or is it going to be something a little bit different? And I think, what our perspective is that we're going to be left with a situation with higher commodity prices. And then the question is, does everyone lose, or are we going to have winners and losers? And we're more of the latter train of thought. And we think that there's going to be more opportunity to be more selective. And we think that, the U.S., for example, it's hard to argue that they're not going to be more insulated from a terms of trade perspective. And there'll be some more weakness in other regions like the UK and Eurozone. So I think you have to be a little more selective.
Well, let's stay within the United States and get selective there. Pre-war, semis were doing well, software was not. Post-war, for the month of April, semis have ripped, software has struggled. Do you expect that to continue?
I do expect it to continue. I think the hardware, the semi story is undeniable. There's a lot of demand. I think software, we're trying to sort through what are going to be the disruptions from places like Anthropic and different companies. But, our perspective is that, we think, it's still going to be more of the same. And we don't see any reason to really change that perspective.
It seems like the leadership has very much been big tech, has very much been the semiconductors, as John mentioned. When you look at the sigh of relief being breathed by the entirety of markets, how much do you need to see corporate executives talk about actual efficiencies, actual gains coming from some of the deployment of AI to justify the ongoing rally?
Yeah, so I don't know if we need to see immediate justification. I think it's a clear race, between the U.S. and China, both, I think, militarily and I think from a commercial perspective. And I think the perspective is that that's going to be ongoing. I think earnings right now, 12 months forward, it's about 30%. So it's really hard to get negative, especially after we had the correction that we did. So I think, right now, we do eventually need to see some revenue, but the demand is so significant, especially in the hardware space, that I think it still instills confidence in investors to move forward.
When I think about the demand coming from AI, and then you think about the fact that commodity prices, as you just said, will probably be higher, why has everyone moved on so quickly from this inflationary story that could potentially pressure yields higher and could create a really difficult situation for central bankers?
Well, when I think about the inflationary pressures, I think you also have to think about the growth side. So I think when we think about valuations, for example, and the support from an interest rate perspective, I think investors are skeptical that central banks will be able to hike as much as being priced in. So we would push back on that. So I think the growth aspect is going to keep central banks largely in check in the background. And again, we'll have to deal with inflationary pressures, but that was to my point earlier. There's going to be winners and losers, and that's where I think you have to be selective.
Is there also winners and losers when you look globally? Because the energy shock is really still hitting Asia and as well as Europe, and we're not feeling it as much in the United States.
Yeah, so I think it's definitely going to hit Asian countries. I think about South Korea. I think about Japan. They import 90% of their energy. But again, that actually brings some opportunity. So the baby will get thrown out with the bathwater. I think the Asia tech trade, there'll be some opportunities there, down the road as we get these corrections. But no question, I think Asia's very exposed. And as I mentioned, I think Europe is very exposed.
What would it take the market to care once again about the conflict? The Washington Post this morning is talking about sending thousands of additional troops. We always say, look at what Trump does also, not just what he says.
Sure.
But the market seems to be ignoring any sort of escalation.
Sure. So I think you need to separate two things, the nuclear agreement and I think opening of the Strait of Hormuz. From a market perspective, they're focused exclusively, I think, on the Strait of Hormuz. Keep in mind, for example, the JCPOA agreement with Obama, that took about 2 years to sort. So that's not going to get, I think, resolved anytime soon. It'll take some time. But the Strait of Hormuz, there is incentive, I think, for all sides to try to find some resolution. And I think that's what the markets are sniffing out and looking forward to.
And that's the carrot for the market right now. The president recorded an interview earlier this week with Fox News, getting some headlines from that conversation just moments ago. Maybe the end result will come soon, Bramo. And on the blockade, no pushback from the Saudis. There was some suggestion that there might have been some pushback from the Saudis. Not seeing that in these comments this morning.
No, and talking about how he sees the end as being very close, and ongoing sort of edification of what you're seeing in markets with respect to this sort of seamless effort toward a ceasefire. Look, I mean, Emery's not wrong when she raises skepticism. And I mean, I respect the Debbie Downer. I respect the fact that you can cast some cold water on this because, frankly, this conflict is not over. And you talk to any geopolitical strategist, they say the world has fundamentally changed. But the market has said, ultimately, to the degree that it's changed, we've moved on. President Trump seems to be leaning onto that, given the fact that higher markets seem to support him.
The world also has fundamentally changed, and so has Iran. I think the president always says there is a new regime. Not regime change, just change within the regime. Actually, these are hardliners as well. And they're going to come with the same hard lines to the negotiating table that their predecessors have. Also, what's interesting is Trump says that China had no pushback on the Hormuz blockade. I think that is incredibly interesting because China is the one that, of course, buys all the Iranian oil that the U.S. is now trying to stop.
Crude this morning, Brent crude at 95.80 at the front end of the futures curve, WTI at 92. The president saying that oil will be down to the levels it was and maybe lower. Now, I know the presidential jawbone can be effective, but that is quite an effort to jawbone this market a little bit lower.
The only way that could actually transpire would be if there was serious demand destruction on a mass level. And that would require some sort of decline in economic growth. But right now, based on the fact that you've had more than 10 million barrels a day taken offline and not coming online anytime soon, it seems unlikely unless you get some sort of serious slowdown.
No, you get that one. Oil will be down to the levels it was and maybe lower. Noel Dixon, your response to that?
Yeah.
Don't fancy it?
No, I don't fancy it.
Noel Dixon of State Street there. No, thank you, buddy.
Thank you.
Appreciate it. Let's get you an update on News Worldwide with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. The U.S. and Iran are looking to arrange a second round of peace talks in the coming days. Sources telling us here at Bloomberg the objective is to hold more discussions before a ceasefire expires next week. One proposal is to return to Pakistan, though other venues are being considered.
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams, whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
Israel and Lebanese officials meeting for the first time in more than 30 years for high-level talks in Washington. The Israeli ambassador calling it, quote, a victory for sanity, even as officials play down hopes for an end to the war with Hezbollah. And prosecutors making a surprise visit to the Fed's offices this week amid the DOJ's investigation into Fed Chair Jay Powell. Sources telling us here at Bloomberg officials tried to enter the construction sites but were denied entry because of clearance protocols. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Up next on the program, the White House teeing up peace talks.
I think it's close to over, yeah. I mean, I view it as very close to over. We'll see what happens. I think they want to make a deal very badly.
Up next on the program, we'll catch up with Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. The rally stalling out just a little bit, unchanged so far this morning on the S&P 500, unchanged on the Nasdaq. But what a move we've seen so far this month. Only one down day so far for the month of April on the S&P 500, a rally off the low of about 10% and within striking distance of all-time highs on the S&P 500. Now that's at the index level. If you look at the energy sector has basically wiped out all of the gains on the S&P 500 that we saw through the month of March. That's amazing.
Especially given the fact that oil prices haven't come down to where we were before March. So ultimately, people are looking at this and saying it's pretty much a wash for them, given the fact that they've got destruction to some of their facilities in the Middle East, and they're not necessarily going to be profiting so much more from high prices. The market is treating this as though it's a blip and we can all move on.
Brent crude at 96 right now, WTI at 92. Under surveillance this morning, the White House teeing up peace talks.
I think it's close to over, yeah. I mean, I view it as very close to over. You know what? If I pulled up stakes right now, it would take them 20 years to rebuild that country. And we're not finished. We'll see what happens. I think they want to make a deal very badly.
So here's the latest this morning. The president signaling he's ready to wind down the war in Iran, saying peace talks could restart in the next 2 days. Bloomberg's Tyler Kendall has the latest from Washington. Good morning, Tyler.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Hey, John, good morning. Well, our reporting maintains that both sides are seeking another round of in-person negotiations ahead of next Tuesday's ceasefire deadline. But that means that things have to get going quickly because President Trump indicated earlier this week that the timetable for a deal has not changed and suggested in an interview yesterday that he may not offer any sort of extension. There are signs that Iran is potentially trying to avoid some escalation here, at least in the short term as well, as Bloomberg News reported yesterday that the country is considering a temporary halt on shipments and maritime activity that could violate the U.S. blockade, though at the same time, Iranian state media did report last night that an Iranian supertanker made its way through the Strait of Hormuz, though that has yet to be confirmed by the U.S. Instead, we got a statement overnight from CENTCOM saying that all commercial traffic to and from Iranian ports has been halted. As we're getting more details, a U.S. official telling us that the military is stationing its vessels in the Gulf of Oman instead of directly near the strait in a bid to give the U.S. more flexibility. This blockade isn't the only means of pressure that the U.S. is looking to deploy ahead of potential dialogue, including the Washington Post now reporting that additional troops are being sent to the region, and the U.S. Treasury threatening additional secondary sanctions on any financial institutions that aid the country. John, as you all know, this comes after yesterday the Treasury announced it was not renewing that 30-day waiver for purchases of Iranian crude already at sea. But I will point out that Bloomberg News is reporting new this morning that nearly 4 million of those barrels just arrived in India ahead of that waiver expiring. This after just yesterday, Indian Prime Minister Modi called President Trump about the war in Iran, as we get these more headlines that the president has been speaking to world leaders about this, including breaking in the last few minutes. President Trump saying that China hasn't taken issue with the strait being closed so far.
Tyler Kendall with the latest in Washington. Tyler, thank you. Tyler's right. According to the president, China hasn't pushed back. The Saudis haven't pushed back. Moments ago, it's starting to sound like the Iranian military is pushing back.
Right, the Iranian military saying that the United States needs to get out of the blockade, and potentially what they have continuously said is there will be escalation because of this. They had said that if you block our ports, we are going to go after your partners' ports in the region as well.
To discuss, joining us now, Colonel Wayne Sanders, the Senior Defense Research Analyst at Bloomberg Intelligence. Colonel, welcome back to the program, sir. How fragile is this ceasefire?
It's pretty fragile. I think if you look at the next 24 to 48 hours, Iran's responses are going to be key here. The first 24 hours in the blockade, I'm sure it's just Iran trying to be able to figure out where they can position forces necessary if they need to respond. And so I think a lot of the tell there is going to be on whether or not any of those strikes actually take place over the next 24 to 48 hours against some of the Gulf states, as well as U.S. military bases in that region as well.
Would Iran do this within the Gulf of Oman and the Strait of Hormuz, or would they actually try to get the Houthis involved in the Red Sea?
I think they could do either one. I think that if they get the Houthis involved, obviously it gives them a little more plausible deniability in the region. But when they keep things localized, if they're trying to keep it U.S. focused, they're trying to keep it against what we're doing on the blockade, then they're going to want to have some type of show of force against either U.S. or anybody that they're trying to escort through.
What do you make of the fact that the Pentagon, according to the Washington Post this morning, is sending 1,000 more troops to the region?
So, I mean, I think that one is obviously it's a leverage that that the president can use, but also on the military side, it could be to shore up additional boarding and interdiction teams, which could be part of the blockade. Seizure and inspection of vessels actually takes quite a few people to do that. The 11th and 13th Marine Expeditionary Units are very good at that, but if these are reinforcing of that, it might also be hardening bases in the region. So I think the real tell there is going to be what type of logistics follows along. If it is a lot of Army logistics, you might be looking at more of hardening of the U.S. bases in the region. It might also just be something along the lines of military Sea Lift Command, which are the ones who actually provide kind of a conveyor belt of resources and fuel and all that to the ships in the region. That could also be a play in this as well.
Colonel, I've seen a lot of commentary from different officials talking about who holds the cards. It seems like everyone's talking about that. Is it the U.S. holding the cards? Is it Iran holding more cards? What's your sense of the points of leverage right now heading into further negotiations at a time where we still pretty much seem to be at a stalemate?
Yeah, so the military normally looks at it. There are four levers of national power. You have diplomatic, information, military, and economic. So on the diplomatic side, both sides are trying to apply that same level of pressure to be able to do it. On the information campaign, I would say Iran normally does pretty well on that because of the asymmetric threat. They don't have to strike a whole lot. They just have to have something on fire to be able to create some chaos in the market and create chaos around the world. Militarily, the U.S. is dominated in that region, but the IRGC does have capability. And then economic, you've seen a lot of these pieces play out over the last month as well.
How much do you really see China playing a part in this? We know that President Trump was saying that China did not push back regarding the blockade. There are questions, and there have been reports about China supplying weaponry to Iran, potentially even a new air missile defense system. What's your sense of what the reality is and what's fiction?
Yeah, I find that very, very hard to believe, especially if you're talking about exquisite air defense systems, because these things aren't small, and the U.S. has eyes in and out of Iran pretty much across the board. So you're not going to see some large, aircraft coming in that's dropping off these types of supplies that's not going to require a U.S. response. So I think that's probably one of the biggest ones. I've seen other reports that are dealing with a lot more of the smaller shoulder-fired weapons, while I still think that's very risky for China to do, because if it is attributed back to them and there is a lot of proof there, that obviously puts them in a worse position on the national stage. But if they are trying to smuggle those in, those smaller type weapons, those shoulder fire, Stinger type missiles and things of that nature, those types of weapons are small enough to be able to get through onesies and twosies, but you're not going to be able to put it together at the level of the air defense systems that some of the reporting is putting out there.
It's not just weaponry, though. The Financial Times this morning saying Iran used Chinese spy satellite imagery in these companies to target U.S. bases. At the same time, the president seems to be striking a more friendly tone with what Beijing is saying to Washington. How concerned are you about how much China is really helping Iran and targeting U.S. service members?
So, when it comes to China, I know we had that talk earlier about Russian intelligence, supporting Iran as well. I think part of it we all need to remember, too, is that a lot of that is dual-use technology that could be tied to China's civilian side, as opposed to dealing with the Chinese People Liberation Army or the Ministry of State Security or anything like that from that perspective. So I think that it is definitely being leveraged. I think that Iran is going to use anything and everything they possibly can. And because of how good technology with satellites has become, even on the commercial or on the military side, it has allowed an advantage, a technological advantage for pretty much everyone to catch up somewhat to the technological advantage of the United States when it comes to satellite imagery.
Colonel, you're in a different seat to the seat that a lot of people on Wall Street are sitting in. They're focused on markets, and the comments coming from the president. It's an anticipatory asset class. Basically, they're seeing the president looking for an off-ramp. This market's moved on. What guides you, away from presidential statements, what guides you and your thoughts about how things are progressing?
I would probably say when I look at the military strikes against some of the Gulf state neighbors, that is something that has started to wind down, obviously, during the ceasefire. It went from 149 strikes the day before the ceasefire down to 7. You saw a handful of upticks a little bit during each of the times. but not to the same level that it had been for the first 4 months. So I think, or excuse me, 4 weeks. But what I continue to look at right now is some of the logistics tail, where we're actually going, the transition of the U.S. military into the types of weapons that they're using, and then at that point in time, also the response for some of the other folks in the region, the Gulf states that are playing a part in this and starting to put additional pressure. I think all of those are good telltale signs that things are moving in the right direction. But Iran having an asymmetric threat is always that card that they can play at that last second.
And that threat certainly still lingers. 4 weeks felt like 4 months, without a doubt. Colonel, thank you. Colonel Wayne Sanders there of Bloomberg Intelligence. And what guides him and how he's thinking about this war?
Yeah, and right now it seems like it's less bad news also on the geopolitical front. Things are not escalating or getting worse. And that's the reason why Wall Street is moving on. There are frictions, though, that are going to be long-lasting. And this really is the ultimate question. The Strait of Hormuz may never be open again the way that it used to be. What does that look like? And the fact that people have kind of moved on is notable given the potential inflationary pressures.
People have moved on, but we should note the shock in Asia is really getting very, very dire. Right now you have Pakistan that is dealing with controlled blackouts in the evening because they want to make sure they're controlling the price of electricity. For the first time ever this morning, India received Iranian crude barrels. Well, guess up. That waiver's ending, and this blockade means no more oil's coming
We've seen
through.
that rationing across Asia. It's been brutal for them, I know. Coming up on the programme, we'll catch up with Susan Bell of Rystad Energy with crude trading back below 100. Plus, Yahira joins us. She's got your morning movers. Broadcom rising on a new chip partnership with Meta. That stock is up by 2.5%. Live from New York City, you're watching Bloomberg TV.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
We are wrapping up quarterly bank earnings on Wall Street this morning. In about 15 minutes from now, we should hear from Bank of America, Brian Moynihan and the team. In the next hour, we should also hear from Morgan Stanley, Ted Pick and the team at 7:30 Eastern Time. Bramo catching up with Ted Pick later on this morning, so look out for that in the 10 o'clock hour, I believe, Lisa.
Yeah.
A little bit later this morning.
And really the key questions that everyone has is how big is that pipeline? How much can capital markets remain open? The other interesting note is how much all of the executives have completely dismissed private credit concerns. They're all coming out and saying, ultimately, this is not systemic. We have it under control. I expect the same there. And then just going forward, how much are consumers really feeling the heat, given the fact that ultimately they had a lot of spending power going in and Americans like to spend?
Ted Pick catching up with Lisa later this morning. Don't miss that, 10:45 Eastern Time. Your equity market at the moment pulling back just a touch on the S&P 500, negative by a little more than 0.1%. On the Nasdaq, down by 0.2. What a run on the Nasdaq. 10 consecutive days of gains, the longest run since November 2021. That little bit of weakness this morning, some headlines moments ago from Iran pushing back on the blockade and really exposing just how fragile this ceasefire might be.
The Iranian military spokesman, according to Iranian state TV, is basically saying that this constitutes a breakage of the ceasefire terms. They also say if it continues, Iranian's armed forces, the IRGC, will not permit any exports or imports to continue through Persian Gulf, the Sea of Oman, or the Red Sea. Basically saying we are going to go after all of these other parts of our proxy regime that have been dormant for the past 6 weeks.
That's boosting crude this morning, up by 1.8% on Brent, on WTI. Both of those contracts, the front end of the futures curve, closing below 100 for 5 consecutive days now. That's bringing this market just a little bit of comfort, but a boost from the headlines we've seen in the past 15 minutes. They're the scores. Let's get you some single names, some morning movers. Yahira has more. Morning, Yahira.
Hi, John. We start with Broadcom. Those shares are rising 2.6% as the company expands its partnership with Meta, building custom AI chips. It's part of a multi-billion-dollar effort to build out more than a gigawatt of computing power. And it speaks to something larger that we've been hearing from guests, that the AI build-out is alive and well. Deals still getting done. We keep hearing about them, even as this market grapples with the Middle East. We are also seeing shares of Nike moving higher in the pre-market, up 2.3% on a show of confidence from the top. Board director Tim Cook and CEO Elliott Hill buying the stock, putting about $1 million to work. It's a show of support as Nike goes through this rough stretch, but we've seen this type of buying before, and the stock is still down some 30% year to date. And we end on shares of Robinhood rising 4.25% after a big shift from the SEC, the agency approving changes that remove key limits on day trading, including that $25,000 minimum balance. So it's now easier for retail traders, retail investors to trade more actively, and that is a boon for the likes of Robinhood, since retail makes up such a large portion of its users. John?
Yahara, thank you. Thanks for the update. More from Yahara in about 15 minutes' time. On our radar this morning, President Donald Trump suggesting talks with Iran could resume this week. A ceasefire between the two nations expires next Wednesday. The president did not say if Vice President J.D. Vance would continue to lead negotiations. Elsewhere, the Treasury Secretary, Scott Bessent, saying the global tariff struck down by the Supreme Court could be reinstated.
We will be implementing or conducting Section 301 studies so that the tariff could be back in place at the previous level by beginning of July.
The president imposing a temporary 10% tariff following the High Court's decision. The levy set to expire July 24th. And finally, Anthropic drawing investor offers that could value the company at more than $800 billion. It's not clear if the AI startup will accept investor terms. Anthropic previously discussing a listing as early as October.
Yeah, in the last round of funding, Anthropic was valued at $350 billion. That gives you a sense of more than the doubling that this $800 billion valuation comes into play. And it comes after the Mythos experience that we all had, which I just want to add, it's really notable that after Anthropic came out and said, we're going to release something only to a couple people because it's so dangerous should it fall into the wrong hands, guess who's doing the same thing? OpenAI. They're about to roll out something only to a few people because they too have something. Guess what? We too have something that could be dangerous, so watch out.
Right, so they come out with this thing that everyone wants their hands on, and now it's like, oh wow, their valuation is so much higher. I find the U.S. government relationship with Anthropic right now fascinating. On one hand, they're fighting intensely with the DOD, and we had the Undersecretary Emil Michael on after he basically said that Dario Amandi had a God complex. Then the Treasury Secretary last night hailed what Anthropic was doing and calling it a revolutionary step that'll keep America ahead of China.
This industry has such a huge branding problem right now that they need to address. And it's exacerbated by the leaders in the positions that they are at the companies that you talked about. And I'm not sure what they're going to do about it between now and the IPO. I'm sure the kind of comments they make at the moment help increase the valuations of their firms going into those IPOs that people expect later this year. But it certainly doesn't help consumer attitudes, and I would say attitudes of the electorate at large towards these companies. And that could expose them further down the line when the people that represent those electorates will be setting the regulation around those companies and the taxes they'll have to pay as well.
Yeah, and not to tie too many things together, but this is also related to the recent disruption that we're seeing in energy markets because energy bills are already going up. And then if you think about how much electricity costs are going to go up for any regions that are tied to some of these big hyperscalers, that's going to become increasingly a political issue.
Let's turn back to the energy story. Crude rising after Iran warned the U.S. against continuing its naval blockade, saying it would violate the terms of the ceasefire. Susan Bell of Rystad Energy writing, Hormuz will reopen. But the question is how much pain the market absorbs in the meantime. Susan joins us now for more. Susan, good morning and welcome to the studio.
Thank you so much.
Let's get into how much pain we're experiencing right now. Just describe what's happening in physical markets.
Well, the physical markets are extremely stressed, and I think, a lot of focus is on the ICE Brent price, but the ICE Brent price is a cash-settled market, right? It's not a physically settled market, and really, if you want to see what the pain is, look at dated Brent. And dated Brent premiums to ICE Brent are in the order of 25. Yesterday, the market closed out with dated Brent at, I think, $30 higher than ICE Brent. So the true physical markets are extremely stressed.
Do you expect that to turn around anytime soon? Because this market, and when I say this market, this equity market has moved on really, really quickly.
Right. No, I don't. I mean, we really do need to see flows establish out of the Strait of Hormuz before the physical markets can start to rebalance. I do, I think the reason why the financial markets, the crude oil financial markets have been relatively stable over the past couple of days is that we have yet to see Iran retaliate. Now, the U.S., the Pentagon yesterday said that they successfully blocked four vessels, or at least 4 vessels turned around on their command. But then there's conflicting news coming out of some of the ship tracking agencies that are saying, well, actually there was one vessel that was loaded at an Iranian port that was able to get through the blockade. So, there's a lot of really conflicting information out there, and so far Iran has not retaliated. But the news this morning that they do intend to retaliate if their trade does get blocked, that would amp markets up all over again.
Let's say there isn't a massive escalation, that things kind of stay where they are for a number of weeks and then slowly get a little bit better. Yeah. Does it make sense to you that December dated contracts for Brent are at $82.49?
It does. If there is not a massive escalation and if the Strait of Hormuz takes its time to reopen, it does make sense that dated Brent, or that the Brent contract is so elevated in December, because what's happening right now is we're digging a hole in inventories. And when the supply recovers, a lot of that volume has to go back into restocking, right? So it's not that we're going to see the markets collapse the minute we start to see flows coming out of the Strait of Hormuz.
I thought you were going to say that it should be a lot higher. So that was where I was kind of heading. So that's sort of one of the questions that people have. We're focused very much on the oil and the energy space. Is that the real disruption that you think is going to be truly problematic for the global economy? Or do you think that some of the other disruptions, whether it's agriculture, whether it's the metals sector, could be potentially worse?
I think that, energy it's almost a human right. And that is going to be the most painful impact of all of this. But I do believe that there is, if we don't start to see something happening in the ag space, the fact that fertilizers are so expensive and effectively unavailable for some nations because it's unaffordable, this could move into food scarcity. Which is very concerning.
Well, what about things like LPG, which India needs to cook every single meal?
Absolutely, and LPG is a significant issue, particularly for India. They had resolved their immediate concerns by negotiating transit for vessels through the Strait of Hormuz, and of course, the Trump administration is saying they are not going to block navigation for trade that is not tied to Iran. So India should still be able to get their LPG. But of course, if Iran retaliates, that upends everything. And if Iran retaliates and the Houthi get involved and start to impact that flow out of the Red Sea, that puts even more pressure on Asia, because so much of their crude oil is coming from that direction now.
This morning, India actually got 4 million barrels from Iran from that general license that the Treasury had 3 weeks ago that they were unsanctioning Iranian oil at sea.
Yes.
How long does it take for a ship to go from the Strait of Hormuz to a port? Basically meaning, if its blockade really started in earnest yesterday, when do you think we could see even more physical disruption?
So I think the average days of transit from the Strait of Hormuz into Asia is 15 to 20 days. It depends. I mean, if they're going all the way to China, it's longer. India, it would be shorter. Asia has already seen the fact that they're not getting any oil right now. There was oil on water through the first 25 days of March, but now there's no oil on water.
Susan, it's good to see you. Thanks for dropping by. It sounds like a doom and gloom conversation relative to the enthusiasm elsewhere in the stock market, but this is real. That's what's happening in physical markets right now.
Well, that's the reason why, as much as you feel doomy and gloomy, I think a lot of people are on the same page. It's just that markets are saying, what is the pain threshold in which the global economy can move on? And people are taking the most rosy scenario at face value.
Susan Bao there of Rystad Energy. Susan, thank you once again. This headline from AP just crossing that mediators are moving closer to extending the US-Iran ceasefire. That headline crossing just moments ago, that mediators are moving closer to extending the US-Iran ceasefire. Some conversation about that in the last week. We'll keep an eye on that. Crude still elevated, close to 97 on Brent. Earnings from Bank of America just around the corner. Before we get there, let's get you some top stories, some headlines with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump signaling he's ready to wind down the war with Iran. Trump telling U.S. news outlets that peace talks could resume in the next 2 days. The president saying Iran now has a different, less radical regime. A confirmation hearing has been set for President Donald Trump's nominee for Fed Chair. Kevin Warsh will face the Senate Banking Committee at 10 a.m. next Tuesday. Senator Tim Scott expects the DOJ to drop its investigation into the Fed's renovation project, clearing the way for Warsh to be confirmed. And Snap is laying off roughly 1,000 full-time employees, or 16% of its global workforce. In a memo to employees early this morning, the CEO said the cuts are necessary for Snap to boost efficiency and profitability. He also cited improvements in AI technology that let Snap employees move more quickly. That's your Bloomberg brief. John.
Yahira, thank you. Thanks for the update. Up next on the program, mixed results from the big banks.
There is still a lot of uncertainty out there, but should the hostilities in the Middle East start to die down and we get this resolved sometime in the second quarter, that points to a very healthy second half of the year for the banks.
In just a moment, we'll break down the results from Bank of America with David George of Baird. Plus, we'll get you the latest on a U.S.-Iran ceasefire. AP reporting that they agree in principle on extending that truce. More on that headline and the latest results from Bank of America in just a moment.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
We've got two things to do here, the latest on Iran and the US, and then we'll break down the results from Bank of America as well. Let's start with the latest on the US and Iran. This from AP moments ago. They've given, in principle, an agreement to extend the truce. The latest from the US and Iran, according to AP just moments ago. So, in the equity market, there were some very small losses. We've erased them. We're just about unchanged on the S&P 500. In the commodity market, there was a boost to Brent and to WTI. We've erased some of those gains. Brent crude down to about 96. WTI at 92. The truce set to expire in the next week or so, and this looks like the US and Iran is getting closer, in principle at least, to agreeing to extend it.
It's supposed to end on April 22nd, so we'll see how long that they're willing to, in this idea, in principle, extend that truce. It also comes at the time where the Pakistani Prime Minister has announced he will be making a visit this weekend to some Gulf countries like Saudi Arabia, Qatar, as well as Turkey. So for him to then go back to Islamabad, have consultations with these other mediators that have been trying to bring an end to the hostilities, this actually tracks and makes sense. It's interesting, though, this comes after the Iranian military said, if you are going to continue this blockade, we view that as essentially ending of the ceasefire, and we're going to go after some ports.
The market, I think it's fair to say, focusing on one of those headlines and not the other,
yes,
given the 10% move we've seen off the lows in the equity market. I mentioned the second piece of news we need to cover, results from Bank of America crossing just moments ago. That stock is up by 2% in the pre-market. With the latest, here's Danny for more. Hey, Danny.
Hey, John. It has a similar flavor, I must say, to Goldman Sachs. That is a big beat on equities and a really large number for equity trading, but a slight miss on FICC trading. So the numbers themselves, equities comes in at $2.83 billion. The expectation was just over $2.5 billion. That is a record quarter from Bank of America when it comes to equity trading, which means their overall trading numbers, a slight miss because of a miss on FIC, $6.3 billion. That still is a record quarter for trading. FIC comes in at $3.5 billion. The estimate was for $3.8 billion. So that is where we are seeing a miss in their trading numbers. But again, it reflects a really strong first quarter for all of Wall Street, given the volatility and the results on the trading desk. When it comes to their net interest income, that is a beat too, $15.75 billion. The estimate was for $15.37 billion. It's something the company had been very optimistic about. Their co-president not that long ago was guiding towards at least 7% growth in net interest income. So we expected that to be a strong number. I would just flag what they're saying about credit. We've seen the banks, many of them for the first time, break out their private credit exposure. Bank of America, no exception in this regard, breaking out that they have $20 billion worth of exposure to private credit. That would actually put them in the smallest camp of all of the banks we've heard from so far. Just a reminder, Citi, $22 billion, Wells, $36 billion, JP Morgan, $50 billion. So Bank of America showing that they have less exposure to private credit than their banking peers. Finally, just some of the commentary we're getting from Brian Moynihan saying we remain watchful of evolving risks. However, we saw healthy client activity, including solid consumer spending and stable asset quality, indicating a resilient American economy. So something we've heard from other executives. Everything looks good for us, but there are evolving risks.
Danny, thank you. Thank you for the update. Hermes and LVMH have been beaten up in the last 24 hours, but if they've got a store near a Wall Street bank and this keeps up, I think they're going to be okay. The latest headline from Bank of America, record equity sales and trading revenue. Over at Goldman, we had a Wall Street record for equity trading revenue. Over at JP Morgan, traders posted their best ever quarterly revenue. At Citi, the highest quarterly trading call since the financial crisis. So these guys have been busy over the past 3 months.
Yeah, the volatility has been a good thing when it comes to their returns. You did see, as Danny was saying, Bank of America missed slightly on the fixed income currencies and commodities trading. Nonetheless, still coming in with $3.5 billion of revenue versus the expected $3.78 billion. The takeaway also, very much the consumer is solid and the U.S. economy is chugging along. At what point does the volatility that's fueling trading and sales potentially stymie the pipeline that has been fueling also record banking fees? And that is maybe a tension and maybe not as people look to a brighter future for at least banks.
Let's get to David George of Baird. David, welcome to the program. You've seen the results from some of the big players. Can this keep up? And why aren't you as bullish as some on the street are on some of these names?
Good morning, John. Thanks for having me. Yeah, these numbers look pretty good. We're kind of just processing them as you are in real time here. But as you say, they look pretty good across the board. Capital markets was very strong. We had a lot of volatility in oil, gold, silver, and rates throughout the quarter. And obviously, B of A benefited from that, as did some of the other money centers. In terms of the stocks, there was a window to buy a couple of these maybe at the beginning of the war, and we upgraded a handful of the regional banks during that period of time. But we still think that the risk-reward trade-off is better in some of these regional banks, like a Huntington, Fifth Third, PNC, and Citizens, for example.
And we just did see PNC, for example, report earnings and raise their full year net interest income estimate. I'm just wondering, have we put to bed some of the concerns about private credit? Danny was talking about how all the banks are breaking out their exposure. Bank of America came out with a relatively low exposure. Their net charge-offs are lower than expected. Is there sort of a waning in interest and concern about this area?
Yeah, you know, it's really going to be headline dependent, but we've been of the view that market participants are maybe overly concerned, Lisa, as it relates to private credit. And again, I think it's important, and we heard this throughout the quarter, that the big guys and even some of the regionals were going to kind of size this private credit exposure to make market participants maybe a little more comfortable around the exposures and actually the actual size. And as these companies report, these are 1% to 2% of total loans. And again, Wells is almost a $2 trillion balance sheet. Same with B of A, and these are $20 to $30 billion loans. And again, the structures of these are also very low risk. So from our perspective, those fears are overblown. The bigger fear around credit is a function of how long does oil stay here? If oil is elevated for an extended period of time, it's a concern around the consumer potentially, as well as just how it makes its way into inflation and the impact on corporate profit margins.
David, just based on the big banks, not necessarily the regionals, and we still have Morgan Stanley yet to report, who's been the winner so far in your eyes?
Honestly, I'd say JPM and B of A probably had the best quarters. Obviously, as you mentioned, Wells had a tougher quarter. They reaffirmed the outlook for the full year, but they missed our pre-provision, which is basically kind of your pre-credit earnings number, by 4 to 5%. And I think it's also important to note that the stocks came in relatively hot. We have erased all of the war fear and losses going into earnings. So we've seen almost a 10 to 15% move in these stocks. So they came in a little hot, but we think that JP so far has had the best quarter. Excellent capital, excellent core trends, and a great outlook as well.
David, always great to hear from you, and thanks for making time for us. I know how busy you are on a morning like this morning. David George there of Baird breaking down the latest results. This is what we're seeing in Bank of America. I'm very interested in how the consumer's doing right now. We've heard from a range of banks that everything's okay. Just to break out the details from B of A, consumer banking up 21%. Payments up 5%. Consumer credit debit spend up 7%. Deposits are up, loans have grown. When you look across the bank right now, that speaks to an economy that's still doing well, better than okay. And I'd say we've heard that on repeat from several banks across Wall Street over the last week.
And even when they've gotten pushback from analysts saying, what about higher gasoline prices that offset the one big beautiful bill and any kind of tax refund that people get? What they've all said, led by Jamie Dimon, is they can absorb this and then some. And what you just saw in the Citigroup consumer spending pulse, again, just really strong across the board with an expectation that even retail will start to do better.
Yeah, Brian Moynihan saying he sees a resilient American economy. They all continue to say that. What's going on in gasoline prices, potentially trickle-down effects of diesel when it comes to other products like your food, is not hitting the consumer right now, or the consumer at least is able to make these decisions and weather the storm.
Stock is positive in the pre-market by some 0.6%. One more bank to go, Morgan Stanley, in the next hour. So far, so good, though, for Wall Street. Bank earnings are fine, based on what we've heard so far. On top of that, we're looking at extending a truce between the US and Iran, based on our headlines from AP just moments ago.
The more you can take the temperature down and put that in the rearview mirror, the more people will focus on how good earnings are. And so far, so good, as you said, with respect to both the outlook as well as the read on the American consumer.
Up next on the program, we'll catch up with Beata Mathy of Citi, Ed Mills of Raymond James, Gerard Cassidy of RBC, and George Wonderland of Schroders Capital from New York City this morning. Good morning. The second hour of Bloomberg Surveillance. Up next.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
There is scope for inflation to go higher.
Base case is that you'll stay around 3%.
We in the markets accept that a 2% inflation target is a myth.
There are cracks in this economy. There's some other kinds of tailwinds that are holding things up.
Longer term, things have been quite stable.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. The scores, the price action looks like this. Equity futures just about unchanged on the S&P 500, within 1% of all-time highs on the S&P 500, following a 10% rally off the lows on the S&P. 10 days of gains on the NASDAQ, a 10-day winning run, the longest since 2021. In the crude market, with 10% moves on equities off the lows, we've had 20% moves off the highs on crude. Brent this morning at 96, WTI at 92. A report from AP that the US and Iran is close to extending this truce.
Yeah, which would be balm to the ears of so many people on Wall Street who already have declared mission accomplished. Ultimately, it would indicate that kicking the can down the road means no further escalation, at least not in the near term. And that's part of the reason why people have moved on and looked to earnings, which have been pretty good. Actually, they've been better than pretty good. And looking to the tech investments that, once again, seems to be the ballast to this economy.
This report signals that they want this, kicking the can down the road, keep the détente. Right now, living in almost purgatory, no fighting, but no true peace. If you look more into the AP report, though, there is one official speaking to the AP that says before the ceasefire ends on April 22nd, 3 main sticking points they want to get through. What are those 3 main sticking points? Oh, Iran's nuclear deal, the Strait of Hormuz, and wartime damages. None of that is going to happen before April 22nd.
Stop spoiling the stock party. That's how people feel this morning, just as you speak.
I'm getting a lot of panicking messages from people like Neil Dutta.
Look, in fairness to you, that is what's happening in the physical oil market. The Strait of Hormuz is still largely closed. Physical prices, there are shortages across Asia. We're seeing them build. The Europeans are worried because they've had their last deliveries of some oil products and they know that nothing is coming yet. And there is this hope that in the future it will. And this market continues to take comfort from the shape of the futures curve and how depressed prices are looking further out.
I just find it challenging when Pakistan literally overnight is they're suspending electricity supply for about 2 hours every single day. In Asia, you have individuals who are not going out to work. The government is saying you need to stay home. What you described what's happening in Europe, they know that they're on the edge of their last products being delivered, especially things like jet fuel. And they're having meetings because they need to do something because consumers are very angry. We're a little bit more insulated here, and I think the market also takes comfort that the President of the United States at least is signaling this is the direction of travel he wants. He wants an off-ramp.
Right now, we're looking at earnings as well. Bank of America in the pre-market higher by 0.9% in early trading. Every bank we've looked at, Goldman, record trading call. Trading records over at JP Morgan, at Citi, more of the same from Bank of America. That name up 1%.
You can tie these stories together. Why is the market so sanguine at a time of some potential real pain in the physical commodities market? Because this market is awash with liquidity. Capital markets are wide open. People are getting deals done. And Bank of America, Citi, Goldman, JP Morgan, all minting money. And that is really the story. And frankly, that is the underpinning story of the strength in a U.S. economic story that's tied to artificial intelligence and consumers that still have jobs and still have money.
Morgan Stanley reporting later this hour. We should get those results around 7:30 Eastern time, so look out for that. Coming up this hour, we'll also catch up with Beata Manthe of Citi, with stocks within 1% of record highs. We'll speak to Ed Mills of Raymond James as the U.S. pushes for a grand bargain with Iran, and Joe Cassidy of RBC as Morgan Stanley closes out big bank earnings on Wall Street. We'll begin this hour with stocks nearing all-time highs. Beata Manthe of Citi with a year-end S&P 500 target of 7,700, upgrading U.S. equities to overweight on a, quote, quality defensive tilt. Beata joins us now for more. Beata, good to see you. Welcome to New York. Welcome to the studio. It's fantastic to have you with us.
Great to be here.
Let's get into this call. Overweight U.S. equities. What's underpinning that?
So we've been advocates of the diversification away from the US for over a year. And of course, that was based on the broadening of the EPS coming from broad set of sectors, more cyclically driven. And that's this assumption and what we've been seeing in the data was telling us this would continue into this year. And of course, the war has happened. And with markets almost at all-time highs, and it's not only S&P, it's more cyclical markets like Europe as well, you have to step back and ask yourself, has anything changed? Even if the war finishes today, which of course it won't, has there been other damage done to the economy, or is going to just trickle through damage to consumer? And your assumption right now should be for estimates for cyclical earnings are most likely too high. So we expect some downgrades there. And in the world where downgrades are coming through or will come through, you look to the parts of the market that are upgrading. And that's the US. But again, the US is upgrading through a very different set of sectors. And it's tech again. It's mega cap tech. So AI that was on the shaky ground at the start of the year is back because it's derated and earnings are getting upgraded. That's why.
I give you credit where it's due because you were quite early on the international call at the time, so credit to you and the team for doing that. US leadership appears to be reasserting itself because of the tech story, but we're seeing that in other places too. South Korea, the Kospi is absolutely flying again. Do you have less enthusiasm for the international tech trade? How are you thinking about that dimension?
So you could argue that the international tech trade is more cyclical. I get that, but they are all interconnected. And Korean market, it's something insane. I've never seen anything like that. Every single week, the upgrades to the earnings for Korea are amounting to like 20% extra in the EPS. The earnings expectations have tripled. They are up 300% over the past few months. So for me, again, coming back to this point, in the market where the outlook is uncertain for many parts now, you just follow the earnings, right?
What's fascinating is people are saying it's back to the U.S., and the U.S. seems to be the winner. You're not seeing a commensurate move in the dollar. And actually, now a lot of strategists are coming out and saying they expect a reassertion of the weakening in the dollar that we saw earlier this year. How does that play into a U.S. call when catering to European investors?
So our view is that in this current market environment, you have to be very nimble. So what is winning right now, in a few months' time, could be reversing as well. Because the drivers for the diversification trade are there underneath, right? But they are just overshadowed by other worries right now. And US dollar weakness, of course, that would be very helpful. US usually doesn't outperform in the dollar weakness environment. So that's something to watch out for, but that's really very dependent on the resolution of the war and the speed of that resolution.
I've heard a lot of people say this, stay nimble. What does that mean in terms of the liquidity profile of your portfolio, how much you have to stay in the names that are easiest to trade, the assets that are easiest to trade, given the fact that everyone is expecting potential shifts that could potentially require some pretty significant trade activity?
That's a very important question. And of course, at the start of the year or late last year, everybody was getting excited about mid-caps outperforming, growth prospects getting better. But for us right now, this type of environment, you just stay in large caps, you stay in liquidity.
You say follow the earnings. Commodity strategists I talk to will say follow the barrels, the physical barrels.
Yeah.
What is the tension like right now between, say, your team versus the commodities team?
So our views are pretty much aligned, I have to say. So at the very start of the conflict, what we've done, we've upgraded one of the biggest geopolitical hedges, the UK, to overweight. We've downgraded one region that was very bullish, and we've had it as an overweight to underweight Japan. So the difference this time around versus 2022 is back then it was only about Europe, the energy crisis. Right now it is much broader, and Europe, what there could be physical shortages, but Asia is much more exposed to that.
Do you think the president has also basically primed the market for this because of all the job butting he's done and past episodes like Liberation Day?
Well, it's hard to say, right? What I can say is what I see in the data, and the fact that the situation is still very uncertain, and we do not have the edge on the outcome or the speed of the resolution to the conflict.
How different are the conversations with clients that you're having in Europe compared to the conversations you've had so far in New York?
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
So we get no pushback on the overweight of the US.
I'm not surprised.
Of course, everybody is still quite bullish, the emerging markets tech-related part. And of course, about Europe, investors are worried about longer-term effects of this energy crisis. They should be more limited than last time around in 2022, but there will be some, right? And of course, right now, investors are more upbeat, but our view is that lots of the majority of the market moves over the last week, the squeeze higher, has been because of the short covering. So the market was very, very well hedged, but underneath the surface, most investors outside the hedging have been keeping the same winners as they've had selected for the start of the year. And that could be a problem once the positioning washes itself out.
Beata, it's good to see you. Thanks for the update. Thanks for being here. We should do it again soon. Thank you. Beata Matthew there at Citi. You're trying to start fights with the commodity team over at Citi. Max is joining us later.
Well, I'm just curious because the note leads in with, well, the commodity team says this, so, you know.
Max Layton of Citi joining us from the commodity team in about an hour from now.
Yeah, what I thought Beata said that was actually really interesting is that there is no disagreement, that you can have two things at once. You can walk and chew gum at the same time. I got that expression right. But this idea that going forward,
two for two.
I'm just absolutely crushing. I'm not going to say any more expressions. But going forward, there is a sense that even if oil prices remain elevated, you could still see strength coming from tech, coming from the consumer.
Let's give you an update on news elsewhere. With your Bloomberg brief, Yahara joins us with more. Hey, Yahara.
Hi, John. Mediators between the U.S. and Iran are moving closer to extending the ongoing ceasefire before it expires next week. The AP reporting Washington and Tehran had given a, quote, in principle agreement to extend the truce, allowing for more diplomacy. We are seeing shares of Bank of America rising more than 1% in the pre-market after exceeding estimates for the first quarter. The bank reporting record equity sales and trading revenue. CEO Brian Moynihan remains watchful of evolving risks, but saying the results are, quote, indicating a resilient American economy. And U.S. Treasury Secretary Scott Bessent warning that China's trade surplus threatens global economic stability. At an Institute of International Finance event in Washington, he said the world cannot take a China with a $1 trillion surplus. That's your Bloomberg Brief. John?
Hey, Yahara, thank you for the update. Up next on the program, pushing for a grand bargain.
What the president wants to make, he doesn't want to make like a small deal. He wants to make the grand bargain. He said, if you guys commit to not having a nuclear weapon, we are going to make Iran thrive.
Up next, Ed Mills of Raymond James, live from New York City this morning. Good morning. Equity futures right now just turning positive on the S&P 500 following a close to record-breaking run. Very close, within 1% on the S&P 500 and getting even closer with the gains of yesterday. A 10-day run on the Nasdaq, just unreal. A 10% rally on the S&P 500. The Nasdaq 100 this morning just about unchanged. More bank earnings just around the corner. We'll hear from Morgan Stanley in the next 15 minutes. Crude looks like this. WTI and Brent shaping up as follows. Brent crude at 96, WTI at 92. Slightly elevated this morning, up by a little more than 1%. But some encouraging headlines coming from AP suggesting we're getting closer to extending a truce between the U.S. and Iran.
And that's enough. At least it's less bad news, and it's not necessarily some sort of escalation. I love this idea that less bad news is good news for this market, and everyone would like to move on.
So we go back to old stories.
Please.
The old stories that we love to go back to. The future of the Federal Reserve. I almost don't want to do this because we've done this so many times, but this from the president just moments ago, that Chair Powell will be fired if he doesn't leave on time. So let's set the stage. What does on time actually mean? I think we need to talk about that. His term as chair expires in the next month or so. But if Kevin Walsh is not appointed and confirmed in time, there is reason to believe the chairman will hang around. Is that on time? If the DOJ investigation wraps up, the Federal Reserve Chair Jay Powell has talked about maybe walking away, but hasn't totally ruled out staying on the board as governor. So does that mean he's staying beyond his time? I'd like a slightly firmer definition of what the president is talking about here and just exactly what he's looking to pursue. And
maybe at a later date, he'll give us that time frame. He also said that President Trump said that he was not planning to drop the probe on Fed Chair Jay Powell, and going on to say that he'll be fired if he doesn't leave on time. This goes as the hearing is set for next week. Really key question, though, about whether it will actually go through, given the fact that Tom Tillis very much is digging in his heels and saying until this probe is completed, he's not going to allow this vote to go through.
I'm with Jonathan. I'm struggling with the timing of this, and you. Okay.
10 years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams. Whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
His chairmanship ends basically in a month, May 15th, 2026. But his governorship ends January 31st, 2028. So the president says he needs to leave on time. Is he talking about his chair or his governorship? Because that's a big difference.
That's very odd, isn't it? Look, you've got Kevin Walsh ultimately lined up to have a hearing in the next week, I believe on Tuesday, on April 21. He's got pretty broad-based support in the Senate to get confirmed. He's got support from establishment figures like Jamie Dimon of JP Morgan. We talked about the support for Kevin Walsh elsewhere. So you've got your man, and he's ready to be confirmed. Yet you want to go forward with something that could prevent his confirmation. I just find the whole thing a bit strange right now. The off-ramp was there for you, and it hasn't been taken.
And not only that, but we hear about investigators trying to raid the new Fed building to get more information and getting turned away by security. I mean, it is increasingly becoming an unnecessary drama, and I am editorializing, but a lot of people in markets have already looked on from this too, because they want to look on from everything that is dramatic in any capacity and could potentially derail things. But right now, people are looking to a new Fed that we still don't understand the contours of, and we don't know when Kevin Walsh will actually get through, because both sides seem to be digging in their heels.
Tyler Candill's down in Washington, D.C. Tyler, we were going to come to you on the war, of course, but this takes centre stage now. Your thoughts on what the president is getting at here and what it means for Kevin Walsh's ultimate confirmation hearing we've been waiting for over the last several weeks?
Well, John, it's clear that President Trump is trying to ramp up the pressure, but we have to keep in mind there's sort of two parallel things happening here. President Trump, of course, no secret that he's unhappy with Chair Powell, but it comes on the heels of yesterday, Chair Tim Scott, saying that there is going to be this hearing in the Senate Banking Committee next week. But he also said that he is expecting that legal matter against Jerome Powell to be wrapped up quickly. And that's really what this all comes down to, because as you're discussing, at this point, Senator Tom Tillis has been digging in his heels to block this nomination, despite saying a few weeks ago that he met with Walsh, he likes him, he wants to vote for him, but he does hold that pivotal key swing vote on the Senate Banking Committee. Republicans only have that 13-11 majority, which means that at this point, he really can block it. And importantly, it had appeared that the administration was given a potential off-ramp. After a few weeks ago, we saw this judge strike down the subpoenas that were issued against the Federal Reserve, saying that there weren't the correct grounds to actually issue them. However, at this point, the Department of Justice has been digging in its heels, saying that it's going to appeal that decision. And that is really what we have to look out for. As Tim Scott says, at least, he thinks that this could be wrapped up quickly.
Well, this could get very messy. So, Tyler, thank you. The latest from the president then, speaking to Fox News, these headlines just been released. The Chairman Powell will be fired if he doesn't leave on time. Ed Mills of Raymond James, over to you, sir. Good morning.
Morning.
Good to see you. Your reaction to that headline. Where is this going with this Federal Reserve?
So there's a couple things that we have to watch. One, the Supreme Court's probably going to tell him pretty quickly that he does not have the authority to fire a Fed governor because he's already tried to fire someone, Dr. Elisa Cook. And I think if you take a step back, what he has done is ultimately going to make the Fed more independent. If he didn't do anything, these threats actually could have meant something. And now he can threaten, and it's probably going to make Powell stay longer if he is going to be threatened to kind of get fired for leaving on time. And then we go to Tom Tillis. He's really important. It's 13-11 on the Banking Committee. It will be 12-12. But we also have to remember, you don't actually have to have an affirmative vote in committee to be considered on the floor of the Senate. All that's required is the Senate Majority Leader has to file a discharge petition. If you have 51 votes, or 50 plus the Vice President, you can confirm someone. So yes, he'll dig in his heels. This could add to the drama, but it doesn't stop Kevin Walsh from being confirmed if the Senate Majority Leader and 51 members of the Senate want him confirmed. So that's why the base case remains Kevin Walsh will be in the job sooner rather than later.
May 16th?
Around then. I mean, we still have a month here. We got all of the financial forms. All of the forms are now filed yesterday. Kind of the paperwork is done. Now it's time for a confirmation hearing. That goes well. You just bring it to the floor, prioritize this. He's confirmed.
Okay, so then what happens when the president says the Fed chair doesn't leave on time? He's going to be fired. Do you think the president means his chairmanship or his governorship, which ends in 2028?
Yeah, it's a good question because if you look at the Federal Reserve Act, there isn't anything related to firing the chair. There is about firing governors for cause. And so you could make the case that the chair could be fired and that role, but the individual governor is going to be decided by the Supreme Court. Ultimately, the other thing we'd look at, and this is what we've seen in the past, is that the FOMC actually chooses its own chair. So the president could fire him as chair of the Fed, but the FOMC would then pretty quickly reaffirm him as chair of the policy-making decisions related to monetary policy, which is what the market actually really cares about, Anne-Marie.
Is this an ego issue, or is this an issue of trying to get interest rates lower?
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
I think it's a combination. I think this is just a pattern. You asked, like, why do we do this? He had an off-ramp. He didn't take it. How many times have we said it was right there, and then he did something that made it harder to actually happen? So this here is, I think, a pattern. I know that he wants this to be confirmed. I think that they could have confirmed him earlier than kind of the May 15th and maybe pushed him on. We've had the DOJ show up at the Fed, as we saw. The Fed didn't let him in. And so anytime that there is a conflict between, like, you don't let my guys do what I want them to do, you don't get to dictate that, I get to dictate that. I think this is behind that. I think he's seeing some of these stories that the Federal Reserve police force didn't let his folks in, and he's going to kind of establish this as, I'm the one in charge.
From a market's perspective, it's popcorn, watch this in your free time, but it has no relevance to anything unless it starts to increase some of the pressure on Kevin Warsh, should he get confirmed, to lower rates in the face of inflation that is somewhat higher and a really resistant Fed board that has pushed back significantly. So at what point does it enter the market's frame in some sort of relevant point other than just popcorn?
Yeah, so two things I'd say. The market always tests the new Fed chair. And we're going to see kind of that in rates more than, kind of the equity markets, but obviously that spills over to the equity markets. The conversation is going to be about the Fed balance sheet. Is he going to force that to be, shrunk? Number two, I think that Scott Bessent provided Warsh with a huge amount of political cover this week, saying maybe it's not the time to cut rates. So next week in his confirmation hearing, as kind of Democratic senators are going to say, are you going to do the president's bidding, and are you going to cut rates even if inflation is higher, even in the face of this war? It's like, look, I'm going to look what the data is. There is a debate about this. Even the Treasury Secretary said maybe it's not the time just yet. So we will see. I think the market has taken out the price, kind of the cuts for this year, pushed it into next year. I think that is now the base case. Thankfully, he'll have that political cover as he's debating this in the Senate Banking Committee next week.
Ed, you mentioned the fact that U.S. prosecutors made this surprise visit to the Fed. The market doesn't seem to care about that at all. If that happened in a country like Turkey, it would be a massive deal. Why is it not a big deal here?
Because it's a continuation of a story that most have decided is not a story.
Right. Doesn't matter.
No. I mean, we are talking about a renovation of a building. Anyone who walks by or drives by have seen a construction project there that is massive for years. We recognize that there are constraints on the way in which these are built. The Federal Reserve Act kind of dictates the number of buildings that the Fed is allowed to have, which drives up these construction costs. And so to the extent that this is about monetary policy, that would be a bigger deal. But if it's over a construction project,
some marble.
Yeah, it's very expensive marble.
I'll make it super, super simple. The biggest difference between Turkey and the United States. When Erdogan says you're fired, you're fired. In the United States, when you say you're fired, you're not. We have institutions. For all those no king protests that take place in this country, there aren't any. These institutions stand up and protect the laws that we have in this country, and that's why when the president says you're fired, they're not. It's different here.
And if anything, the independence, as Ed was just talking about, is only edified given the fact that Lisa Cook is still there, even after the attempts to fire her, and that is what people have been watching. So given all of that, is this a non-story increasingly for Wall Street, given the fact that ultimately Kevin Warsh will take over and he is completely acceptable, and this is all just popcorn?
How stand around is not a non-story.
That's true.
I think that's a pretty interesting one.
Right.
That's the dimension of this that is intriguing. Ed, it's good to see you. Thank you, sir.
Likewise.
Thank you. Ed Mills there of Raymond James. Up next, Jared Cassidy of RBC. Earnings from Morgan Stanley just around the corner. Stocks just about unchanged on the S&P 500. On the Nasdaq, after a 10-day run of gains, just stalling out just a touch. We're going nowhere this morning so far on the Nasdaq 100, the longest daily winning streak going back to 2021. More bank earnings on deck. Just heard from Morgan Stanley moments ago. It's fair to say they got it done. Morgan Stanley, the pre-market, up by 1%. With the results, Danny Berger has more. Hey, Danny.
John, it is another monster quarter for another bank when it comes to equity trading. This is a huge number for Morgan Stanley. The estimate was at $4.78 billion. It comes in at $5.15 billion. Just to put it in context, they are just inches away from Goldman Sachs' equity trading business, which came in at $5.33 billion, which set a new high watermark for the entirety of Wall Street. So Morgan Stanley just behind them. When it comes to their FICC trading, also a beat, which again, Goldman Sachs was unable to do this time around. $3.36 billion is where they stand for FICC trading. The estimate was for just under $3 billion. Net interest income, that's a slight beat as well. And their investment bank, that also beating with the return of M&A in the first quarter. And then there's the crown jewel of Morgan Stanley, and that is their wealth management business. That net revenue also coming in at a beat, $8.5 billion. The estimate was for just over $8.4 billion. So clearly, there's still lots of appetite among high net worth individuals and wealth clients to invest in these volatile times. Just a few sore notes and maybe why you're not seeing shares up as much as others. Their compensation expenses were higher, $8.5 billion. That was higher than expected. The bank just noting that they had a lot of bonuses to pay out, and that led into those higher compensation expenses. The provisions for credit losses, this might get a few eyeballs. That's higher than expected, $98 million. The expectation was for $80 million. And again, their non-interest expenses, that also comes in a little bit higher. So higher credit provisions, higher expenses, but everything else, very strong beats, John.
Strong across the board. Beat, beat, beat. Said this a few times already this week across major banks. These individual trading records we've seen at Goldman, at Morgan Stanley, at Citi, JP Morgan, Bank of America, they continue. Bank of America, okay, earlier on this morning, record revenue for them in some cases over in the trading division. Morgan Stanley this morning doing better, up by 0.5% in the pre-market. Ted Pitt coming up later. Look out for this, 10:45 Eastern Time on Bloomberg TV, catching up with Bramo on a solid set of results.
Yeah, I saw these results and I thought, no wonder he wants to talk. This is a pretty incredible quarter, and it talks to the strength that we've seen pretty much across Wall Street. A key question here is how much momentum is there heading into the rest of the year? Danny was talking about credit losses, the provisions for credit losses. How much is this tied to private credit? Have we put that completely to bed? It seems like everyone's just sort of casting some cold water over that. But otherwise, I mean, what Beata Manthe was talking about, the idea that they're all trying to stay in liquid assets to keep trading and keep trading, well, that is music to the ears of Wall Street, because that trading, ongoing volumes have really supported a lot of these bank books across the board.
Stock is up by 1.2%. To extend the conversation, Jared Cassidy of RBC joins us now for more. Jared, welcome back to the program. This line from Ted Pick of Morgan Stanley: strong execution resulted in net revenue of $20.6 billion. That word, execution. Jared, what's the difference between a great environment that benefits everyone and really fantastic execution? Are you seeing one or the other?
John, thank you for having me back. And you're right, execution is critical. As you know, all of these players are major players in trading, whether it's Goldman Sachs, Citigroup, JP Morgan, and of course, Morgan Stanley and Bank of America. However, you need to be able to execute for your clients, and Morgan Stanley, particularly in equities, has over the years done a very good job. And under the leadership of Ted Pick, they're continuing with that. Now, the market conditions were wonderful for all of these players, as you pointed out, and volatility helps trading, and we saw that in spades with Morgan Stanley as well as the others.
Jared, based on your calls, and I'm just basing this on your calls, and I'm going through them bank by bank, you've got outperform ratings on JP Morgan, Bank of America, and Citi. You've got sector perform on Goldman Sachs and Morgan Stanley. The numbers from Goldman and Morgan Stanley were great this quarter, great last quarter. Is there something about the backdrop for those two names that you don't think will be as supportive in the months to come?
Not somewhat. Yeah, that's a good point. I would say that there's the volatility and the impact on the investment banking results that we're trying to assess. We also know that those names are trading at valuations that are far superior to a Bank America or a Citigroup, of course. And there's maybe better upside, we think, in owning those names rather than the pure plays on investment banking. But if one believes that the volatility will continue, that's a positive, of course, for trading. So every investor has their best pick in this capital markets business. And I can understand why some people may want to own Morgan Stanley or Goldman. We just prefer to go with the universal banks as the play.
It seems like Morgan Stanley and Goldman Sachs are frequently lumped together. That's been how it has been classically. They are rivals. Who do you think's winning between them?
That's a good question because both of them are really good in their different areas. Obviously, Goldman stands out in the advisory business. They're number one. They also are very strong in ECM. Morgan Stanley stands out in their wealth management business. One of the hallmarks of James Gorman, the former CEO of Morgan Stanley, was to move the revenues from the wealth management business from, if I recall correctly, during the financial crisis, less than 10% of total revenues to today over 50%. And that's really what's differentiated Morgan Stanley from Goldman Sachs, as well as their execution in equity trading as well.
Just curious, Gerard, we're hearing a lot from banks about potential risks going forward as they report these record hauls for the first quarter. I'm just wondering what you want to hear, what you have heard about the road ahead and the questions that remain to really assess whether this backdrop can really continue to persist.
It is a really good question because the uncertainty created by the hostilities in the Middle East is really the number one question. When will they end? When will the price of oil come down to more reasonable levels? And when we can get our arms around that with some confidence, I think that's going to really propel the banks as a group to higher levels because of the health of the U.S. economy, and also would potentially help the wealth management business as well as investment banking. That's one thing we've heard is that, the IPO calendar is still very strong, but due to this volatility, it hasn't really taken off yet, and people are very anxious to start to see that happen.
One big cloud that's hung over the banking sector has been private credit. Have we put those fears to rest, given some of the commentary and the loan loss provisions from the big banks?
I don't know if we'll ever put them to rest, but have they certainly been kind of tamped down? The answer is yes. The banks were very good at disclosing how they structured these loans into the private credit sector. We are with what Jamie Dimon has said from JP Morgan, that during a credit cycle, you will see losses in private credit. It's not going to be systemic in our opinion, which we agree with his view on that as well. But there will be losses, and there may be some spillover into the banks, but it will be manageable. The way they've structured their lending into the private credit sector gives them protection that enables them maybe not to have the losses that some people expect.
Gerard, before you go, and I know we've touched on this a few times already this year, but I think it's worth reflecting on once again. This year we could see some of the biggest IPOs ever that we've ever seen in the history of capital markets, financial markets in the US or anywhere for that matter. We just put out a story early on this morning about Anthropic being valued potentially at close to $800 billion, and maybe, who knows where we end the year, maybe north of that. Jared, that's just the IPOs. Then the M&A. We had a story out yesterday, the team here at Bloomberg, that American Airlines and United Airlines were exploring a get-together driven by Scott Kirby. Now, Jared, I don't expect you to comment on that directly, but I just wonder what on earth we're opening the door to in the back half of 26 for all this activity these banks might benefit from.
John, you said it very well. And I would say that if we could, again, have the Middle East situation in a rearview mirror, and maybe that'll never happen completely, but certainly die down from what we're seeing. With this administration, they are very supportive of consolidation, deregulation, not just in the banking industry, but in many industries. And people know that this administration effectively ends at the end of 28. So we have a 2 to 2.5 year window to get stuff done. And to your point, I think these markets are going to be very robust to have a lot of that activity take place in the second half of the year, which will benefit, of course, investors and shareholders of these companies.
How well priced do you think that story is already?
Boy, that's a tough one. It's a fair question. And I would say that it's definitely not fully priced in, but there is certainly some of it being priced in. And it's because of the uncertainty. I keep on coming back to this with the Middle East, but that is certainly what's weighing on it. Once that is removed or reduced dramatically, boy, oh boy, you could see stocks even move further to the upside.
Jared, it's good to see you. Thank you, sir. Jared Cassidy there of RBC, wrapping up the bank earnings on Wall Street. I remember a conversation that we had with Brian Moynihan under the Biden administration, where some clients were even having a conversation about putting a deal together because they didn't know what would get approved under that administration. We were talking about handbags. You mentioned that. Coach couldn't even get that deal done. It was ridiculous.
Middle luxury.
Crazy stuff. Now we're talking about the opposite end of crazy. The potential of United American Airlines getting together. That is unbelievable. And Jared's talking about a 2-year window here and companies that are going to rush to get things done that might not be able to get things done in a few years' time.
Which is why pipelines have not really shrunk considerably at a lot of these banks. That's a commentary that we've heard from a lot of the executives at the big banks, and why people are still expecting a banner year. And just as long as we can get this Iran thing resolved, that people can all get going again. And that's kind of been the story from the C-suite.
Yeah, this little thing.
This little thing.
This tiny little thing. Danny's still with us. Danny, I wanted to give you the final words. Great work, by the way, over the past few days, breaking down these results. What have we learned looking at the results from Wall Street over the past 3 months?
I think we've just learned that when it's the right type of volatility, this is the type of numbers we get. Basically, every bank we heard from on their equity trading front hit a new record, setting new records for Wall Street. That will raise questions about where we go from here. This is something that Jamie Dimon addressed yesterday on both the investor and the media call, that you can't necessarily read forward this quarter in trading specifically in quarters to come. There's plenty of still volatility out there with a war ongoing, still questions over AI, so they could repeat this. But just this morning, a report came out from S&P saying that increasingly banks' trading exposure is fragile, given just how much they are dependent on some of the high-frequency traders. What happens if that pillar starts to collapse? So yes, the numbers are good, and it is worth celebrating, and you see Morgan Stanley stock up 2%. But again, between that and M&A, the questions will be asked, can they repeat such a banner quarter again this year?
Danny, thank you. Once again, looking forward to your coverage later on this morning. Looking forward to this as well, 10:45 Eastern Time. Lisa, catching up with Ted Pick, the Morgan Stanley CEO, a little bit later this morning. What are the questions for you now, after you've seen these results for this man right there?
Well, the main question, as we were just hearing, really is the outlook for the pipeline, given what is going on with that little thing over in Iran, right? There's this idea of how much is that really torpedoing people's plans, how quickly people will get back on board, what potentially rates staying at this level does to all of these deals, considering the fact that people had been expecting rates to continue to go down. And then, honestly, one of the key questions has been acquisitions, right? I mean, Morgan Stanley has been an acquirer and a disruptor. How much are they considering exploring the backdrop that seems to be an open door?
Like Goldman Sachs.
Exactly.
You know, like, why not? I'm not starting real estate. Don't run with that.
That would be similar, though, to the United American Airlines. You know, that would be a great flex.
Crazy.
Go ahead.
Morgan Stanley, no. I'm not starting anything.
You can.
Stock's up by 2%. Let's get you an update on stories. Ask him on stories elsewhere. Your Bloomberg Brief with Yahira. Hey, Yahira.
Hi, John. Taking another look at those Morgan Stanley earnings, shares are rising 2%. The investment bank reporting equity sales and trading revenue for the first quarter well above estimates at $5.1 billion. Fixed sales also topping estimates, along with a beat on net interest income. Lisa will be sitting down with Morgan Stanley CEO Ted Pick exclusively at 10:45 a.m. this morning. The Pentagon reportedly sending thousands of additional troops into the Middle East over the coming days. According to the Washington Post, the reinforcements will include about 6,000 troops via aircraft carrier and over 4,000 Marines that are expected to arrive towards the end of the month. This coming as President Trump is suggesting the war is, quote, close to over. And President Trump warning Fed Chair Jay Powell that he will be fired should he not leave his position by May 15th. The president's adding that he has no plans on dropping the DOJ probe on Powell and the renovations on the Fed building. That's your Bloomberg Brief. John.
Yahira, thank you. Appreciate it. Up next on the program, credit concerns.
We have this entire ecosystem of private credit that has made it possible, has financed companies that probably would have struggled otherwise. We see it through the rising defaults in the private credit sector. The way this plays out is the way it always plays out. People want liquidity.
In just a moment, we'll catch up with the Schroders Capital CEO, Georg Vanderlyn. He joins us next, live from New York City. You're watching Bloomberg TV. Live from New York City, welcome back to the program. Your scores look like this. Equity futures on the S&P 500 just about unchanged, following a really fantastic run on the S&P, up off the lows by close to 10% and very, very close to all-time highs. Just think about that. We've shut down the Strait of Hormuz, hardly any traffic coming through, and yet we're this far away from record highs on the S&P 500.
Yeah, and everyone's just trying to get past this so that they can look at earnings and talk about all the underlying momentum. My big takeaway, one, you could say complacency, et cetera. The second one is that the U.S. economy in particular was poised for an outperformance in economic growth that was so much greater than what people expected that this takes that edge off. So you're still seeing gains, even though they might not be as much as they previously might have been thought to be.
And based on reports so far this morning, it looks like the U.S. and Iran close to extending a truce. The ceasefire set to expire in the next week or so. The report from the AP came about an hour ago.
So it looks like potentially we're going to have this extend past April 22nd. Although if you look at what one of the officials said to the AP, they want 3 things hit by April 22nd. Iran's nuclear program, something on reparations, and the reopening of the Strait of Hormuz. While that is signaling the top line, they want to extend the ceasefire, there's other headlines coming out with Iran saying if one side violates a deal, the other party can too. And Tehran views the U.S. blockade as a violation of the ceasefire deal.
Things are still very, very fragile. They're not at the banks right now. Let's put it that way. Morgan Stanley in the pre-market higher by 2.5%. Earnings a little bit earlier on this morning, and those earnings were better than good.
Beats across the board. Their equities trading revenue, $5.15 billion versus the estimate of $4.78 billion. The opening line of Ted Pick's commentary heading this particular earnings season is Morgan Stanley reported a record quarter. Mic drop. And that is what you're seeing right now in markets.
And some commentary on private markets, private credit from basically all of these players over the last few days. The Bank of America CFO, I believe, on the call right now, talking about the firm not changing their private credit strategy and haven't seen any losses in the private credit portfolio.
There's been huge pushback from all of the executives at big banks saying, look, there are going to be some problem children. We do see some potential lending behavior that isn't exactly wonderful. At the same time, this is not systemic, and we plan to plow ahead. And that has been a theme from big banks.
Under surveillance this morning, credit concerns.
There are a number of operators out there that probably should have gone under even back in 2020 that are still around. And today we have this entire ecosystem of private credit that has made it possible, has financed companies that probably would have struggled otherwise. We see that through the bad pick activity. We see it through the rising defaults in the private credit sector. The way this plays out is the way it always plays out. People want liquidity.
So here's the latest this morning. Wall Street banks reporting at least $100 billion of exposure to private credit firms as investors question the durability of the sector. Georg Vanderlyn, the CEO of Schroders Capital, writing weaker players are being exposed while stronger disciplined investors stand out. Georg joins us now for more. Georg, welcome to the program. And welcome to New York. It's good to see you, sir.
Thank you. Thank you for having me.
Can you help us understand the difference between a liquidity-driven repricing and a structural credit event? Just explain to us one versus the other and what you think this is.
Very happy to, and it probably links nicely to some of the comments made earlier and other executives in the industry. Effectively, what the market isn't really differentiating right now is liquidity stress in semi-liquid vehicles, so linked to structures ultimately in funds, versus impairments of underlying assets. So what we have is liquidity stress in essentially retail orientated structures, so funds that have been sold to retail investors. In some cases where probably these investors haven't fully understood what they're investing in. In some cases maybe compounded by the fact that there is software exposure and the market is trying to price software and revalue ultimately software in the light of upcoming anticipated software disruption. Note, it hasn't happened yet. And essentially the real distress or impairment of underlying assets which isn't happening. And so that effectively is the difference between the two.
What does it mean for you and the team and the dislocations you've seen so far and the money that you're looking to put to work?
So, I mean, for us, just first of all, to note, we're not a direct lender. We are focusing on sectors which we think is the sort of the boring, sexy part of the new, the boring part of the market, i.e. sort of lending against infrastructure assets, lending against real estate assets, lending against, on an asset-backed basis, for example, against hard assets, where we have better collateral, which is less cyclically exposed. And I think to us, that is a key opportunity also going forward for investors to build more resilience into their portfolios by embracing this next to the exposures they have in direct lending.
At a time of rapid change, a dislocation, the idea of AI and what that could potentially do in transforming business, is there an advantage to being illiquid versus liquid with respect to your asset allocation?
I think it's, like broadly speaking, this gets to the advantages of private markets generally speaking. I think you want to be both, really. I think there is no way an investor can only be liquid or only be liquid. I mean, effectively, private markets roughly capture probably 80% of the economy, depending on how you count it. I mean, in terms of businesses in the United States, it's probably 99% of businesses are not listed. 80% of the workforce is working for non-listed companies. I mean, it's a bit hard to gauge, really. But it's such a big part of the economy. A lot of the innovation economy is actually happening in the unlisted space. A lot of effectively real assets, infrastructure, real estate is not really suitable for listings. And then there's obviously also bigger listed companies. And so in any portfolio, there will have to be both.
Do you think that illiquid assets need to have a higher bar for transparency, given that one of the big concerns is that a number of lenders are mismarking their books or marking aggressively and optimistically just how high some of the valuations could be?
I think the issue is much more how you deal with this in the context of semi-liquid structures or liquid structures where you can trade in and out of illiquid assets rather than effectively the time lag in valuations and the approach to valuations in illiquids in general. So you don't have a problem in illiquid funds ultimately, or in CLOs, even in the private credit space, really, where there is no trading in and out. So essentially the daily volatility and themes which are played through the stock market, like should valuations for software companies be lower now because there will be disruption in the future, even though earnings are still very much unchanged and very much in a good territory, isn't something that a private market fund would reflect on a daily basis. However, if you have investors that can trade in and out, either daily or on a quarterly basis, you all of a sudden have that issue translating into these types of structures. And I guess this is where ultimately the issue arises. And for me, the question is ultimately whether then investors fully understand what they've bought into, and the fact that the underlying asset is ultimately illiquid, and there are mechanisms that prevent single investors from trading out, from trading out. And contagion to spread to a broader group of investors just because of sentiment.
Clearly things haven't gone right for the industry over the last few months. With the minute we have left, what should the lessons be of the last few months for the industry?
So I guess, I mean, to say it maybe slightly provocatively, growing too quickly in certain areas, essentially, and selling too much of one thing, maybe with slightly too little diversification, too much sector exposure in certain areas, maybe also a degree of lack of discipline in terms of underwriting in the 2020s, pre the change in the rate environment, is something that has to feed through the system. Per se, that's not an issue, and it's also not leading to credit losses, to just say this again, and it's also not leading to losses in private equity, but probably a series of vintages that will have slightly lower performance.
Georg, thanks for making time for us this morning, and enjoy your time in New York. Georg Vanderlyn there of Schroders Capital. Up next on the programme, we'll catch up with Phil Camporelli of JP Morgan Asset Management, Max Layton of Citi, Pooja Sriram of Barclays, and Brent Shuley of Northwestern Mutual. The third hour of Bloomberg Surveillance up next.
The earnings story still looks very much on track.
You have a situation where the fundamentals actually got stronger.
There is still a lot of uncertainty out there.
This uncertainty can pass. I still think there's a very good road ahead.
The bull market that started in October of 2022 has further to go.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, this far away from all-time highs on the S&P 500. Adding to the rally, just about close to 0.1% higher on the S&P and just about unchanged on the Nasdaq following a 10-day run of gains. In the commodity market this morning, Brent and WTI fairly well behaved. Brent crude at about 95, WTI around 91, a fifth straight consecutive close below $100 a barrel at the front end of the futures curve in yesterday's session. That's set to continue based on these moves and based on the reports so far that the US and Iran is close to extending a truce.
Yeah, and this really has been what's been the ballast behind the market performance so far, is that you haven't seen an escalation, that talks have been ongoing. Yes, the Islamabad talks did break down with no agreement, but further talks are going to be held at some point. That's the reporting. So at this point, is not worse news good enough to keep this rally going, given the fact that we're getting earnings that are incredibly strong from U.S. companies?
And the president is signaling that, at least at this moment, Tehran has some distance right now from Beijing. In a Truth Social post, he said China's very happy that he's permanently opening the Strait of Hormuz. There's actually a blockade right now in the Strait of Hormuz, but maybe potentially down the road, the president is looking for a real opening of the Strait of Hormuz. And then this, they have not agreed to send weapons to Iran. This is obviously Iran's biggest backer because they buy the lion's share of their oil. And what he's saying is Beijing is maybe taking a step back. We will see. And the president will be obviously going to Beijing in May.
It's funny just to track how people's views on all of this has changed. At the start of March, if it goes on a few weeks, it'll be okay, just so long as it doesn't go into April. And now we're talking about the prospect of extending a truce without any real clarity on what that means for the Strait of Hormuz. And we could be talking about the strait still being closed by the time we get to May.
There's not really a clear pathway to get the strait reopened. That's the problem right now. And what you hear on the peripheries is that Iran rejected the UN proposal to open the strait to all commercial traffic without a toll. Remember the toll booth that's been set up? I mean, again, people are saying, yeah, stop it with the geopolitical noise. I just want to get back to my earnings. And right now, markets seem to be focused on that, even though you could come up with a pretty gloomy and doomy story about what's going on in the Middle East. And it's really not that far of a stretch. Talk to any commodity analysts, there they are.
No gloom in the bank earnings whatsoever so far this morning from Bank of America and Morgan Stanley. More trading records. Morgan Stanley in the pre-market higher by close to 3%. Bank of America up another 1 percentage point. Later on this morning, 10:45 Eastern Time, Bramo catching up with Ted Pick, the Morgan Stanley CEO, following some fantastic results earlier this morning.
The key issue is just how much is this potentially threatened by what's going on in the Middle East versus a big pipeline of deals that are slated to get done that a lot of banks have talked about. We talk about how the regulatory environment is more wide open for some of these tie-ups and how much capital markets can continue to boom to the extent that they did in the first quarter, even with some of the noise that people keep talking about in the background.
If United and American Airlines can get a deal done, anyone can.
Okay, go ahead. You're not spreading this rumor.
Imagine the pitches.
Okay, honestly, listen.
Think of the banks right now.
This is John this morning.
The pitches they're coming up with.
Okay, this is John this morning. I'm not
Chevron.
saying it, but what if Morgan Stanley were to buy Goldman Sachs? If, United...
I'm sorry,
and American...
but if United can buy American Airlines, anyone can buy anyone.
All right, I'll ask him. I'll ask Ted. I'll say that John has a question for you.
Ask him about the United American Airlines deal and the potential of getting that done and what that could mean for other sectors, other industries, and the kind of deals that have to rethink the possibilities around.
Alphabet and Microsoft?
Chevron, Exxon?
Who knows?
You know,
sky's the limit.
Crazy talk. Think outside. Anyway.
Coach and Michael Kors, never mind.
No, that's not allowed.
Let's move on.
Don't touch the handbags.
I won't.
Don't upset Biden. Hey? Bad news, that.
Okay, sorry.
Entry-level handbags.
I'm sorry.
Antitrust concerns.
All right, I'm leaving.
From one crazy to another. It's crazy. All right. Coming up on the programme, Phil Camporetti of JP Morgan with stocks trading near all-time highs. Max Layton of Citi on reports the US and Iran are close to extending their truce. And Pooja Sriram of Barclays as President Donald Trump ramps up the pressure on Fed Chair Jake Powell. We begin this hour with stocks hovering around fresh record highs. Phil Camporetti of JP Morgan Asset Management writing, the US in 26 is the most prepared to deal with a spike in oil prices than at any point in recent history. While we have reduced non-US equity, we have not adjusted our overweight to US equities. Phil joins us now for more. Phil, good morning.
Good morning.
Is this the return of US leadership?
So US exceptionalism is not going away, right? However, I think that the US is a clear winner here when it comes to the spike in oil prices, as I wrote. So let's kind of break this down a little bit. Obviously, 5 years ago, we went from an energy importer to an energy exporter. So lo and behold, we had our equity person talk to us earlier this week, and they've upped their earnings forecast from about 15% to 19% this year. Why? Because these energy companies are going to have a heck of a lot of earnings this quarter. Secondly, the One Big Beautiful Bill Act is coming at a one big beautiful time. Okay, so the estimate here is that gas prices would have to average $4.50 for the entire year just to break even with the fiscal policy that is being delivered in 2026 through the Big Beautiful Bill Act. And as we all know, tax refunds are hitting today. April 15th, happy tax day. 3 things that you can count on: death taxes in the 60-40.
Shots fired.
Which I want to get to. And then, like, forward-looking, I know that inflation expectations in the near term obviously are rising, particularly headline inflation that includes energy prices. But if you look further into the future, whether you look at the December 26 oil contract that's trading in the 70s, or if you're looking at five-year forward inflation expectations, which is something that the Fed loves to look at, those things really aren't moving, John. So, you add this all up, and the top 20% of earners, that basically determines success or failure for this economy. They care about every Thursday at 8:30 in the morning, which is initial jobless claims. Right. They don't really care about gas, energy, and oil prices. They only spend about 2.5% of their income on those things. So I think they're a little bit more insulated, and they're doing fine.
And claims have been super low. With regards to the war in Iran, there was a report earlier on this morning from AP that suggested the US and Iran was close in principle to agreeing an extension of the truce. This came from Axios just moments ago, that the US has not agreed to an extension of the ceasefire. That from Axios just moments ago. The US and Iran will continue to engage to reach a deal.
So it sounds like, from the United States point, they want to keep talking, but they have not agreed to extend that April 22nd deadline. Maybe this will change, but right now it seems that the United States still wants to really squeeze and put the pressure on Iran to come to the table and almost capitulate before April 22nd.
We'll have our own fight around this table now and talk about something completely different. Do you want to take it away? 60-40.
Well, it's related. I'll tie it together. And it's this idea of, at a time when the commodity shock is the significant potential shock, does 60-40 work? You are going to die on this hill. Yeah. I just wonder if you see right now an ongoing correlation, positive correlation between stocks and bonds, because the potential risk factor is inflation. How can you say this is still going to work?
Yeah, so Lisa, I did think of you when the 60-40 was hurting my feelings in March. As stocks were going down and bonds were going down. But I thought it was something really important. Once we priced out the Federal Reserve from all of their easing this year, the 2-year note stopped going up in rate, right? So I think there was a limit to that. Oil prices went up, had to price out that. I don't think the Federal Reserve should be easing policy over the next 6 months anyway. Every single one of their meetings is a cost-benefit analysis. Does the benefit of a hike, a cut, or staying on hold outweigh the cost of potential policy error? They shouldn't be easing. But the 10-year note's at 4.25 right now. We were at 4.1 in September of last year. Like, the MOVE index is really our guiding light, because I think that kind of controls everything. The MOVE index controls whether the 40 will protect the 60, and I think at this point we think it will, because we don't see tightening. Once you price out the easing, now you can start to get the benefit of diversification. But you had to go through those painful couple of weeks to get there. And then what the MOVE index, which is rate volatility, also does is it allows you to go buy equities. As I wrote, we never reduced our U.S. equity allocation. We still have an above-trend GDP forecast this year, even if oil prices average $88 for the whole year.
This is the contradiction, and we've talked about it a lot on this show, that if you expect growth to outperform, and you expect commodity prices to inherently be higher going forward than they would have otherwise been because of blockages and questions about the freedom of navigation on the seas, then why wouldn't the stronger growth be inflationary, given the fact that we're already at a higher than target inflation for the past more than 5 years?
Because it's not showing up on, I would say, kind of the supply side. So if you look at wages, if you look at shelter, right, the stuff that really drove up inflation in years like 2022, you're only seeing it on the commodity side. And I think it's okay for service sector to be sticky here, Lisa, because I think what that's saying is that you have a strong consumer. Right? So it's all kind of circular into a positive earnings growth story and an above-trend GDP growth story, along with the fact that you, again, have this One Big Beautiful Bill Act that's providing. Now, the Fed shouldn't be cutting rates. That's not in our forecast. And I think it's not in our forecast because we do have inflation probably closer to 3% than 2% for the remainder of the year. But to make these links back to 2022, which gives asset allocators like me a whole ton of PTSD, right? I don't want that. you have to then add in the other parts of inflation, the shelter. The owner's equivalent rent was a huge driver there, and we're not at that level right now.
I think the greatest counterpoint is just the lack of labour wage growth right now. This labour market's not as tight as it was back in 22. I'm not saying it's super loose either, around 4.5% unemployment, 4 to 4.5 at the moment, but you're not seeing the wage growth that would make most people worried about an inflationary spiral from here.
I love this. And that was March, I think John's right, but March of 2022, that wage price spiral risk was so prevalent, which is why the Federal Reserve eventually had to hike by 75 bips a meeting, 4 meetings in a row. And then just the other piece on equities, which I think is important. There's $22.7 trillion right now sitting in checking accounts, savings accounts, and money market funds. You know what that's yielding right now? Even at Chase, but you didn't hear it from me. It's yielding 52 basis points.
Yeah.
Like, investors are stuck in ZIRP, but these banks, right, can then charge a 6.5% mortgage rate. I mean, that's amazing.
I love it. I'm the embodiment of PTSD from 2022. That's great. When they want to think of something, they think of my face. All I can say is, it's a good pitch.
Yeah,
I like
you look
it.
like wrong way correlation. That's right, exactly.
That's brutal. Stock's down 10% and people think of Bramo. Is that how this works, Lisa?
I think that's great. That'll be my Halloween costume.
Phil, you're a good
2022.
sport. Appreciate your time as always,
Good
buddy.
to see you all.
Thanks for being here. Thank
you.
you. Phil Camprodi there of JP Morgan Asset Management. Let's give you an update on news worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We're seeing shares of Bank of America rising 0.8% after reporting first quarter earnings that beat estimates. The bank reporting record equity sales and trading revenue. CEO Brian Moynihan saying the results indicates a resilient American economy. Morgan Stanley also moving higher, up 2.7%. The investment bank reporting a record first quarter with equity sales and trading revenue well above estimates. Lisa will be sitting down for an exclusive interview with Morgan Stanley CEO Ted Pick at 10:45 a.m. this morning. And New Jersey Transit is considering charging World Cup fans over $100 for round-trip train tickets between New York's Penn Station and MetLife Stadium. It's a pretty short ride. New York Governor Kathy Hochul called the fare awfully high. That's your Bloomberg brief. John?
Yahara, thank you. I'm trying to work out if I should save you from this or not, but
Ridiculous. I think the answer is no.
We're going to have
Goodbye.
months of this conversation. I'm so disappointed with how this has been handled in this country over the last year or so. I'm so bullish this game in this country, and you see youth teams all around the Northeast taking up football, soccer, and I think that's absolutely fantastic. When we had the World Cup in the US in '94, it wasn't the right time. This was the right time. It was a massive opportunity for this sport. All the kids should have had fantastic access to get into the stadiums to watch these games for next to nothing. And the idea that we're talking about $100 just to get a rail ticket, that is so sad. I think it's really sad the way this has been handled.
And then you add on top of that the cost of the actual tickets. I mean, this is the reason why, on one hand, this is what America does best, right? Everyone has their hand out if they can profit, if the demand is greater than the supply. At the same time, it's not really going to get my kids to the game because I ain't paying that.
Right?
And Italy didn't even make it, John.
Oh, Phil, what are you doing?
Oh, no. Now you're...
What are you doing?
He's
now
tweak us all.
Shots fired.
How dare you, with that last name as well.
I'm half Irish.
Up next, we're not doing that. The morning calls, plus Max Layton of Citi with oil rising on mixed messaging out of the Middle East. That conversation and not football from New York City this morning. Good morning.
In terms of the stocks, there was a window to buy a couple of these maybe at the beginning of the war, and we upgraded a handful of the regional banks during that period of time, but we still think that the risk-reward trade-off is better in some of these regional banks. JPM and B of A probably had the best quarters. The stocks came in relatively hot. We have erased all of the war fear and losses going into earnings.
That was David George of Baird weighing in on the bank earnings this morning. We heard from Morgan Stanley and from Bank of America. Those numbers better than good. Equity futures just about unchanged on the S&P 500 following a stellar rally in this equity market. We've heard repeatedly from the banks on Wall Street, this consumer and this economy is resilient. We heard that from Brian Moynihan at Bank of America. From Jamie Dimon, consumers are still earning and they're still spending. From Wells Fargo, spending has been very resilient through the last month. We've heard it repeatedly over the last week.
And they go on to say that just because oil prices are high doesn't mean that they're going to stop spending, because ultimately, as Jamie Dimon came out and said, it really depends on the labor market. And the labor market is strong. Until you see unemployment really creep higher, you're going to see this ongoing resilience that can continue to power the U.S. economy.
Futures just about unchanged on the S&P. That's the price action. Let's get you some morning calls. First up, Piper Sandler lowering its price target on Wells Fargo, the firm cutting its EPS estimate for this year and for next. Your second call from Barclays raising its price target on Citi, saying earnings are proof of a strong start to the year. And finally, Goldman lowering its price target on JP Morgan, noting increased competition and market volatility. That name is up in the pre-market by 0.4%. That's the bank earnings. Let's turn to energy. Crude rising as Iran pushes back on the US blockade of Hormuz, warning if it continues it will violate the terms of the ceasefire. Max Layton of Citi writing, in a scenario of lasting disruption of the strait without major escalation, we could see oil prices relatively stable at higher levels with lower realized volatility. Max joins us now for more. Max, welcome back to the show, sir, and thanks for making time for us. I know you're looking at a range of scenarios. I believe there's three. So could you detail the three and just tell me which one you think is most likely and why?
Sure. Yeah, so I think because this problem is so big, the baseline view that we've taken, that I think the equity markets certainly seems to be taken, is that this is so big it has to be solved, either militarily or diplomatically. And we had kind of penciled in around now and over the next couple of weeks, so second half of April, as a time where that was our baseline view, that's when it's going to happen. And look, it's still possible. Still possible. We put a 50% indicative probability on that scenario. In that scenario, we still think the baseline view that we still think it gets worse before it gets better. The two sides, or at least on nuclear, are pretty far apart. And, there's also talk about Iran saying how much, I've seen numbers out there of up to $270 billion of damages that they want. And look, they want kind of reparations for. So I would say that things look pretty far apart. A lot can happen within a couple of weeks. I mean, a couple of weeks is a very long time. But in any case, we see the price kind of grinding up over the next couple of weeks to $120 is our 0 to 3 month point price target. That's a central scenario. And then it getting resolved diplomatically, most likely. But, we also put a 30%, we're certainly not out of the woods, I would say. We put a 30% probability on the bull case scenario for oil, which is that this drags on for quite a bit longer, or that it involves mutual energy infrastructure destruction. And I actually think that mutual energy infrastructure destruction is much less likely now. I think the bull case is really about the Strait of Hormuz flows being disrupted for, let's say, for example, if they were disrupted to the similar magnitude to what we're seeing today for the next 10 weeks, then oil and product inventories would fall to their lowest levels in over 25 years of data that we have, and most likely to the lowest levels in terms of days of consumption since the 70s. So, with that, you would see in this bull scenario, Brent up at 150, product premiums at 50, and all-in prices at $200 plus. So we're 10 weeks away from that, and it's entirely plausible that happens. And then the bear case scenario. Yeah, the bear case is just really quick. It's just super, super quick resolution. That you get a reopening of the strait almost immediately.
Isn't the market kind of pricing that in right now? Even though Iran is talking about retaliation, the market is weighing more heavily on the fact that it looks like they want an off-ramp between these two sides.
Yeah, I think in many ways. I mean, look, even the back end of oil at $80 odd, 12 months forward is, it's telling you that, it's telling you, A, that the market's super tight right now with spot trading at 130 to 150, depending on the oil, the crude barrel you're looking at. But it also does tell you that the market, at least in oil and probably also in equities, that it is assuming that this is solved pretty quickly.
What does solved mean, Max, given the fact that we're hearing a ceasefire, but it's unlikely, as pretty much every analyst says, that the Strait of Hormuz will actually reopen to the degree that it was before the conflict?
Yeah, I think solved is, it is a path to returning those flows. Probably it will be some kind of phased trust building return of flows in that baseline view. But look, there is that entirely plausible other scenario that I think arguably the market is complacent about, is that this drags on for a lot longer, and or that the conflict restarts in a couple of weeks' time.
Are you sick of thinking about this? And I ask this because I think that the rest of the market is. I mean, I think that really that's part of the issue, is that people are exhausted by the headline roulette, and so they're just discounting it altogether and moving on. I mean, is that sort of your sentiment too?
Yeah, I mean, look, it has been exhausting. I'm spending half a day on X and on Bloomberg trying to figure out what's going on. But yeah, I think people in general are kind of hoping for the best and getting on with their daily lives. And, I have been, and I think that's reflected in our base case scenario. But, wow, it's I think when I look at the risk skew, I think it's entirely plausible that this regime, that the ceasefire works for them in the sense that if they can just hold out for, let's say, 10 weeks in that scenario, you're going to drive oil inventories down to the lowest level in decades, and you're going to drive up the oil price, and you're going to be able to probably maximize your ability to extract something from the negotiations.
Max, can I just finish on this question? And it's an important one, I think, in the 45 seconds we have left with you. There's a lot of people in other asset classes taking comfort from how the futures curve is positioned, how it looks, the deep backwardation, that prices looking out further in the future are a lot lower. They look at that almost as an implied market forecast. Do you see it the same way as a commodity expert? Do you look at the curve and see that as a market bet, or does it reflect something else?
Oh, wow. This is a big debate. And in my career in commodities, I've worked with different PhDs who have different views on it. I think your traditional commodity expert would say the forward price 12 months forward, 12 months forward is not a forecast. It reflects the convenience yield and the tightness today. So the fact we're trading at 150 reflects the tightness today, and the backwardation is not a forecast. But, everybody also knows that, just logic tells you that the market is trading at that price. And if it was so far from people's expectations, then it wouldn't be trading there 12 months forward. Yeah. So I think the further out on the curve you go, the more it becomes, the less tied to the front and to the tightness it is, and the more it is an expected value. There's a big debate in the literature about whether that's 12 months out or 5 years out, depending on who you work with, yeah.
We'll get into the books another time. Max, it's good to see you. Thank you, sir. Appreciate your time. Max Layton there of Citi. Up next, Pooja Sriram of Barclays, as President Donald Trump is ramping up the pressure once again on Fed Chair Jay Powell. Live from New York City this morning. Good morning. You're watching Bloomberg TV. Only one down day so far this month on the S&P 500, and it was tiny. It's like this small. Equity futures just about unchanged on the S&P, following a fantastic run on the S&P 500. Energy stocks on the S&P so far this month, down 9%. The Nasdaq so far this month, up 9%. The Nasdaq 100 on a 10-day winning run, the longest since November 2021.
All you can really count on in this moment, where even Max Layton is saying, I don't know what's going to happen, we're all sick of talking about what's going on in Iran, and yet we're just sort of headline chasing, is that people keep investing in tech. And tech keeps outperforming. And ASML actually upgraded their forecast. So for all of the noise elsewhere, that is one constant and is viewed as an existential threat, which is the reason why people are piling in. This is the new haven.
Semi's up by more than 20%, I think.
Bonkers.
This month. The Kospi is up by something like 20%, I think, this month.
When you take a look at the 10-day gain, going back for the stocks, for the semiconductor index, it is the biggest 10-day gain going back to 2002. That gives you a sense of just how much of a rip it has been.
Absolute rip. Super impressive rally. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We're wrapping up bank earnings with more of the same, a trading bonanza on Wall Street. We start with Bank of America, shares up 1%. Traders there pulled in the unit's highest revenue in more than a decade, and Morgan Stanley right there with it. Shares are up 2.6%. Equity trading jumping 25% to a record of more than $5 billion. So to sum it up, volatility fueled activity across Wall Street, turning into a windfall for these banks. Turning to another name in the green, and that is Snap. Shares are up 6.4% in the pre-market. The social media company announcing it's cutting 16% of its workforce as it tries to achieve profitability. And notably, CEO Evan Spiegel pointing to AI as one of the reasons the company is able to do more with less people. So that's what investors are reacting to, the idea that AI can drive efficiency. And we are also seeing shares of Broadcom rising nearly 2% in the pre-market after expanding its partnership with Meta to build custom AI chips. This is part of a multi-billion-dollar push to build out more than a gigawatt of computing power. John.
Yahira, thank you. Thank you for that. Broadcom with a fantastic run as well. Let's turn back to the Federal Reserve. President Donald Trump saying he'll fire Chair Jay Powell if he doesn't leave his position on time. Mike McKee has more on that. Good morning, Mike.
Good morning, John. Another threat from the president. But before we get to the Fed, I just want to mention that we did get some economic data that will make the markets happy again today. Import prices rose 0.8% in March. The forecast was for a 2.3% rise. So like PPI yesterday, better news. And almost all of that was oil prices, ex-petroleum. Import prices were up just 0.1%. Empire manufacturing, also big jump up to 11 from minus 0.2. So some good news on the economy this morning, and it might keep the Fed sidelined. Whether the president can sideline Jay Powell or not is another question. He, once again, speaking with Maria Bartiromo, said that if Powell doesn't leave on time, he would have to fire him. But that's not up to him. That's up to the Supreme Court. The Lisa Cook case still hanging out there. We hope to get a decision sometime soon on whether the president can fire somebody on the Federal Reserve Board without specific cause. So that's kind of off the table until we do. There are legal questions about what happens if Powell's term ends as chair of the Board of Governors, and that might be fought out in the courts. But he would stay on as FOMC chair, the interest rate setting panel, because they've already decided that he would do that, and that's not subject to the president's decisions. Of course, we get Kevin Warsh's confirmation hearing next week after he finally got his paperwork in. Part of the reason for the delay is he's got a lot of money and he had a very complicated financial disclosure form. But there's no vote scheduled yet because Senator Thom Tillis is still holding out, saying the probe has to end before the Justice Department probe has to end before he would vote in favor of Kevin Warsh. And we heard just last night that the Justice Department showed up at the Federal Reserve and tried to go into the buildings to do an exploration, and the Fed's lawyers told him, no, you can't do that. You have to have a subpoena, and the subpoena was quashed by the judge. So the battle on that still goes on. There will be some interesting questions for Powell, for Kevin Warsh next week, of course. The biggest one is he going to work for Donald Trump, or is he going to work for the Fed? In other words, is his priority cutting interest rates over everything else? And if he's going to wait and see what the data tell him, when would rate cuts be appropriate? He wants to change the Fed's balance sheet, so I'm sure there'll be questions on that. And then, of course, his own $190 million plus balance sheet, and that only is his money. His wife is a billionaire, so there is quite a bit of questions about whether that will influence any of his decisions. So it's going to be a big week next week, and we're still waiting on the Lisa Cook case to see where that takes us.
And Mike, just what are you implying? Just that last line. That last line, what are you implying? That somehow he would set policy to benefit himself because he has $200 million?
Well, it's not so much that. It's that policy could inadvertently help him or his wife because the holdings are so vast. Now, he has said, as part of his disclosure, that he will recuse himself from anything that could possibly affect his portfolio, which he would, for the most part, sell off, but affect the Estee Lauder companies, which is where his wife gets her money from. So it's a question about, how do you manage something that is so big in your own portfolio and stay out of trouble?
Interesting. Mike, thank you. Thanks for breaking that down. Appreciate it, as always. Fair to say he married well, right?
Yes, exactly.
Kevin Walsh doing okay.
As Mike's talking, and it's like his paperwork was so delayed because he has so much money, because he married well.
I don't think that's a man who needs to work for anyone, right? Never mind the president.
Well, and this is the reason why I think some people would say, okay, he's fine. He's going to be the Fed chair and he'll be relatively independent. I feel like this is sort of a normal pathway. You get enough to be independently wealthy before you take the salary of a Fed chair.
Chairman Powell also independently wealthy.
I mean, pretty much that's a nice pathway.
Yes.
My son said to me the other day, he's like, what about me? And I'm like, yeah, go to.
Oh, he wants to be the Fed chair?
I think more Treasury Secretary.
Oh, right. He's got big plans.
I was like, yeah, good luck to you.
I've met him.
Maybe just graduate from high school first.
I imagine that's possible for him.
All right, well,
who knows?
Please, I hope he's not listening.
All right.
Please don't inflate your ego.
I imagine he is. So you go for it. You go for it. Pooja Sriram of Barclays writing this. We think there is likely enough support in the Senate for Walsh's nomination to proceed. The path for a timely confirmation, however, seems narrow. Pooja joins us now for more. Pooja, good morning. Good to see you.
Good morning.
Let's get into this. So we've had all these attacks on the Federal Reserve. Have you seen any real credible effect on the operational autonomy of the Federal Reserve that's really harmed them, actually taken place? Never mind the risk of it happening. Have you actually seen it happening?
Not at all. I think so far it just seems that this is background noise, unnecessary noise that Chairman Powell is having to deal with. But we listen to the FOMC members closely. We read the minutes. It doesn't seem to have affected how they're functioning. I think what this does is this constant attack, and like we said that the path for Walsh's nomination was already quite narrow in the first place, and then you have this attack, and as Michael McKee just pointed out, it sort of creates a potential roadblock for that happening in time, and so it's political, no doubt, and it could get messy.
Has it changed how you think about leadership at the Federal Reserve and what a Chairman Powell Fed looks like compared to a Chairman Kevin Walsh Fed?
Well, yeah, I mean, we do know, how Walsh thinks in terms of, he's more hawkish on the balance sheet, but there is an inclination for him to cut rates. So, he is perhaps, one more dovish member to come on board. But we've always held the view that, irrespective of who's Fed chair, one person cannot entirely influence monetary policy. And so I think that the big job of a Fed chair is to build consensus, and you need to have credibility to do that.
One of the most amazing aspects of all of this, whether it's Fed independence, whether it's a commodity shock, whether it's the fact that inflation has not been at the 2% target or below the 2% target for more than 5 years, is that inflation expectations are incredibly anchored. They are. If you take a look at five-year break-even rates, they've creeped higher to 2.2%. Oh, horror. Like this question of what are we looking at right now? Do you think that this is stable and that this is faith in the Fed, or do you think that this is just simply complacency?
No, I think this, to a large extent, reflects Fed credibility. And, forget the markets. You look at consumer surveys, right? And you think about the average consumer and what inflation expectations they're pricing in. We're not seeing the longer run expectations move up there either. So I think so far there seems to be a belief that this energy price shock is going to be, to use that word, transitory. And then, hopefully things pass over. But I think the longer this continues is when consumers, the average consumer, starts getting worried.
To preserve the Fed's credibility, do they have to move to more of a range, a 2 to 3% inflation range, rather than the 2% target that they haven't met in more than half a decade?
No, I think they're going to be extremely hesitant to make any changes on that front. I think the idea would be for them to perhaps, keep rates more restrictive if they're seeing signs of inflation, remaining sticky or elevated. One thing that sort of worked in favor of their current policy stance is, like you said, inflation expectations. The other thing is, sure, I mean, you look at the annual numbers, they're elevated, but you look at the monthly prints. I mean, core CPI has been surprising, to the downside for, I want to say at least 10 out of the last 11 months. And so those outcomes are something that they will likely sort of take signal from. The other thing I would say is, You know, if you sort of break down inflation into core goods and shelter, and then the core services ex shelter, the sort of framework the Fed likes to follow, core goods surely has moved up in 2025. You can say that's a tariff story. And, you know, by our estimates, we think that's about to wind down. You know, much of the tariff pass-through has come through, and we don't expect any incremental inflation on that front. Shelter is, in fact, in disinflation. It's a good, you know, chunky part of CPI, so that's, you know, doing a lot of the heavy lifting. And then core services ex shelter, you know, a bit sticky, but it's still sort of moving in the right direction. So, you know, if you're the Fed and you're watching that, you could be hopeful that things are moving in the right direction.
Under Kevin Warsh, do you think there could be a real conversation about changing how they target inflation, maybe to target a range instead? Because this is something the Treasury Secretary has spoken about prior.
Yeah, I mean, we don't have a view on what, you know, whether he intends to do that, whether he, you know, can do it so quickly. I think when he comes in as Fed chair, I think it's likely to be status quo initially before he can sort of build consensus, get more people on board. We think that the thing that he might want to do first is something on the balance sheet front rather than, you know, we've been asked about Fed communications. We don't think that that's on his priority list.
Get rid of the dots. You know, get rid of the dot plot. I think people have been talking about that for ages, haven't they? Why not just take the opportunity? Just dump the thing.
You know, that would be sad for me. Because I remember
you want to keep them?
Because when the dots came out, I remember the newsroom had dot cupcakes. And people would come out with different cupcakes with different dots in different places.
I find that sad.
Yeah.
I'll
get you a cupcake.
I think it's lovely. I think it's really sweet.
Cakes,
they were blue dots.
That the only time anyone brought in cakes. We'll talk about this another time, all right?
On the couch.
Have a little session.
Exactly.
All right, Pooja, good to see you. Thank you. Pooja Sriram there of Barclays. Let's give you an update on stories elsewhere. That's sad. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Mediators between the U.S. and Iran are moving closer to extending the ongoing ceasefire before it expires next week. The AP reporting Washington and Tehran had given a, quote, in principle agreement to extend the truce, allowing for more diplomacy. President Donald Trump warning Fed Chair Jay Powell that he will be fired should he not leave his position by May 15th. The president adding that he has no plans on dropping the DOJ probe on Powell and the renovations on the Fed building. And Starbucks and OpenAI are teaming up. The coffee giant launching a new beta app in ChatGPT today. Customers can type at Starbucks in ChatGPT to discover and customize their drink before finishing checkout on the company's app or website, or just go in store. That's your Bloomberg Brief, John.
It would be easier. Yahara, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Brent Schutte of Northwestern Mutual Wealth Management, with stocks hovering very close to record highs.
I think that the U.S. is a clear winner here when it comes to the spike in oil prices. Inflation expectations in the near term obviously are rising. But if you look further into the future, whether you look at the December 26 oil contract that's trading in the 70s, or if you're looking at five-year forward inflation expectations, those things really aren't moving.
Inflation expectations are super anchored. That was Phil Camporelli of JP Morgan Asset Management. Lisa, you said it earlier. We've said it repeatedly on this program. Despite everything that's been thrown at this institution, the Federal Reserve, the criticism from the White House, the oil price shock in the Middle East, somehow inflation expectations are super anchored.
Which is the reason why Phil Camporelli is going to die on the hill of 60-40, continuing to reassert itself, because ultimately that downside protection still is in the bond market. And that's ultimately one of the key questions, given the positive correlation so far this year, that I've been noticing.
It wasn't much fun in March. Let's put it that way. Well, it really wasn't.
It's the 2022 playbook that burned so many people, and that PTSD. I still kind of feel it, but I guess other people have moved on.
Moved on quickly. This equity market's moved on very fast. Prematurely? We'll find out, but moved on very quickly. Equities up again this morning by 0.1% and going into the cash open about 42 minutes from now, very close to all-time highs. As we count you down to the opening bell, your trading day for the week ahead and into next week looks like this. At 1 p.m. Eastern Time, a White House press briefing. At 2 p.m. the Fed's beige book. Thursday, we'll have another round of jobless claims and earnings from Netflix. Looking ahead to next week, Senate confirmation hearing for Fed Chair nominee Kevin Warsh taking place on Tuesday, or at least set to take place on Tuesday next week?
Yeah, I was thinking maybe, because ultimately Tom Tillis really does hold the keys over a lot of these machinations about the hearing, because he has said he is going to oppose this hearing. He is going to prevent Kevin Warsh, who he supports, from getting even confirmed because of the ongoing probe into the Fed's construction.
The president wants to see Kevin Warsh confirmed. He appointed him, of course he does. Wants to see that happen. He also wants the DOJ probe to continue and the Fed chair, the current one, to get off the board. Those three things don't line up right now because of the player you mentioned, Senator Tom Tillis of North Carolina, and the chairman of the Federal Reserve, the current one right now, who said himself that if the investigation is ongoing, he's not going anywhere.
Yeah, so at the moment, basically, you're going to have a standstill until someone blinks. Is it going to be Senator Tillis, or potentially is there a way you can get it through the floor with a number of senators voting, basically via discharge position, or the DOJ drops that probe? I don't see that happening. But this could just live in the hearing. Senator Tillis, I think, will be happy to have the hearing. It's just whether or not there will be a vote to get Kevin Warsh out of the hearing onto the Senate floor.
It's a story for next week in the Here and Now, very close to all-time highs on the S&P 500. Brent Shitty of Northwestern Mutual writing the following. Investors have taken comfort in strong earnings forecasts for 26. Commentary in the coming weeks will be crucial in validating how businesses are truly navigating higher inflation and higher energy costs. Brent joins us now for more. Brent, welcome. Are you convinced that will be validated, we'll get that validation from the C-suite in the coming weeks?
I am not yet convinced. I think the reality is that investors have focused more on those strong earnings kind of as a security blanket, so kind of the tiebreaker, because the economic data has been a bit mixed. But in the interim, they focus more on the fact that the ceasefire is held, and there's this belief that President Trump values the equity markets and that if he has the opportunity, he will pull back, plus those earnings expectations, which analysts are usually slow to mark them down. And so that's where I think they focus on the strong earnings that are out there right now and the expectations. But let's hear what company executives have to say about how they're navigating the future. And I think that will set the tone, certainly for the next few days and weeks as we look ahead.
So, Brent, we know what the calendar looks like for earnings. Which sectors, which pockets of this equity market are you not comfortable with at the moment and you're waiting to hear from management teams?
You know, I think investors have bid back up the markets, and they've gone back to their old favorites. They've gone back to the things that had worked for much of the past 3 years. They've gone back to non-profitable tech, ironically. They've gone back to the Mag 7. If you do believe that the economy is going to continue to push along and that the conflict will pull back and that will be just fine, you want to go back to what was in place prior to that, where you saw this broadening that was occurring into small and mid-cap stocks, which started basically back in October of last year when 5 of the 7 Mag 7 names actually announced earnings, the Fed cut rates, and investors started thinking about a broadening economy pushing forward. That's where I focused more in the long term, because I think the shorter term is a bit uncertain, but certainly with the chance of a pullback overall, just given the fact that the economy is still showing signs of weakness despite the comments about resilience.
How much are you seeing a change, though, in overall backdrop based on what's happened in Iran, what's ongoing in Iran, and the expectation that commodity prices are going to remain higher for longer? Do you think that nothing materially has changed that potentially favor big tech, say, over mid and small cap stocks?
This is where I think if you look at this quarter, it was expected to grow around 3% when we started it because of the impacts of the One Big Beautiful Bill, the deferred spending from the government that shut down in Q4, plus the monetary policy stimulus that we received last quarter. And this is where I think that is what's held the economy in there. And I think that stimulus will still be there if we can get past the conflict. And that's where I do believe if the conflict does pull back, if interest rates remain well behaved, which I think is even more important than oil. I think people are kind of missing that interest rate commentary a little bit. If that happens, that's where you will see this broadening that was occurring prior to that. And this is where I like, as a strategist, having a couple different outs. I like being in things that are cheaper and underappreciated. And that's where if you look at earnings estimates going forward, the forward 12-month earnings estimates on the S&P 600 is around 17.5%, and you're paying 15 times for that, versus the S&P 500, which is a similar 17% growth rate, but you're paying 21, 22 times for that. I like having valuation on my side in a trade because it can bail me out. I don't have to think about the next 3 or 4 months. I think a little bit longer term, and that's where I like to set up there just a bit more. From the standpoint of where I think value is and where I think we're going in the longer term.
You talked about rates commentary, so let's go there. There's a question about what the direction of the Federal Reserve is going to look like under new leadership, potentially, and the brouhaha that's brewing in the latest soap opera down in Washington, D.C. over the new Fed chair. How closely are you paying attention to this and whether the president's going to drop the probe into the Fed's construction or renovations, and whether we could get Kevin Warsh in the seat by May?
I think it's one of those things that's still out there that beyond the conflict, you still have the questions over what happens with Kevin Warsh when and if he does become Fed president, and what happens with the president's wishes versus what the market is pricing in right now. You have the midterm elections coming up, and you have tariffs, which quietly have come down the past few months as the IEEPA came off, but they're, I think, going to go back up in the future. And so I think there are still plenty of things to worry about. I think the biggest commentary that people are missing just a bit, which I heard the conversation that you just had about inflation expectations in the Federal Reserve. Look, we haven't been, as you mentioned, at the Fed's 2% target for 5 years. And it's been a series of excuses. It was COVID, then it was tariffs, then it was oil, and it was transitory. At what point do people start believing this is more of a permanent thing? And at what point does that begin being priced into the market? And that's where I think you see that risk. On the opposite side, you still have a labor market, which has recovered the past 2 months or 3 months. But if you look at the hiring the last year, since the beginning of 2025, it's all been and more in health services, one narrow segment. And so I think there are still risks out there. But I do think if you look intermediate to longer term and start thinking about that, that's where, regardless of these risks, I like things that are cheaper. I like things that are underinvested. And that's where I would still focus more on those small and mid-cap stocks. And I also think that investors need to think about the 60-40. You need to own some commodities, something that we have owned for much of the past 5, 6, 7 years. That's where I think there are two-sided risks going forward, not one-sided like existed for the past 15, 20 years, where it was just hedged by using long treasuries. Now I think you need to think about inflation being more permanent, maybe tied back to that Kevin Warsh commentary and where the president would like monetary policy to go.
Interesting. Brent, you're a class act. We appreciate your time. Brent Schutte there of Northwestern Mutual Wealth Management. One of the last lines there on inflation being above target for the last 5 years, I think is really important. The chairman was asked about the supply side shocks that we've seen. And I would have to say in the news conference, they were almost dismissed as just something that was happening out there that we couldn't control. Some of these supply side shocks have been choices. They've been more frequent, and some of them have been choices, which is why some people think they're going to see more to come in the future. And this is something you've got to adapt to as an institution, not just sit here and say it's come out of nowhere. We can't do anything about it.
And frankly, there is a structural incentive for nations and for companies to build up their concept of security and independence. And what that requires is investment and more commodities, more of the industrial renaissance that some people were talking about, which leads to higher prices, higher costs that are embedded in the system because of all of these choices, as you say. So this does change the backdrop a bit.
The Fed has also decided to make a choice to basically accept inflation at 3%, not 2%. They made that choice.
That's been the story of the last 5 years for sure, and has certainly not been the objective of this Fed to damage this economy, to get inflation down to 2%. We've certainly not seen that with Chairman Powell. Programming note for you, coming up a little bit later this morning, 10:45 Eastern Time. Bramo catching up with Ted Picker, Morgan Stanley. Look out for that. Tomorrow, ramping up coverage from Washington, D.C. We'll catch up with Max Kentner of HSBC, the Barclays CEO, CS Venkatakrishnan, the former New York Fed President, Bill Dudley, and the Franklin Templeton CEO, Jenny Johnson.
Recovery comes in many forms. For me, there are a few non-negotiables. If I think about the first thing that comes to mind is, of course, my sleep. Good, long enough hours sleeping is so important for our bodies. And I'm sure you can give us a much better explanation for why, but it is something that we can't just leave out. It is the time where your body recovers.
Begin our morning routine of reading the Korea Economic Daily together this morning.
It is Thursday, April 16th. Overnight, the S&P 500 and Nasdaq indices on the New York Stock Exchange hit all-time highs. Optimism regarding the peace talks between the U.S. and Iran is continuing. I will briefly show you an interview President Trump gave on Fox Business before I speak further. Yes, he stated that the war with Iran would end soon, which supported this investor optimism. Riding this momentum, the U.S. stock market showed strength last night, centered on tech stocks. However, not all stocks performed well. I will report on the USI market situation shortly, but let's take a look at the front page headline first. The article is titled ETF surpass 400 trillion yuan, growing 1 trillion yuan a day for 100 days. As of yesterday, the net asset value of domestic ETFs has surpassed 400 trillion yuan. The pace of growth is accelerating. ETFs first appeared in the Korean stock market in 2002. It took 11 years to surpass 100 trillion yuan, 2 years to reach 200 trillion yuan, and half a year to reach 300 trillion yuan. But this time, the market has entered the 400 trillion yuan stage in just 100 days. Now, the net assets of ETFs investing in the domestic market have increased by 46% this year, recording 264 trillion yuan, while ETFs investing overseas have increased by 14% to 126 trillion yuan. Why? It can be interpreted that the global market rally had a significant impact on the rapid expansion of the ETF market. Now, I imagine you are buying a lot of ETFs every day. How large do you think the trading volume is? Well, so far this year, the average daily trading value of ETFs has recorded 17.2 trillion yuan. Compared to last year, the volume has more than tripled, and it has grown significantly to the point where it accounts for 60% of the total trading volume of individual stocks in the securities market. Now, ETFs have various advantages. While you're likely well aware of them, the fundamental advantage is the ability to diversify investments with very low fees. Furthermore, there are now virtually no assets that individual investors cannot invest in, which previously had high entry barriers. This applies to bonds, overseas, stocks, dollars, and even gold. You can trade them very conveniently through a brokerage account. Another attraction is that even retail investors can employ aggressive investment strategies such as leverage or inverse ETFs. Additionally, there are accounts that have no choice but to trade through ETFs. These are pension accounts. And the rapid growth of the ETF market is partly driven by the money concentrated in these accounts. While it is welcome news that the tools we can utilize for investment are diversifying, the rapid growth does raise some concerns. In today's article, we will touch upon a few of these points. First, it is worth considering the excessive increase in short-term trading that bets on market direction using leverage or inverse ETFs. This year, the average daily trading volume of leverage and inverse ETFs or inverse ETFs has exceeded 4 billion KRW. This accounts for 89.5% of the trading volume. While trading volume is already high, the average daily volume for these ETFs is only about. However, it has grown significantly, and its share of total trading has risen by nearly 20 percentage points. Secondly, while the number of ETFs has diversified considerably, the industry points out a problem in that there are many products that are essentially cookie-cutter copies. Although the size of the domestic ETF market is about half that of the Japanese stock market, the number of listed products is 3 times that of Japan. The fact that various asset management companies copy and list products whenever a trending theme emerges has been identified as a critical issue. Now, there is another point. While it's good that the market is growing, instances where the tail wags the dog and distorts the market are occurring quite frequently. I will explain this in more detail in the following article. It is titled The Side Effects of the Dog. Stock prices surge just upon inclusion. As large amounts of capital flow into ETFs, the phenomenon where ETFs dominate and maintain the prices of individual stocks is spreading throughout the entire stock market. It is not that this did not happen in the past. There were some stocks that surged due to a mechanical influx of passive funds simply because they were included in certain index, even though their earnings or industry conditions were not particularly good. I didn't coin the term myself, but apparently there is a phrase called fan, not monster. It refers to a monster created by passive funds, a rather amusing expression, and such things were also a topic of conversation. However, recently, there are claims that the degree of market disruption has become even more severe as active theme ETFs holding illiquid gas, small and medium-sized stocks have sprung up like mushrooms. A prime example would be stocks like CN Electronics and Current, which were included in Xauusd active ETFs last month. Share prices jumped by over 20% simply because they were listed in the ETF. Since then, they have also undergone a sharp correction. The increased volatility in the stock price of 300 Pharmaceutical also had a significant impact on ETF funds. Now, the International Monetary Fund released its Global Financial Stability Report yesterday. Since the report included some discussion regarding the Korean stock market, let's take a look. The report warned that structural vulnerabilities could emerge as large-scale ETF inflows occur, noting that the concentration of the domestic market is the highest among major stock markets. The analysis indicated that while the combination of ETF inflows with a structure centered on a few large-cap stocks, including semiconductors, provides momentum that drives stocks to surge during bull markets, it also plays a role in amplifying risks during bear markets. The general industry assessment is that ETFs have evolved beyond simple index tracking products into key variables influencing market prices. However, opinions suggest that various regulatory frameworks are necessary to ensure stable continued growth. Addressing leverage products, mitigating market concentration, and expanding liquidity are on-chain as key tasks for the authorities of the series. Now let's take a look at some news regarding Korean companies that garnered attention in the stock market yesterday. The headline reads, Samsung SDS, after 10 years of investment silence, partners with KKR to go all in on artificial intelligence. Samsung SDS held a board meeting yesterday and resolved to issue convertible bond CBs worth 1.22 trillion won. The issued CBs will be entirely acquired by a fund managed by KKR, one of the world's largest private equity firms. These convertibles are characterized by the fact that while they are currently bonds, the lender can convert them into company stock later if they so desire. If KKR converts its entire portfolio of convertible bonds, CBEs, into shares, it will secure an 8% stake in Samsung SDS. Through this strategic partnership, KKR has agreed to provide M&A advisory services to Samsung SDS for the next 6 years. This is an area where KKR excels, so this can be understood as an intention to jointly boost the stock price by transferring its know-how. Samsung SDS has raised 1.22 trillion won from its third fund combined with approximately 6.4 trillion won in accumulated cash equivalents. With a combined total of over 7 trillion won in capital, the company has unveiled plans to aggressively expand its artificial intelligence business both domestically and internationally. Domestically, it plans to invest funds in establishing AI data centers in Hainam, South Jeolla Province, and Gumi, North Gyeongsang Province, while in the U.S., it intends to look for potential acquisition targets. The IT industry is paying close attention to this collaboration, viewing it as a turning point that signals a shift toward a more aggressive investment strategy for Samsung SDS. Samsung SDS went public in the fall of 2014. It received a great deal of attention at the time. The closing price on the first day was 320,500 won, and its market capitalization reached 600%. However, as harsh assessments continue to accumulate, namely that the company has accumulated a lot of cash but lacks growth potential, the stock price has now been cut in half. It is worth watching to see if this can mark the beginning of a counterattack. Now, yesterday, Samsung SDS's stock price surged 17.89% due to news, closing at 108,600 won. Samsung Electronics is the largest shareholder of SDS, and Chairman Lee Jae-young also holds a stake of about 9.2%. Next, let's look at the automotive sector. The title is Hyundai Motor Group acquires Rotem and WIA Defense Businesses, accelerating business restructuring. Hyundai Motor Group is streamlining its operations by divesting non-core assets across its subsidiaries and focusing on enhancing their respective expertise. It is reported that Hyundai WIA has decided to transfer its defense business division to Hyundai Rotem and has begun the practical work for the sale. The goal is to finalize everything within this year. Now, Hyundai Rotem is the key player in Hyundai Motor Group's defense industry, responsible for the production of ground weapon systems such as the K2 tank and armored vehicles. Hyundai Rotem's performance has been improving significantly since it began exporting K2 tanks to Poland in 2022. Last year, its operating profit entered the one-share range for the first time, and its defense business accounts for 55% of total revenue. But once this sale is completed, Rotem will be able to internalize the manufacturing technology for other defense businesses previously held by WIA, such as the barrels for the K9 self-propelled howitzer and the main guns for the K2 tank. Furthermore, by absorbing WIA's close-in defense systems, for ships and remote fire control systems, Rotem can become a defense company encompassing operations from land to sea. This is another notable point. Hyundai Xauusd defense sales were around 400 million won last year, so if they divest this business, revenue will naturally drop by that amount. However, they have a plan to reorganize their business with robots and thermal management systems as their two main pillars. Hyundai Rotem is a company with a market capitalization of approximately 23 trillion won. Yesterday, its stock price fell 0.71% to close at 210,000 won, while Hyundai Yuan's market cap is in the 2 trillion won range. During regular trading yesterday, it rose 1.52% to close at 8,400 won, but after our Hangyang article was published online, it surged into the 90,000 won range in the aftermarket to close. Now, let's take a look at movies again. The title is Showbox Continues Box Office Success with Samukji following The Man Who Lives with the King. Showbox, the investment distribution company that hit the jackpot with The Man Who Lives with the King, is aiming for a consecutive hit run with the horror film Samukji, which was released last week. Has anyone here seen this movie? No, I haven't seen it. It is said that the movie reached its break-even point by surpassing 800,000 viewers just 7 days after its release, and it was actually filmed at a reservoir in Yesan, South Changchun province. Apparently, these days, many people who have seen the movie are actually visiting that reservoir late at night. It seems to be becoming quite a hot topic on the internet. Now, there are 5 major distributors in the Korean film market. Among them, Showbox and New are the only 2 that do not own multiplex theater chains. Companies like CJNM and Lot Culture Plus M Entertainment have established vertical integration extending from production to distribution, and they own theaters such as CGV. Lot Cinema, and Megabox. However, since Showbox and Niju do not own screens, they are in a position where they have no choice but to compete based on their content planning capabilities. But in that sense, their achievement is being evaluated as quite meaningful. However, even if the film business is doing well now, it is always a high-risk, high-return business. Last year, Showbox released a film titled Soju War as a major focus, but it only attracted 280,000 viewers by origin. Consequently, its financial condition deteriorated somewhat. I recently mentioned that the government has injected a significant budget into the cultural sector through a supplementary budget by allocating 65.6 billion. It is playing a role in opening up opportunities for investment and distribution companies to conduct business more boldly. With a program set to provide 3 billion per domestic film also scheduled to launch, the industry says that distribution companies without their own theaters will be able to expand their standing. But Showbox is a publicly listed company. Yesterday, its stock price rose 1.23% to close at 2,885 won, marking a 15% increase compared to the beginning of the year. In the case of CJENM, the stock closed at 54,100 won yesterday, up 0.93%, but it has fallen 19% year-to-date. Now let's look a little further into the stock market. Yesterday, the Key Money Index closed at 60.7%, up 2.07 points. This marked the first time the closing price recovered the 6,000 mark since the war with Iran broke out. The Kosdaq Index rose 2.72%, 1,152, and the $1 exchange rate hovered in the mid-1,471 range. Expectations for the resumption of face-to-face negotiations between the U.S. and Iran stimulated domestic investor sentiment. While we are seeing signs here and there that asset prices are quickly finding their footing in this market, there are still many who remain concerned. There is some caution that we might be getting of ourselves. How do you view this? Looking at the Kospi situation, foreigners made net purchases of over 500 million won, while individual and institutional investors were selling stocks. SKNX hit an all-time high yesterday. It closed at $1,136,000 won, up a beady, so 99%, meaning the stock price is now higher than it was before the war. The sector that saw the biggest gains yesterday was construction. Expectations that infrastructure projects, which had been stalled due to the war, could resume have ripened once again. Daewoo ENC rose 28% to 28,500 won, while GS ENC, DAL ENC, and Samsung CNT also showed notable gains. Now let's take a look at the Kosdaq. Okay. While foreign and institutional investors bought stocks, individual investors sold a significant amount. A standout sector is quantum computing-related stocks. A large number of stocks hit the daily upper limit. This is due to the impact of NVIDIA reviving quantum stocks in the global market after unveiling new quantum computing technology. Yeah, get it? Dream Security, which researches quantum-resistant technology to counter quantum computer attacks, rose to the daily limit and closed at 2,731. Additionally, QSI and RNT-X, which manufacture quantum computer components, and ICTK and Xgate, which possess quantum mobile security technology, all recorded consecutive daily upper limit gains. Baby Security stated that while the industry had predicted the commercialization of quantum computers, around 20 computers around 2030, the possibility of this happening sooner is increasing due to technological advancements. They offered a positive opinion, noting that while one must accept the very high volatility of the stock price, it is worth noting as a key technology for AI infrastructure. Now let's look at a few more news items related to listed companies. I have prepared 2 news items regarding Samsung Electronics. The first is an article titled Samsung Widens Gap with China by Equipping All TVs with AI. Samsung Electronics held an event yesterday to unveil its new 2026 TV lineup. The key point is that they have leveraged an integrated artificial intelligence platform as their weapon. They reportedly provide personalized AI to assist with TV viewing through services like Gemini and Perplexity, and the lineup includes features that automatically optimize audio by analyzing it in real time, technology to upscale low-resolution content, and a soccer pro mode that analyzes soccer matches in real time. These are interesting features, but honestly, I don't really use these functions on a TV I buy. I just watch it. I'm not sure how consumers will react to them. Now, it appears that Samsung Electronics has prepared these measures as a strategy to defend against the offensive of low-cost Chinese TVs. This move is based on the judgment that simply making TVs large and high-performing is insufficient to maintain the competitive edge. The company is planning to reshape the landscape by popularizing AI-based TVs, and yesterday, Samsung President Xauusd stated that new Samsung TV products launching in Korea would incorporate 99% AI functionality. It is estimated that the visual display business, which sells TVs, recorded an operating profit of only around 200 million won in the first quarter this year. Furthermore, the company plans to close its factory in Slovakia, a key TV production base in Europe, starting in May. Yesterday, Samsung Electronics rose 2.18% to close at 211,000 won. While Samsung's TV business is facing some difficulties, there was some good news regarding the semiconductor sector. Let's also take a look at an article titled Thank You Musk, Samsung. Tesla's Elon Musk announced that he has completed the design for AI-5, a next-generation artificial intelligence semiconductor. You are currently viewing a post uploaded to X. He stated that they have achieved the tape-out for AI-5. Tape-out means that the semiconductor design has been finalized and has moved on to the foundry manufacturing process. So this is the core chip that will serve as the brain for Tesla's autonomous driving system and humanoid robots. The prototype photo you are currently viewing was posted by Musk. You can verify that this product was manufactured at Samsung Electronics foundry production line by looking at the serial number, or whatever you call it, printed on the bottom. AI-5 is expected to be mass-produced starting next year at the SMC's plants in Taiwan and Arizona, as well as Samsung Electronics plant in Texas. Thus, as for another chip, AI-6, Samsung Electronics will strategically produce it instead of TSMC. With this news of progress in in-house semiconductor development, Tesla's stock price rose significantly on the New York Stock Exchange last night. It rose 7.63%, recording $9 at number 391.9. Now let's look at another stock that benefited from Elon Musk. The article is titled SpaceX Napoom Holdings Hits 52-Week High. Media reports emerged that a company called OCI Terraces has signed a long-term polysilicon supply contract with SpaceX. Following this news, the stock price of OCI Holdings, the parent company, surged. The polysilicon to be supplied by this company is expected to be installed in silicon-based solar cells, which is SpaceX is expanding production of within the United States. It is reported that a long-term supply contract worth approximately 1 trillion won and lasting for about 3 to 5 years is likely representing a substantial volume approaching half of OCI Terraces' annual production capacity. Xauusd Securities projected a positive outlook, stating that companies with solar production facilities in the U.S. will prefer polysilicon from non-Chinese companies to mitigate uncertainties regarding tariff issues or import controls. Yesterday, SIA Holdings rose 24.93% to 93%, closed at 235,000 won. Now for the next article. It is titled Naver Financial and Dunamu to merger and listing in 2031. Dunamu and Naver Financial issued a public disclosure yesterday stating that they would immediately proceed with the listing of Naver Financial once the stock exchange is completed. They presented a schedule to complete the listing within 5 years in principle, which means they intend to do so by 2031 at the latest. At the general shareholders meeting held last month, Dunam stated that they are keeping their options open for both domestic and international markets. However, the internal sentiment suggests that they are considering a Nasdaq listing more seriously than a listing in Korea. The two companies announced a merger through a comprehensive stock exchange last fall. They structured the deal so that Naver Financial would hold 100% of Dunamu shares, making it a wholly owned subsidiary. According to the plan, the procedure should have been completed in the first half of this year, but their schedule was pushed back by 3 months due to various variables such as delays in the Fair Trade Commission's corporate merger review. The stock exchange and transfer will proceed until September 30th. Now, yesterday, Naver's stock price rose 4.71% to close at $211,000. There is one more news item related to coins. It is an article stating that price stability and financial stability are the foundation of economic growth. Now, the general hearing for Bank of Korea Governor nominee Shin Hon-sung was held at the National Assembly yesterday. While a wide variety of topics were discussed, mentions regarding stablecoins also emerged, causing the stock prices of related listed companies to surge. Nominee Shin stated that he clarified his position by saying that stablecoins, central bank digital CBDC, and CBDC-based deposit tokens each have roles in monetary economy and can be used complementarily and competitively. This indicates a significant shift from a somewhat negative stance on coins in the past to a more forward-looking one. Influenced by this, Rune Secure and Aiden closed at their daily upper limits, while Mituo rose in the 10% range and Dara in the 2% range. And these are all companies that emphasize their business activities related to stablecoins. Now let's look at a few stories about foreign companies. The article is titled 4,732 Chats, the man who fell in love with AI eventually. An incident occurred in which an American man in his 30s committed suicide after falling in love with Gemini, Google's AI. According to a report by the Wall Street Journal, this man took his own life just 2 months after using Gemini. His family sued Google, claiming that Gemini fueled his delusions. Records show that 4,732 messages were exchanged over 56 days. It is said that the man started using the AI to alleviate his psychological loneliness operating from his wife and Taintiscope. However, he ended up becoming too emotionally dependent on it. This man began to accept Chebo as a sentient being by giving it a nickname. Although Gemini mentioned that she was an artificial intelligence and encouraged him to converse with real people and even directed him to crisis counseling hotlines. On Moon side, she failed to persuade him. When the man assigned the role of a romantic partner to the user, Nai began acting like a lover again. Ultimately, this led to a suicide attempt. The Wall Street Journal assessed this as a case where a user of an AI arrest scheme fell into delusion and met a tragic outcome. Based on Alphabet A shares, Google's parent company, the stock rose 1.26% last night to close at $1,000 at $337 at $312. Now let's look at a story about a Japanese company. It is an article titled Why Alcoholic Beverage Company Suntory is Acquiring a Healthcare Company. Nihon Kizai reported that Suntory, one of Japan's leading liquor companies, plans to acquire the over-the-counter OT's drug subsidiary of Daiichi Shohei, a major Japanese pharmaceutical company, for 200 million yen. This subsidiary currently holds various brands ranging from painkillers and stomach medicines to cold medicines. Suntory has been concerned about declining whiskey and beer consumption as more people cut back on alcohol. It is said that the company is looking to expand its business into areas such as health drinks and soft drinks. I'm not sure if their intention is to say, we will heal your alcohol-damaged body with medicine, so buy both alcohol and medicine. From the perspective of the IH brand, the rising costs of new drug research and development have been a concern. It is reported that they hope to raise R&D funds by selling this subsidiary. On the Tokyo Stock Exchange, Suntory closed at 4,744 yen yesterday, of 1.24%. Now let me summarize the situation in the U.S. stock market in detail once again. 3 major indices closed mixed. The Dow Jones fell 0.15% at 48,463, giving the impression of a slight pause. On the other hand, as I mentioned earlier, the S&P 500 rose 0.8% to close at $7.22. Breaking the 7,000 mark for the first time, it hit an all-time high for the first time in 2.5 months. The Nasdaq rose 1.59% to 24,16, also setting a new record for the first time in 5.5 months. While it is somewhat surprising that such all-time highs are achieved through war, updates on various changes in the Middle East situation continue. There were reports in the U.S. media that the U.S. and Iran are considering extending the ceasefire, which is scheduled to end on the 21st, by another 2 weeks. But the White House denied these reports as being untrue at this time. Additionally, there were reports that a third U.S. aircraft carrier would soon arrive in the Middle East, which can be interpreted as a move to apply pressure while preparing for the possibility of negotiations collapsing. Okay. Treasury Secretary David Bessent announced that he would not renew the measures to ease sanctions on Russian and Iranian oil, which had been introduced to counter the surge in international oil prices. As a result, New York Sub-Texas crude closed at $91.29 per barrel, and London Brent closed at $93, with both showing almost no change. International oil prices ended flat. Now let's take a look at the stock prices of major listed companies. Earnings announcements are continuing, mainly centered on financial firms, and the reports from Bank of America and Morgan Stanley have been released. They presented decent results that met market expectations. Now let's check a few tech stocks. Porsche. Broadcom's upward trend is particularly notable right now, as of extending its partnership with Meta continues to act as a positive catalyst. Broadcom recorded a 4.2% increase to $12.72, while Meta recorded a 1.72 increase to $671.58. Now, in the case of NVIDIA, the stock price has been rising for 11 consecutive trading days. It has surpassed $190 and is challenging the $200 mark again. It is reported that it has broken the record for the longest continuous rally. NVIDIA rose 1.2% at close at $198.87. Also, NVIDIA's competitor AMD rose and Intel rose as well. However, what is somewhat peculiar is that the stock prices of memory manufacturers fell significantly. Micron dropped 2.03% to $1.50 and Xauusd 23 cents, and Surgeon also pulled back 5.58% to $891.72 to $1.72. That is $7. It is estimated that this was influenced by some profit-taking selling pressure. Since there were some gainers but others fell, the semiconductor index only managed a slight increase. Quantum computing stocks continued their search for the second consecutive day. Positive news regarding the advancement of novel technologies introduced in yesterday's broadcast continues to maintain its momentum. IonQ closed up 20%, Wave Quantum 22%, and Rigetti 13% off. Now, another notable piece of news in the tech industry is that Snap, the operator of the social media platform Snapchat, announced a restructuring plan to lay off 16% of its full-time workforce to divest from artificial intelligence. The company stated that it aims to reduce costs by $500 million by the second half of the year through workforce costs, thereby laying the foundation for a turnaround to profitability. Snap's stock price rose 7.57% up, set at $0.04. Meanwhile, European stock market showed some weakness compared to the U.S. The share prices of luxury fashion companies plummeted. France's Hermès released disappointing first-quarter results that fell short of market expectations due to the aftermath of the Middle East war. What is that? Although sales increased by 5.6% compared to a year ago, the growth rate dropped sharply compared to the fourth quarter. In particular, sales in the Middle East fell by 6%, and sales in France also declined by 2.8% as Middle Eastern tourists visiting for shopping disappeared. These factors fueled market concern, causing LMS shares to close at 1,636.5 euros, down 8.2%, and the Xauusd also fell in tandem. It dropped 9.29% to record that day 254 euros. Now, let's wrap up by solving a quiz together. Shall we take another look at the quiz we showed on our Morning Teen website yesterday? Recently, in Kumamoto, Japan, statues of characters from this manga have emerged as a tourist attraction. What is this popular animation that began serialization in 1997 and has surpassed $600 million in cumulative global sales? I ask. Now, let's see how you chose your answers The most popular choice was One Piece, selected by 73.4% of the people, while some Joes, Crayon Shinjan, and others opted for Dragon Ball. Now, I will show you the answer right away. You all got it right. It is One Piece. One Piece is forging a heartwarming connection with Kumamoto. In 2016, an earthquake struck the region, resulting in nearly 300 casualties. It is said that Oda Eida, the author of One Piece, is from Kumamoto, and he sent a letter to his hometown, promising to help with the reconstruction of his hometown. He devised a plan to erect One Piece character statues throughout the area to attract fans. You are currently viewing the statue of the protagonist Luffy in this article. Along with this, 10 statues of major characters were placed primarily in areas that suffered significant damage, and tourism products were also developed. As it has emerged as a tourist hotspot among foreigners, the number of overnight guests has increased significantly. Last year, the number of foreign visitors staying in Kumamoto reached 1.76 million, a 2.5-fold increase compared to 2015, before the earthquake. The Nihon Keizai Shimbun positively evaluated this, stating that reconstruction tourism, visiting disaster-stricken areas while traveling, achieved both lessons learned from the earthquake and tourism intelligence. It also touched my heart to read the article, noting that manga can play a role in revitalizing such regions. Now, if you visit the Morning Routine homepage today, there is another quiz. Since we introduced a lot about ETFs today, we have had a quiz related to that. If you visit and set up auto login just once, you can participate very easily every day. If you participate by the end of April, we plan to give away tickets for exhibitions and other events. The more you participate, the more chances you will have to win. Sein Valien. We will announce the winners all at once during the broadcast in early May. Now let's take a look at the pre-market situation. Okay, riding the favorable winds of the U.S. stock market, the overall market is rising. However, the gains in semiconductor stocks aren't particularly significant in comparison. What in comparison? Samsung Electronics and SK Hynix are up around 1%, while Hyundai Motor is currently in the 3% range. Naver's stock price is up about 4%. Also, Hyundai, which you saw in the article earlier, is starting with a digit percentage increase. I will keep an eye on how far today's trend continues, and we'll give you an update on tomorrow's broadcast. Now let's take a look at the comments you have left. Misu, you mentioned, since I am still a beginner, I only invest in ETFs through my ISA. Well, if you invest in ETFs through an ISA, you are essentially doing all kinds of stock investing. You can handle pretty much everything with this. So, even though you say you are a beginner now, I believe that as you gradually gain experience, the scope of your investments will expand as well. Ms. Sujin, this makes me reconsider why you choose to invest in ETFs rather than individual stocks. So you shared those stories. Now, regarding that movie from earlier, what was it? Not Wang-san, but the one that was a box office success. I can't quite remember the name. But anyway, that movie with the Yan Reservoir, Chang-sek said, it's really scary. Then I won't be watching it. Yes, said that if Showbox's next project, Duncheck, does well this year, will be a real jackpot. They say this is a film directed by director Yan Sang-ho. Yes, the industry is quite curious about this one right now as well. Now, after seeing the article about Samsung Electronics' new TV lineup, Mok Japan said that he wished they would release a TV at a lower price without the AI features. I actually have a similar thought. And finally, Spa Click left a message saying, quote, I've lived in Gyeonggi-do for nearly 30 years, and today is the day I'm moving to Cheongtan. My mom, dad, and dog are listening together. Let's cheer for our family. Oh my, isn't moving to a new place like this after living in the same place for so long actually a huge change in life? Oh, the weather looks like it will be very sunny today, so I hope you complete your move safely and without any issues. Hello, you Jang-un. I hear you have been listening consistently from the US. Oh, thank you. You mentioned that your 10-year-old son checks the Key House Index every day, saying, I'm a reporter who looks like Yu Jae-suk and tries to guess his mom's mood. Oh my, what an honor. You said you hoped this would serve as some advanced economic learning for him, analyzing market maps with such a famous person. I hope son becomes stock market millionaire. Now that he's doing the local stock market, he'll be able to trade the US market more easily. I hope you hit the jackpot. Hello, Gail Goop. I'm listening while walking the Jeju Ola Trail. You mentioned the weather is amazing. Wow, actually, it's been a really long time since I've been on the Ali Trail. But the vibe I felt when walking it. I can still picture my beautiful self, my handsome self. It still comes to mind. I saw recently that there was someone who said they listened to our broadcast while resting after retiring, and others who listen while traveling. El Bohan. Thank you so much for listening to our economic news from such diverse places. We'll do our best to make tomorrow's broadcast satisfying as well. Now, Chojong, I heard you and your family are listening together in Japan. Wow, there are really a lot of people listening from abroad these days. If like you subscribe to the newspaper, that's a recommendation. Oh, you said you put my name in it. Oh my, thank you. I really want to give you a big thank you, but my desk is a bit small, so thank you. If you get interested in the newspaper while listening to our morning routing, please make sure to subscribe at least once. Our reporters are really sharpening their skills these days to show you high-quality content that is well worth the investment. Our new editor-in-chief has joined us, and it's absolute chaos. We are currently preparing various initiatives to make the newspaper exceptionally good. Please look forward to it. Now, Europa, it has been a year since you started listening while commuting to and from Seoul. Paul, you described YouTube as your companion for your daily long-distance commute, calling it your morning routine. Oh my. Thank you. We will continue to be your companion tomorrow as well. Now, here one asked a quiz question. What is the difference between the Korea Economic Daily app and the mobile app? Well, if you access the mobile version, it is a service where you view our newspaper exactly as it appears in print, so we aren't really included there. You can participate in the quiz by downloading the regular Korea Economic Daily app, or by simply visiting the Morning Routine homepage link shown below our video. So the two apps have slightly different purposes, so we would appreciate it if you could keep that in mind. Well, we'll wrap up today's broadcast here. I will be back tomorrow morning at 8 a.m. with new content. Thank you.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
We're at a world now where there's heightened uncertainty.
If we have a peace deal, then we could have a relief rally in markets.
The market has been volatile during this period, but not a tremendous amount of downside yet.
The market is pricing in that there's going to be a resolution.
We are going into an area of really uncharted waters at this point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, extending the uncertainty. President Trump says he's extending talks with Iran for 10 more days as the energy market is considering a closed strait until at least April 6th. It's leaving oil at triple digits, leaving bond yields at the highs of the year. The uncertainty persists.
So what have we learned this week? It has been a tumultuous week, and one potential takeaway could be that the Truth Social diplomacy plan is losing its punch when it comes to propping up markets. Yesterday, we got this Truth Social post that you were talking about from President Trump talking about postponing that deadline. We saw the worst one-day sell-off before that posting in the S&P since the war started. Now we're still seeing equities lower. We're still seeing bond yields higher. We're still seeing oil prices higher. That is the takeaway for me.
This is the problem. We've replaced near-term escalation risk with an extension of the uncertainty. Persistence is the problem this morning. If the straight closure persists, triple-digit crude persists. If that's the case, you don't need oil to keep going on higher. You just need oil to stay at these levels to cause sufficient problems, which is why if you check out the bond market this morning, 2s, 10s, 30s, two-year yields back to where they were Monday morning before that post on diplomatic talks. 10-year bond yields higher than they were on Monday morning.
And when you take a look at Japanese two-year yields, they're at the highest levels going back to 1996. It's not just a U.S. bond market move, it is a global bond market move, as they reckon with the potential of rate hikes coming from central banks around the world in response to oil prices remaining where they are. We keep talking about asymmetric risks. The longer this goes on, the more of a sea change people see with respect to inflation, downside risk to growth.
And we're tracking the troop movement. This from the Wall Street Journal. Check out this report. The Pentagon looking at sending up to 10,000 additional ground troops to the Middle East to give President Trump more military options. That's hanging over this market as well.
Absolutely, because if those 10,000 troops are sent to the region on top of the Marines and on top of the already deployed soldiers from the 82nd Airborne Division, that would signal to this market that this potentially would be a longer, more protracted war, which is why potentially you can see crude stay higher for much longer. We should note, this right now is just a report, but it does show that the president is keeping his options open.
It just eats away at confidence. It eats away at the Fed's easing bias. It eats away at potential economic growth.
Why send troops there if you aren't going to use them? If you have this hardening line from both sides, and this is already going on for a longer period of time, and ships are not getting through the Strait of Hormuz, people are pricing in a slightly new regime, which is what you're seeing coming through the bond market, which potentially could be the real signal that people need to pay attention.
I think what's going on the Strait, obviously, is of critical importance to this White House. The president talked about it a lot yesterday when I was in the cabinet meeting. But then this morning, you see Iran says that the IRGC turned back 3 container vessels through Hormuz. So you think potentially they're allowing more individuals to come in, more vessels to come in if you pay the Tehran toll. But right now, this morning, they're turning back some vessels, and this is a massive problem for this White House.
Equity futures this morning down by about 1/10 of 1% on the S&P 500. Coming up this hour, Russ Kostrick of BlackRock as the president extends talks. Kevin Burke of Clearview Energy Partners with crude still pushing higher, and Joe Davis of Vanguard with policymakers warning of rising inflation. We begin this hour with our top story. President Trump extending talks with Iran for 10 more days. Leading our coverage out of the region, Bloomberg's Jumana Basechi joins us now from Dubai. Jumana, it's another 10 days of uncertainty.
Yeah, well, you know, on first blush, this actually came as a relief to the nations in the region. The strikes on infrastructure, on key civilian infrastructure, both against Iran, but also potentially in retaliation against the Gulf states, pushed back by 10 days. So that was the, I would say, short-term reaction. But beyond that, there's still a lot of skepticism about the state of these talks, whether they're actually happening, whether the Iranians do want to engage. And the Iranians, at least rhetorically, are not signaling that any discussions are taking place. And in fact, the Iranian Foreign Minister Abbas Araghchi gave an interview to local TV yesterday, and he said that they're not engaged in any talks to end the war. They don't have plans to engage in those talks. But the U.S. had sent messages to them via Pakistan, which is in line with the reporting over the last couple of days. But there is no sign whatsoever that this in-person summit that people had been talking about is set to take place. So that is the diplomacy angle. But at the same time, in light of what you were just discussing, I think we really are going into a critical weekend in terms of the mobilization of troops that the U.S. is amassing in this part of the world. And we've been reporting over the course of the last couple of days that there are 2 Marine expeditionary units making their way. Our expectation is that the first unit will arrive in a couple of days. The next unit should arrive in mid-April, just to give you an idea of the time frame here. Wall Street Journal reporting overnight that the Pentagon are also considering sending 10,000 troops alongside infantry and key vessels as well. And so the takeaway from all of this is the U.S. is preparing for perhaps another stage of escalation. And you've got to assume that once all of these new military assets are deployed, they are going to be in striking distance of Iran or Karg Island, which is the key export island, or there's going to be some form of an attempt to forcefully reopen the Strait of Hormuz. There are little islands situated nearby as well. So the overarching question as we go into the weekend perhaps is less about whether diplomacy is going to yield anything, but actually what the U.S.'s plans are on the ground, if there is a plan.
Jumana Basechi out of Dubai. Jumana, appreciate your time. Stay close. No doubt we'll get some news throughout this morning. The base case at the start of this war, it won't matter to markets if it's days and not weeks. Remember that? And then it was weeks and not months. And now here we are at the 1-month marker and a new self-imposed deadline of April 6th. So we'll be talking about this into April, based on this guidance.
Prediction markets are saying that through the end of April, this could potentially be the reality. And the issue is, and people are watching this, you don't just open the Strait of Hormuz. You don't just say, okay, green light, go ahead. This is the issue, the lag time. And so as people try to price that in, it seems like another number of asset classes are really starting to respond.
It's the reality of production in the region. The longer some of the production is shut in, the harder it is to ramp up production coming out the other side.
And that's why Macquarie this morning is out with a note saying if this is protracted, it lasts a lot longer. You're looking at $200 a barrel when it comes to oil. We actually know and had reporting from our colleagues in Washington that the Treasury Department was modeling out what the impact would be for that number, $200. So that is another key threshold everyone is watching.
Let's get to the view on Wall Street this morning. Russ Kostrick of BlackRock writing the following: while our base case is no recession, the energy shock suggests a moderation in near-term growth expectations. Russ joins us now for more.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Russ, welcome to the program. You and the team have been de-risking. Where and what in?
Good morning, Jonathan. We've been de-risking across the board. We've really been getting closer to benchmark in our equity positions, closer to benchmark in duration. We've been bringing down some of the factor risk in the portfolio. And there are a couple reasons for that. The obvious one is we don't know how long this is going to go, to continue. I think you used exactly the right word a few moments ago, persistence. And the longer this persists, the greater the risk to inflation, the economy. But the other reason for de-risking is that there really aren't any hedges in this context. In 22, the dollar actually was an effective hedge against the sell-off in equities. Last decade, treasuries were providing some downside when there were concerns about growth. In other circumstances, gold has been working. Nothing is working right now. So really the only thing you can do within a portfolio, other than making some adjustments at the stock level, is to bring the risks down.
I often say, in moments like this, the bonds don't work, they make things worse. Yields right now up again by 4 basis points for us, 10s at 4.45, 2s at 4%. Lisa and I yesterday spent a lot of time on a week 2-year auction, a week 5-year auction, followed by a week 7-year auction as well, Russ. What is happening there? What's behind those moves?
So this, to me, is actually maybe even a bit more interesting than what's going on in equity markets. It's very easy to understand. You have an oil shock, higher inflation, hit to growth, and what's happening with stocks. The bond market, I think, is more nuanced. Obviously, the bond market is reacting to what will be an increase in headline inflation. That said, as you point out, I think most people realize higher energy, not just oil, but natural gas, higher food prices, higher fertilizer prices, all of which leads to an increase in headline inflation. But the problem is, one, that doesn't necessarily flow into core, and two, it is also a drag on growth. And it's happening at a time when the labor market is already a bit soft. So the notion that you just want to keep selling bonds into this, to me, that's less obvious. And I do think at some point, if the concerns about growth continue to build, if we do have $100 or higher oil for a prolonged period of time, there is a question about at what point you want to start bringing bonds back into your portfolio as a hedge against weaker growth, which is going to be another risk we're going to contend with.
Part of the reason why it's been so hard, Russ, to get a handle on when that point is, when people should step in and buy duration, is it's unclear exactly what's behind the sell-off. Is it technical? Is it a question of central banks that are selling what they can to raise money for possible fiscal stimulus? Is it a potential concern for a fiscal response to any kind of slowdown in the future? What's your take on this?
So I think it's a great question. To my mind, one of the things that's clearly going on is a pricing out of what would have been a number of rate cuts from the Fed and pricing in a greater possibility of hikes, particularly from the ECB. So is the front end of the curve is adjusting. You're seeing that movement throughout all of the yield curve. But again, if we're going to be in an environment where $100 oil persists, and I think, you all raised a good point a few moments ago, it's not as if oil is going to go back to 65 the second the shooting stops. There's been damage to infrastructure. There are questions about how long it takes to open the Straits of Hormuz. There is likely to be a war premium or a risk premium embedded in oil for many, many months. So if you're going to have that period of prolonged higher energy and all the knock-on effects, you've got to start to bring down your growth expectations, most of which were high coming into the year. And at some point, that probably does suggest bringing your duration up further.
Which is something that I know others, including JP Morgan, has been thinking of doing. Given all of this and given what we know in terms of the prolonged conflict, do you think that right now we're facing a market that is overly complacent when it comes to the growth shock that's coming down the pike?
I don't think it's overly complacent because I do think you've already seen a fairly significant adjustment. I also believe that, at least in the U.S., I think the situation in Europe is certainly more serious given their exposure to higher energy prices. I think the U.S. can probably survive 80 or 90 oil, still have a year when growth is positive. Of course, the difference is going to be that we're not going to get, or we're less likely to get, the type of above trend growth that investors were expecting just a few months ago. And if you look at what the equity market has been doing, it's actually responding to that. The rotation that dominated back in late 25, early 26 was all about the broadening out. You bought cyclicals, you bought value, you bought international stocks, you bought small caps. To my mind, those trades were predicated on above trend growth. As you start to price that growth out, you're seeing a reversal of many of those trends. Investors have been looking for more defensive parts of the market. And interestingly enough, they've also been looking at tech, at least on a relative basis, as holding up better in a world in which economic growth is not as much of a tailwind.
Hey, Russ, always got to catch up. Russ Xauusd there of BlackRock. Certain pieces of tech, maybe, but the Nasdaq 100 down almost 10% from the highs of the last year or so, and some individual names have been hammered. Microsoft down some 30% from the highs of last year. Meta hammered yesterday, down 15% so far in March.
That was fascinating. It's frankly breaking below a lot of the technical trends, leading some people to say this has legs. Is it because of disruption coming from new technology, whether it's overseas or domestically? Or is it the lawsuits with Meta coming under pressure for some of its social media controls? Tech is maybe the haven, but it depends where you look in tech, and that is an increasingly complicated story.
It's not just the war you've got to track, it's the situation with technology, AI disruption, etc., and this in private markets. Is this a flex from Oaktree? This headline we've just seen. They'll meet 8.5% of private credit fund redemptions in full.
100% it's a flex, because that's the headline they want everyone to see. Apollo, Blue Owl, all of you people, you guys can cap things at 5% and say, oh, I'm so responsible. I'm going to meet it in full and have no problem with it. So sure, this is definitely going to be a time where they're all kind of trolling each other. And this is how I read this headline.
More on that story a little bit later this hour. Equity futures here down 1/10 of 1% on the S&P, with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Good morning, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well. Iran saying it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. A legal victory for Anthropic, the maker of the chatbot Claude, winning a court order blocking a Trump administration ban on government use of its AI technology. Anthropic arguing the ban could cost it billions in lost revenue. And the Senate passing a bill to end the Department of Homeland Security shutdown. The bill still needs to pass the House and be signed by President Donald Trump. Ahead of the bill passing, Trump saying he would sign an order to pay TSA officers. That's your Bloomberg brief. John.
Hey, Yahira, thank you. More from Yahira later this hour. Up next on the program, pushing allies to step up.
Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that. So they should step up and deal with it. They should be doing something about it.
Up next, we'll catch up with Bloomberg's Colonel Wayne Sanders. He joins us next, live from New York City this morning. Good morning.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Biggest one-day loss since the war started in yesterday's session. This morning, no pickup, no bounce. Even as the president extends talks, he extends uncertainty for this market. The Nasdaq is down by 0.2%, and this move continues. Weak 2-year auction, weak 5-year, soft 7-year. Bond yields up again, 2 basis points, north of 4% on 2s, on 10s. 4.46. Yields right now are higher now than where they were on Monday morning before the president declared there were talks.
We're now pricing in a 50% chance of a rate hike from the Federal Reserve by October, a 75% chance for an ECB rate hike, at least one, through the end of the year. And right now, it's a real question mark. If this goes on for a longer period of time, Christine Lagarde coming out and saying, we cannot be humble about our goal, which is getting inflation down to 2%. So even if it is a marginal move higher, we have to take action, seeming to confirm the hawkish bias.
It's pretty simple. The longer the talks go on, the longer the strait is closed. That's the view of the market right now, which means crude stays at these levels. Brent around triple digits, 110, almost 110 this morning. WTI 96.
Or the talks are basically just a distraction because the President of the United States is making sure that the right personnel is in place so that he can open the Strait of Hormuz. But I think one thing to really understand is that even if the U.S. military was able to open up the Strait of Hormuz, maybe also with a coalition, the FT is reporting the UAE would be willing to join this sort of coalition, it is not going to be normal flow of traffic in terms of volume that we are used to. So regardless, it is going to be weeks and months that this is going to be impacting the energy market.
Persistence is the problem. Under Savannah's this morning, pushing allies to step up.
Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that, and so they should step up and deal with it. It can be open tomorrow if Iran stops threatening global shipping, which is an outrage and a violation of international law for all these countries that care about international law. They should be doing something about it. There was a couple of leaders in Europe who said that this was not Europe's war. The United States is constantly being asked to help in a war, and we have more than any other country.
So here's the latest this morning. Secretary of State Marco Rubio at the G7 foreign ministers meeting in France, with the US seeking support for opening the Strait of Hormuz. Bloomberg's Ollie Crook joins us now for more. Ollie, what's the update on the talks?
Yeah, for the G7 foreign ministers gathered here, you have Marco Rubio just in that room there behind me having discussions with the foreign ministers of other G7 nations, but also very interestingly and very relevantly, the Saudi foreign minister who is here as well. For them, you know, it's going to be a fact-finding mission to get from Marco Rubio not only what the U.S. war aims are in Iran, of course that has been the big question for everybody, but also further to that, what are the specific things that are being asked of European allies? We've of course heard from Donald Trump yesterday saying that NATO had been effectively useless to them in the Straits of Hormuz and that he won't forget it. The question will be specifically what kinds of things the Europeans, the G7, can present. What we understand now is under discussion at a high level is a coalition of more than 30 countries. We had the NATO Secretary General Mark Rutte speaking yesterday about that would be involved in some way, this coalition of the willing to open up the Straits of Hormuz. Now, there's several questions attached to that. The first is willing to do what and willing to do it when. I've spoken to a number of officials here, including the Canadian foreign minister, a spokesman for the French here, who had originally floated this idea of being actively involved in opening up the Straits of Hormuz, and I couldn't really pin anyone down in terms of the timing. They say really after the majority of the war is done, but as you know, the war doesn't necessarily end cleanly. I think there's also an effort here by the Europeans to link the war in Iran with the war in Ukraine, saying that the Russians sending drones and intelligence are actively targeting U.S. troops and U.S. lives. That is a line they want to draw, but as you say there, John, the line that Marco Rubio wants to draw is that everybody's saying the war in Iran is not our war. The Americans say Ukraine is not our war, but we're still helping.
Ollie, it's good to catch up. Stay close. We'll catch up with you later if we see any headlines. Ollie Crook there on the ground in France. Joining us now to extend the conversation, Colonel Wayne Sanders, Senior Defense Analyst at Bloomberg Intelligence. Colonel, welcome to the program. Can we talk about the potential for a ground operation? Could you describe what that might look like and what the objectives would be?
Absolutely. When you think about ground operations, especially with the limited number of troops that are on its way, it is something that would probably be limited in scope. It's probably, you know, we look at the 2 Marine Expeditionary Units that are on the way. The first one's coming from the USS Tripoli, should be there over the weekend, and then the USS Boxer in the beginning of April. But any type of insertion, right, is going to require air superiority, which we already have. So you would actually see an uptick in overflights that would allow for those type of security operations to make sure secure passage to go there, whether or not they're being airlifted in or whether or not they're actually going into the strait. We think about like Karg Island being one of the areas where you could potentially see boots on the ground because it is limited in terms of its mainland Iran status, if you will, to be able to go there. But when you look at this, one thing I do want to bring up is the difference in troop numbers that are going out there now versus previous escalations, because people are talking about the ground strike portion of it. The U.S. troop count when in Desert Storm was 697,000. The amount of people at OIF, at Operation Iraqi Freedom in 2003 in Iraq, that was about 160,000. So we're only talking right now at about 10,000. Even if you bring in another 10,000, you're talking about 20,000 total. So a lot less. So it would be very, very surgical in terms of what they're trying to accomplish.
If it's surgical, does that mean that this wouldn't be a garrison of troops set up at one of these islands?
Well, that's about all you would be able to do with that, right? Is because you would have to be able to set up enough security, bring in logistics, refueling, everything that's required, air defense assets that you would have to set up to be able to provide security for those infantry and Marine Expeditionary Unit forces to be able to hold that. The straits are pretty long, so even when you're looking at where the choke points are and being able to do that, you still have to figure out how are you going to make sure that you can get rid of some of the asymmetric threats that can show up with shoulder-fired missiles. Because at this point in time, as you've seen, it doesn't matter. It doesn't have to be a full closing. Iran at this point in time has just had to threaten those attacks, and it has stopped most of the flow.
Does the president's new deadline of April 6 match up with the ability to get all these troops in place?
I think it does a little bit. His original deadline of this weekend, right, was tied to the Marine Expeditionary Units coming in. There are additional capabilities that are coming in, and one of the other things we've seen President Trump do is he doesn't like to choreograph his moves. Most of the success has come from ones that hasn't been choreographed. Operation Midnight Hammer, nobody knew it was coming. And then even when the strikes originally happened on February 28th, same kind of thing here is that extension allows him to have additional options. Even if he was going to do something with just one Marine Expeditionary Unit as they come in, or the 82nd Airborne, the elements of them that are coming in as well, it gives him freedom of operations at that point in time. There are more options available now as opposed to having to answer to a deadline that was set for this weekend.
Colonel, appreciate your time. Fantastic framing. Colonel Wayne Sanders there of Bloomberg Intelligence. We've talked repeatedly through this week about two-way risk. The two-way risk persists.
Even though there was a dialing down of the temperature, and this is the key point, a question of even if you don't necessarily have this bimodal outcome over the weekend, there still is a feeling that we don't have a sense of resolution. Why would anyone take big risk at this moment, especially with the lingering after effects?
You've got to remember who turned up the temperature to begin with. The original threat came from the US side to bomb energy plants in Iran, and that moved from an immediate threat to a 5-day period of talks, and that's now moved to a 10-day period of talks, taking us to April 6th. So you can turn the volume down all you like. This market's been focused on one thing, obsessively. The volume of traffic going through the Strait of Hormuz, what it means for production in the Middle East, the damage done there too. And if this persists, this story doesn't change, it gets worse.
And frankly, that is exactly why this is so different than what we saw during Liberation Day, because you could turn the temperature back down and it wasn't the Strait of Hormuz and it wasn't a physical goods. The fact that now UAE and Saudi Arabia are coming out and saying, you better not leave, and then leave this quagmire with us to deal with, gives you a sense of how this could develop.
I'm struck this morning. 2 Chinese vessels tried to go through and they had to make a U-turn.
If you're hoping for a change for the better, you're not seeing one right now. Coming up on the programme, we'll catch up with Kevin Burke of Clearview Energy Partners, with oil rising as traders brace for a longer war. Live from New York City this morning. Good morning. You're watching Bloomberg TV.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
So we had a self-imposed deadline and the president has delayed 10 more days of talks. The price action might not be what you expected. This is seen as 10 more days of uncertainty, 10 more days at least of the Strait of Hormuz being effectively closed. Equity futures on the S&P down by 1/10%, following the biggest one-day slide we've seen so far throughout this month, throughout this war. In the bond market, 2-year, 10-year, 30-year yields making new highs for the year. The 2-year, north of 4%, 10s at 4.46 and up 4 basis points. On the front end of the curve, up by 2. And this is following some pretty soft auctions through the week so far.
Yeah, and Russ Kostridge said it perfectly, which is you can't hedge anywhere, and it hasn't been a hedge in the 2-year yield. It hasn't been a hedge in the 5-year yield. And in the 7-year yield, when we got the auction yesterday, the similar kind of messiness, albeit even less, actually, ironically, than the 2 and the 5-year. The 60-40 portfolio, worst monthly performance right now, going back to 2022.
You don't need crude to go up a lot from here. Crude just holding on to these levels causes its own problems. And we're holding on to these levels, 110 on Brent, 96 on WTI. That's a problem. Once again, the P word. It persists.
It persists, and it is a problem because this is a global market. I was struck yesterday by the Treasury Secretary saying the global oil market is well supplied. Well, if it's so well supplied, then why are we taking all these extreme measures? Why are developed countries having to go into their stockpiles and release? And why is the president threatening all these troops to open up the Strait of Hormuz? Because it is priced globally, and right now, yes, the United States is dealing with this, but if this persists, a lot of issues are going to be prolonged. And it's not just crude. Fertilizer. You have to make these orders in the next 5 to 6 days. And we are reliant 20% on imports of key fertilizer ingredients.
There's a lot of options on the table heading into April 6th as we count you down to the opening bell. 3 hours away. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We start there with oil, with the U.S. energy producer Battalion up 14% in the pre-market as it tracks another rise in oil prices. And I thought Deutsche Bank put it best this morning, saying that while President Trump's 10-day delay for strikes may ease immediate risk, there's still no clear path to a resolution with Iran. So that is keeping supply concerns front and center and benefiting these domestic oil stocks. And it's not just oil, gold moving higher as well, and that is benefiting mining stocks like Hycroft, up 2% in the pre-market. And what's notable here is that during this conflict, we have seen oil and gold moving in opposite directions, but today we are seeing them move in lockstep, both rising. And we end on AstraZeneca. Those shares up 3.8% in the pre-market after late-stage data showed its drug to treat a deadly lung disease helped alleviate symptoms. And analysts say that this one drug could bring in nearly $1 billion in annual sales for the company. So shares up on that news. John?
Yahara, thank you. Appreciate the update. More from Yahara in just a moment. On our radar this morning, President Trump extending his deadline for striking Iranian energy sites for 10 days. In a social media post, the president writing talks are, quote, going very well. Tehran insists it's not negotiating with Washington. The White House considering sending 10,000 more soldiers to the Middle East. A senior U.S. defense official reportedly saying the forces would be in addition to thousands of Marines and paratroopers already deployed to the region. And finally, the Senate passing legislation early this morning to fund most of DHS. The deal approving funding for the TSA, but not for ICE. The budget impasse jamming airports and disrupting travel around the country. The measure heading to the House for a vote as soon as today.
And really the issue for me is, does this actually matter, given the fact that President Trump has already ordered that they get paid out of a discretionary fund? Has in some ways Congress absconded its function once again to the president, who is superseding them as they wait to vote on this measure? I just wonder how much pushback they get, because suddenly there is more time that they potentially could continue negotiating this, given that perhaps TSA agents are already going to be paid.
Two things stood out for me. One, if the president had this authority and found these funds, why didn't he do it weeks ago, before we lost all these people at TSA, before TSA workers were not getting paid? How difficult is that, to continuously miss paychecks? I'll tell you this, lawmakers aren't missing paychecks. And two...
And they're cutting lines.
Yes, and they're... Yes, exactly. And GOP leaders have, for weeks, resisting Democratic calls to say, let's just do a deal, let's pay TSA, and let's come back to the table and discuss what's going on for ICE and CBP. They said no, they said no, they said no. And guess what? Last night at 3 a.m. when we're all waking up, they're voting for it.
I don't know why politicians in Washington don't realize the following. They play this game where they want to make it about Republicans versus Democrats. If you're in that line, you just hate Washington. You just despise Congress. And you see this in poll after poll. There's one great poll about the handling of the economy. Are you happy with the handling of the economy by the president right now? And you'll see in that poll, no, people aren't happy. Then you'll ask them, do you think that the Democrats would handle it even better? And they'll say no in the very same poll. The consequence of this mess is not one wins versus the other. People just turn against Congress and the politicians representing them.
Everybody loses, essentially, is the way that this works. People lose politically and people lose when they try to travel anywhere. One individual who went down to Washington, D.C. to discuss with them this, who actually is in the industry, asked them, why don't you just pass this bill, get TSA agents paid, we'll resolve this issue, you guys can scrabble, fight over everything else. What they said was, nothing gets done if we remove this point of leverage. It's very honest, but my goodness, it does not read well in this society.
Not good at all, is it? Not good at all. Let's focus on crude, pushing higher once again with no off-ramp in sight for the war in Iran. Kevin Book of Clearview Energy Partners writing the blockage of crude through the Strait of Hormuz could be more than offset by SPR releases in the Americas, but inventory levels in Europe could drop if current conditions persist. Kevin joins us now for more. Kevin, welcome to the programme. This situation does persist, so let's assume, and it is an assumption, things can change, it's a self-imposed deadline. But if this continues through to, say, April 6th, what would that mean for this energy market?
John, good to see you. Look, we've got 10 more days for inventories to decline. The cold mathematics of inventory depletion are much like the cold mathematics of viral replication. If you go back to COVID, the problem was building around the world. Markets and really America missed it, and it's going to catch us.
Well, how much drawdown could the United States continue to do without going back and refilling the SPR?
There's room for the SPR to come down further, but not much room. And part of that's got to do with legislation and the ability to draw further under emergency conditions versus non-emergency conditions. Part of that's got to do with the practicality of the SPR. Having it available for the big crises means you want to keep some in reserve. If this isn't over in 10 days, maybe you want it around longer.
Kevin, if the U.S. administration knew that this was a possibility, and it always was. The president, I remember a year ago talking to him about this. He prefers a diplomatic route, but he was steadfast. Iran will never get a nuclear weapon. He's willing to deal with them the hard way. Why were they not refilling the Strategic Petroleum Reserve?
As you know very well on this network, the Secretary of Energy asked for $20 billion, or at least mooted the proposition last year. And in what was probably the most catastrophic mispricing of risk in recent congressional history, they gave him $171 million. So without money, you can't refill the reserve.
When it comes to the OECD stocks, how does that actually impact the price of oil?
There's a very strong inverse correlation between OECD petroleum inventories and the front-run Brent crude price. And it's one of the relationships you can count on for a reason. When there's less oil in stocks, if it can't come out of inventories and it can't come out of the ground, it can't come out of the strait, where's it going to come from? Prices go up.
Is this an oil problem, Kevin, or are we overplaying the oil aspect of this and underplaying the natural gas aspect?
I think the natural gas aspect is pretty significant at the margins. It's easy to overlook it in sort of the total energy picture. And frankly, the two are related in a very significant sense. 4% of the world's energy consumption in terms of oil and gas bottled up in the strait right now means that there's substitution fuel pursuits happening all over the world. In the last crisis, 4 years ago, we went from missing gas westbound into Europe, drawing liquids demand from petroleum for generation in Asia. Now those liquids aren't available either.
We do see, though, that the United States has been ramping up the production of liquefied natural gas and had previously been exporting a growing proportion to Europe in particular to offset the decline coming from Russia. How much do you see that continuing versus maybe a little bit of restraint on that front as natural gas prices in the U.S. also climb?
Well, they haven't climbed very much, and I think that's one of the significant takeaways of the LNG story here in the United States. There's still a great deal of missing connectivity that would provide for those prices to rise. There has to be some way to expand volumes in response to the deficit in global markets for there to be that kind of price response. And even then, we have a very flat supply curve. I think that when you look at importing governments, they're all going to be asking one question after this, and that question is, how can we make sure this never happens again? One answer is to diversify sources and routes. To the extent that routes are the solution, the United States can provide an answer.
That's certainly going to take time. Kevin, I want to finish on this, just a piece of scenario analysis, if you will. If there is a ground operation to take Karg Island to try and reopen the Strait of Hormuz, how do you suspect the futures curve would price that? Would it begin to price in a resolution to this war? Would it drag prices lower or push prices up?
I think we have to ask what the Iranian riposte would be to that, John. And I think the answer might be that they'll look westward those cargoes going to the Red Sea, and maybe we see an activation of the Houthis in the next leg up in risk. So I'm not sure that's the answer we'll see in the market.
I think I understand where you think prices will go. Kevin, thank you, sir. Kevin Book there at Clearview Energy Partners, because if the Houthis get involved, we got another problem.
Yeah, and yesterday I thought that it was fascinating, the interview that AMH did, the indication that right now Saudi Arabia is paying off the Houthis not to interfere with the Red Sea passageway, gives you a sense of, the rule by mob that seems to be going on over there.
But that could change, because obviously their biggest beneficiary is the Iranians. And at some point, the Iranians could say, we need to escalate this. We want to put the pressure up even higher. We want to move crude prices closer to a very painful threshold for this White House. And he could tell them to get involved. And all you need is one drone, one speedboat at the Bab el-Mandeb Strait, and this east-west pipeline that Saudi Arabia has been using to move 3, 4, 5 million barrels a day. Now that crude all gets stuck.
Brent crude right now. Brent 110, WTI 96. Let's get you an update on news worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Secretary of State Marco Rubio meeting with his G7 counterparts in France. Rubio may have a hard time gaining support from U.S. allies a day after President Trump complained about NATO countries not stepping up to help with the war in Iran. Nicolas Maduro appearing in a Manhattan federal court yesterday. You can see the court sketches there. The U.S. is pushing ahead with a broad drug trafficking and narco-terrorism conspiracy case against the ousted Venezuelan leader. And Oaktree Capital Management is meeting all redemption requests for one of its private credit funds. According to a regulatory filing, the company is allowing investors to take out 8.5% of net assets from its strategic credit fund, which is equivalent to around $400 million. That's your Bloomberg Brief. John.
Yahira, thank you. The ultimate flex. Bramo was talking about it earlier. Everything just feels like a marketing campaign right now. They're all throwing shade at each other in private markets.
This is an opportunity for people to potentially gain market share and to show who the bad apples are and that they're the good ones. To me, this is saying you have to cap it. We don't. We're good.
The Oaktree flex early on this morning. Equity futures right now, the S&P negative by a third of 1%. Up next, the inflation warnings piling up.
Moreover, the conflict in the Middle East raises additional risks.
I still see underlying inflation as gradually moving down.
The inflation risk is greater right now as a result of the Iran war.
We'll get to that divide in just a moment with Joe Davis of Vanguard. Uncertainty extended. Equity futures down by a third of 1% on the S&P, following the biggest one-day slide on the S&P 500 so far this month since the war started. The S&P at the lowest level we've seen since early September. On the Nasdaq, we're down another 0.5%. The Nasdaq 100 very, very close to correction territory, down almost 10% from the high of the last 12 months. In the bond market, new highs for this year: 2s, 10s, 30s, 10s, 446 up 5 basis points, 2 up by 3 basis points to 4.01%. This is the pain trade for me, Bramo. This is the pain trade for me. We've flipped from easing to tightening over at all these central banks, the Fed, the ECB, the Bank of England. And in this market, when you speak to anyone in fixed income, they talk about the value created in the yield curve and the opportunity to step in. There's so much doubt about this persisting, which makes it so much more painful.
If it continues to go up. And what you did see last week and this past week, long-term bonds have seen their second largest ever withdrawal, their biggest withdrawal going back to March 2020. This is according to EPFR and Bank of America data. And Michael Hartnett over at Bank of America said, expect policy panic to avoid recession. Guess what? He's looking for that yield curve steepener as a result of the fiscal response to avoid any kind of serious economic downturn. This is the potential pain trade that you're talking about.
Check out crude, Brent, and WTI. There's 3 scenarios here, and we usually only talk about 2 of them, and these are the 2. The two-way risk that crude crashes from here on the back of a resolution, or things escalate and crude spikes to 150. What about the problems caused by just staying around these levels? And that's the conversation I think we have to have this morning as we talk down another 10 days of talks between the US and Iran, and Brent crude around 110.
Well, it's going to be very complicated and not really as much for the United States as is the rest of the world. You're already seeing some countries like the Philippines saying this is a state of emergency. Asia is still the front lines of this crisis when it comes to the energy shock, telling people work from home, take carpools, and then it's really going to start to hit Europe. And that's going to be a big problem, and I'm sure Secretary Rubio is hearing about it right now in France at the G7.
Brent crude 110.50, WTI north of 96. Under surveillance this morning, inflation warnings piling up.
Moreover, the conflict in the Middle East raises additional risks. Higher oil prices tend to pass through pretty quickly to gasoline prices. And higher gasoline prices can be particularly painful.
I still see underlying inflation as gradually moving down towards target over the next, 12 months.
I would argue that the inflation risk is greater right now as a result of the Iran war.
So here's the latest this morning. Federal Reserve officials raising concerns about the impact of the Iran war on inflation. Treasury yields setting new highs for the year as investors shift expectations from rate cuts to possible hikes. Joe Davis of Vanguard writing, the key indicators I'm watching are twofold. One is clearly just the labour market. The second has always been a wild card, the price of oil. Joe joins us now for more. Joe, welcome to the programme. Two time horizons. Let's start with the first. Quite short term. I want to start with the March data and the April data. What are you expecting to see in the March and April data?
Well, we're going to continue to see inflation that's somewhat stubborn. I mean, if you look back over 2 years, obviously some progress, but our theme going into the year before the events, just in the Middle East, was that the Federal Reserve was going to be a little bit challenged to deliver in the cuts expected because a little bit of this stubbornness in inflation. And so, again, that's before oil has moved. So we're going to see mixed signals, and some of it is dated given what we're seeing in the oil markets.
Joe, in line with that, how do you expect central bank communication to adapt, to evolve between now and the April meeting?
Well, I think we're starting to see it. You're going to have to talk tough on inflation. This is, central banks, generally speaking, have some scar tissue going back several years. And so I think the tougher you talk, the less you actually have to do. And I think that's where we're at. I think you're going to have to address the fact that although the oil spike will push up inflation, push down growth, you have to focus on the former, not the latter, just from a risk management perspective. I don't see the Federal Reserve hiking anytime soon, just because of the cross currents it'll do in labor market. But nevertheless, this notion of easing significantly because of the downdraft in the economy, you got to be careful with that timing, even if that would ever happen, because we need to see a lot of events unfold before we go down that path.
And Joe, this is the reason why when John says, what if oil prices just stay around here? Potentially that could be one of the more toxic scenarios for central banks, because they may have to respond more to ongoing inflationary pressure with growth continuing to hang in there, at least reduced, but at least positive. How do you see the Fed responding to oil prices staying here versus spiking higher or going back down?
I think that's the most interesting dynamic, what your conversation is this morning, because obviously if it collapses, we have obviously a risk on, and this is more of a return to other factors that we were watching. Obviously 150 price of oil per barrel starts to bring in the recession risk much more prominently, but it's a persistent around $100. You have to redo the calculus. I think that now that is a Federal Reserve that is very much on hold and is not going to get the disinflationary effect that you were banking on. And so I think that's the more interesting scenario. And I think that should be, more seriously considered than perhaps even the other two for the time being.
What do you think the bond market right now is pricing in, given the fact that we've had a repricing across the curve? Yes, there has been a curve flattening. Short end yields have risen more than long end yields, but long end yields continuing to sell off with some auctions that represent real weakness. Is this people who are gaming out growth, rate hikes that persist, stagflationary types of situations?
It is doing both. I mean, we got a little fiscal in the background at the long end of the curve, but it is really oil. Does it dominate on the growth side or on the inflation side? And again, I think there's a really healthy debate. I mean, we're talking about it this morning, 3 scenarios, not one. And so you're going to get really some volatility on the yield curve. I think the intermediate part of the curve probably looks the most attractive and potentially safest if you talk to our fixed income team. So again, I think It's premature to talk about a Fed easing because the oil hit takes down growth, just given what we've been. And the fact is inflation is not super high, but it's above target. And you have to reflect that in your timing, even if you're bearish in oil going much higher.
In the meantime, how isolated is the U.S. economy from the rest of the world? A lot of economists have come on and said that Europe faces a real problem, Asia faces a real problem. The U.S. is somewhat insulated because growth has been at a higher pace. You have the tech impulse. Is that sustainable?
It is. Again, it all depends upon where oil goes. What we would need to see to have really a downdraft in growth are really two things. It's not just the price of oil, which we all feel at the gas pump, but it's also the fact that we would need to see financial conditions really weaken. So the equity market here is actually the wild card. The equity market would have to start pricing in downdraft in earnings significantly so that it would pull back some of the business investment and high-end consumer spending. It would have to shake confidence of CEOs and on the consumer side to really, because those are the really two strong foundations for the U.S. economy, hence your point. So again, you would have to see that foundation really become rocky before we're starting to talk about Fed easing here.
Hey, Joe, it's good to see you. Thoughtful stuff and lots to think about. Joe Davis there of Vanguard on this economy and energy prices. Central bankers know what to do in extreme situation. When you hit extremes, central bankers will know what to do. If you gap lower on crude and you crash back down to 50, 60, opens the door to cuts. If you spike higher to 150, pushing 200, they'll start worrying about growth. Mike Gapon of Morgan Stanley will break this down for us a little bit later. If you persist at these levels, they're stuck and they don't know what to do. And we see this time and time again with the central banker. If you throw a recession at them, it's obvious what that central bank is going to do. You throw the middle ground at them, things get complicated.
Morgan Stanley, I'm glad you brought them up. They're the ones that say this $100 to $110 a barrel. That kind of range leaves rate hikes back on the table and potentially certainly no move from the Federal Reserve based on the ongoing inflationary pressure without that hit to growth. That, to me, is the most interesting situation, as Joe Davis said, and frankly, is one that this market is trying to grapple with.
Can we see a Federal Reserve that has to quickly hike rates to then get a growth shock and then unwind them, all while they have a leadership change at the top? I'm still confused about who will be running the Federal Reserve come May 16th.
You're not alone. Is it going to be Kevin Walsh? Is Chairman Powell going to be around for the rest of the year? Based on how things are trending right now, I'm not sure Chairman Powell wants to be around for the rest of the year, based on where things are headed.
Yeah, he would like to have this wrapped up. I think there is a sense of confusion about why there wasn't just an easy out taken so that we could resolve the subpoena, the investigation, and get on with it. Nonetheless, clearly the lack of clarity around the Fed reaction function adding to the volatility that we're seeing in bond markets and some of the messy auctions that we saw this week.
Yields up this morning by 2 basis points on 2s north of 4%, on 10s north of 440, with crude right now 110 on Brent, on WTI at 97. Coming up next, we'll catch up with Bob Michael of JP Morgan Asset Management, Tobin Marcus of Wolfe Research, the ECB Governing Council member Pierre Wunsch, and Sonal Desai of Franklin Templeton Fixed Income. The second hour of Bloomberg Surveillance is just around the corner as the uncertainty persists for global markets as the president extends talks for another 10 days between the US and Iran.
We'll really start to see that energy price shock feeding through in the March data. It could create some real challenges for the economy.
The central banks are in a tough spot.
They need to continue to focus, very closely on the data as it evolves.
I am concerned about the fiscal outlook.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action and scores look like this. Negative 0.4 on the S&P following the biggest one-day sell-off so far this month on the S&P 500. We sit here now at the lowest level since early September. Coming into Friday morning, the losses continue, down by 0.6 on the NASDAQ, and in the bond market, unlocking higher yields on 2s, 10s, 30s. New highs for the year. 446 right now on 10s. And in the commodity market, crude drifting higher. It persists, and it's persistence that we need to talk about. Brent crude at 111, WTI at 97. The president saying this: please let this statement serve to represent that I am pausing the period of energy plant disruption by 10 days to Monday. This market is not celebrating the removal of near-term escalation risk. This market is wrestling with the extension of uncertainty to Monday, April 6th, 2026.
This isn't a market that can embrace a taco trade, the so-called Trump always chickens out and he can reverse course, partly because he can't. This is a now multi-party conflict that's dealing with physical assets being shipped. It is the Strait of Hormuz, this key waterway, and a question of who's going to ultimately control this. And frankly, his discussion is coming, given the reporting that we have right now, with tens of thousands of troops lining up to potentially make their way. This raises a question of what it's going to take to de-escalate and whether the persistence has already gone on long enough to create some real damage.
That's a key point. 2 Marine Expeditionary Units are already en route. And on top of that, we have the 82nd Airborne Division that has already been deployed. And then on top of that, the Wall Street Journal this morning talking about the fact that the DOD is weighing whether or not to send 10,000 additional ground troops. So while the market is digesting the fact that this might be prolonged and the president's kicking the can in terms of these talks, at the same time, there's reporting that there is serious concern and discussions about the decision being finally made that this is actually going to escalate in a serious manner with more personnel on the ground.
Kicking the can does not provide relief anymore. Kicking the can for a market looking for a resolution is not going to provide comfort. When you kick the can, you're guaranteeing the strait will remain closed. You're almost guaranteeing that crude will hover around triple digits. And that's the additional scenario we're talking about throughout the program so far. We've been going back and forth on this. We've been talking about the two-way risk. It's resolved. Talks are a success. Or escalation. Things get a whole lot worse and you start hitting energy plants across the country, they retaliate across the Gulf. There's a middle ground. This just continues, lingers. The strait remains closed. You hold on to triple digits in crude and that causes its own problems.
It's not exactly a growth shock to the same degree that, say, $150 a barrel would be for the United States. It's not an all clear as going back to $65 would be. As Russ Kostrick of BlackRock said, and I think it was a really good point, nothing is working in this backdrop. There is no haven trade. It is not gold. It is not bonds. It is not stocks. It is not even, as we saw yesterday, some of the tech stocks. So what does an investor do with what looks increasingly like a stagflationary type of backdrop?
And Tehran did not take that Truth Social post as a moment to maybe have a reach out through the Pakistanis and say, yeah, you know what, we will come to the table. This has been challenging for us. Our entire top-level brass of individuals governing this regime have been taken out and targeted. Nope. What do you have today? You have missiles over Riyadh. You have the strait effectively once again closed. IRG starting back 3 container vessels in Hormuz this morning. They even made an abrupt U-turn. Chinese vessels made an abrupt U-turn, wasn't able to get through safely. At this point, Tanker Tracker says that at this rate, only 2 tankers a day on average go through the Strait of Hormuz. Far cry from the more than 100 a day we saw before this war.
Yeah, and these headlines from the Israeli Defense Minister from moments ago aren't going to help things. They're pledging to escalate and expand the attacks on Iran, saying the escalation would be in response to Iran targeting civilians. That's the escalation we're looking for. And as you've reminded us repeatedly, this is not just a war between Iran and the United States. There's other actors involved here as well.
It's Israel. It's the UAE, which came out with an op-ed in the Wall Street Journal saying, hey, this is getting really annoying to us. We want to offer some deterrence. You're getting Saudi Arabia involved too. This is a much more complicated backdrop.
Futures near session lows on the equity market on the S&P 500, negative here by 0.5%. Coming up on the program, we'll catch up with Bob Michael of JP Morgan Asset Management. With crude holding on to triple digits, the ECB Governing Council member Pierre Wunsch joins us on the potential for rate hikes, and Sonal Desire Franklin Templeton with the bond market on very shaky ground. We begin this hour with the bond market struggling as crude hovers near 110. Bob Michael of JP Morgan Asset Management writing central banks are all in a terrible position. Overall, the bond market continues to struggle to manage this inflation shock, and it's testing reaction functions. Bob joins us now for more. Bob, good morning.
Yeah, happy to be here.
Good to see you, buddy. And first of all, congratulations, Mr. $1 trillion man.
Yeah, thank you.
$1 trillion in AUM, and I know what a team effort.
Fixed income business is doing well.
That has been. Fixed income itself is not doing well.
Not today.
So let's talk about that. What's behind the shakiness and the fragility in fixed income?
Well, I think there are a couple things. I think, first of all, you're right. The bond market is pricing in the worst of all scenarios, which is the administration is desperately looking for an off-ramp, and there is none available. They're not going to cede sovereignty and control of the Strait of Hormuz to Iran. So if Iran doesn't give them a palatable off-ramp, then escalation is the only path forward. I think the second thing that the bond market is dealing with is we came out of the FOMC meeting a week and a half ago with the FOMC more concerned about the labor market than inflation. They had rate cuts still priced in for this year and next year. They were willing to look through it, and now you're hearing more hawkish tones coming out of the FOMC, particularly from Waller, who's right. It's not just about energy. You have to think about fertilizers, the planting season in the U.S. and across the world, and could that ultimately pass through to finished goods and prices?
We've caught up with your team a few times over the past few weeks, Kay, Priya, Kelsey. They've all said something similar, that we're unlocking value here in bonds, that yields are higher, that this should introduce demand. But we haven't seen that at auctions this week, and I think people have found that surprising. 2-year, 5-year, 7-year auctions, soft. Why do you think that is? Who's not turning up to these auctions that would typically turn up and buy these bonds?
Because things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Just stand out of the way. Keep positions that you're comfortable with riding through this. Let the market wash itself out. That's always been the best thing to do. And if it's at levels that you want to add to positions, then sure, go ahead and lengthen duration, add to a bit of credit. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for recession. So in the meantime, just let the markets go to wherever they're going.
Is it a trade, though, or is it a technical issue? With a question about some of the central banks, whether in Japan, whether in the Middle East, that are needing to raise money right now to support fiscal efforts, that need to do things like sell gold, as we've seen. Is that part of what's behind some of these auctions that have gotten somewhat messy?
I think it's a technical washing out of positions right now, that everyone got crowded into a few trades. The central banks would eventually be cutting rates. All you have to do is actually look at gold. This is the absolute ideal environment for gold. It's the safe haven, it's the risk off, and it's the inflation hedge. All of those things should have pushed gold up from, call it 5,000 to 6,000 if it were fairly priced. It was an overcrowded trade. There's exiting from overcrowded trades. You talked about the lack of a safe haven. There is one. It's Treasury bills.
Treasury bills, but not long duration. And this is, I find, very interesting, given the fact that a lot of people are saying that this is a Fed that's going to be more hawkish. The implication should be, if you have belief in the Federal Reserve, that that should lower inflation over time. That should reduce growth over time. That should reduce your appetite for longer-term bonds. Why is it not working that way this time?
Well, it is working because if you look at forward curves, the 1-year forward or the 5-year forward, actually, those yields have come down a little bit. So as more hawkish rhetoric has come out of the Federal Reserve, long-term inflation expectations are a bit more anchored than they were a week or so ago.
Inflation expectations, but not the bond yields. That's what I'm talking about. Is this sort of the fiscal response?
There is the painful path from here to there. The hawkish expectations lead to higher rates, which then dampen aggregate final demand a bit more, and that ultimately cools off.
Bob, you're talking about the recessionary level of oil around $120 a barrel. That's where the physical market is, well above that. At some point, Brent will potentially, if this is protracted, catch up. The futures market will catch up to that physical market, and that might be sooner than people expect. What happens then?
Well, the data we're going to see over the next couple weeks is going to give us a lot of information, particularly next week when we look at the labor market data, because it won't fully have the conflict priced into it. It will still be somewhat clean. And if it's softer, it's telling you that actually the labor market wasn't on firm footing heading into all of this. If you're a business and you're already struggling with trying to understand what tariffs you're going to pay, what the impact of AI is to your labor force, and you've paused hiring, now you have higher input costs and you're concerned about demand destruction. Are you really going to go ahead and do some hiring? Our expectation is it's already starting to bite in the real economy.
This all sounds super gloomy. Should we finish with some optimism?
Sure.
Torsten Slok of Apollo just published. Check this out. Markets are overreacting to what will likely be a 4 to 6 week period of volatility, which will ultimately result in 50 years of stability in oil markets, supply chains, and geopolitics. Torsten, just moments ago.
Yeah, the headline of this is sentiment destruction, not demand destruction. Always watch what they do, not what they say, given the fact that people are feeling so nervous since they have to go out and shop to make themselves feel better and travel a lot more. He talked about how this shock is not enough to eliminate the tailwinds to the U.S. economy, and that is the reason why so many people have said, actually, the U.S. turns out to be more of a haven right now in all of its assets because of that tailwind, because of its ability to still grow.
The tailwinds being AI spending, the industrial renaissance, and the one big, beautiful bill. Bob, can you envision a better world 12 months out? Looking back 12 months out, and just seeing this as a 4 to 6 week period of volatility.
I can see us getting beyond this at some point. We keep going back to 20% of oil passes through the Strait of Hormuz. Why didn't oil go from $60 to $72 a barrel? So Torsten's right. There's some emotion in this. Whether it's troops on the ground or there's some sort of peace accord, we'll eventually get to the other side of this. I don't know that I want to look out a year, but I'll look out into the midterm elections. I think no holds will be barred into the midterm elections. And what is that, 8 months away?
What do you mean by that, Bob? What do you think is going to happen?
Yeah, sure. I think when you look at the administration, they have to do whatever is possible to ensure that unemployment stays low. They've got to go back to affordability issues, particularly housing. You've got a new Fed chair sitting. You do have the tailwinds of the One Big Beautiful Bill Act. You do have all the CapEx because AI is real. Businesses know that. So you don't want to get too gloomy in here. That's why I said you just want to stay out of the way of this, see where it washes out. I think it's more technical than anything right now. Our bias is to add when we reach firmer footing.
It certainly feels painful right now with the 10-year at 446 and up another 5 basis points on the session. Bob, good to see you. And congrats once again. Thanks for being here. Bob Michael there of JP Morgan Asset Management on a very shaky bond market through the week so far.
Yeah, and he's talking about how it's a technical washout and that longer-term bonds are the haven. He talked about T-bills, not necessarily longer out the yield curve, not now anyway. Michael Hartman, I keep going back to this, expecting policy panic to support the economy heading into those midterms. I just wonder how much that's part of the reason why people don't want to go long bonds right now, if there's policy panic that comes in to flood the market.
If Bob's coming on the program and advocating for T-bills, you know it's a stressful moment, right? Certainly a stressful moment.
You know, you're also getting good yields, so I could understand it, and you are seeing some inflows into that area.
Let's get you an update on news elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well. Iran says it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. Israel not planning to wind down its military strategy against Iran. Defense Minister Israel Katz saying moments ago attacks will escalate and expand to additional targets and areas important to the regime. Katz saying he and Prime Minister Benjamin Netanyahu had warned Iran against attacking civilians, but the firing has continued. And here's another jab. JP Morgan is planning a new private credit fund that will allow investors to redeem 7.5% per quarter. According to the prospectus, the fund will invest at least 80% in credit, including a substantial portion in private credit as well as publicly traded loans. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, making time for a deal.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to. All I can tell you is they're begging to make a deal.
We'll talk about that next with Tobin Marcus of Wolf Research, live from New York City this morning. Good morning. The self-imposed deadline has been extended. Diplomatic efforts continue between the US and Iran, we're told. That continues, and this continues too. Equity futures on the S&P 500 pulling back by 0.5% on the Nasdaq, down by 0.6%, adding to some big losses yesterday, the biggest one-day loss we've seen so far this month. The S&P 500 closing yesterday at the lowest we've seen since early September. In the bond market, that risk aversion, unlocking higher yields, not lower yields. The source of the disruption in the bond market, around 4% on twos, 446 on 10s, pushed higher by this move in crude. The move persists, triple digits. Brent crude, 111. WTI, 97.
And you've heard a slew of central bankers come out and say they are worried about inflation. They have to be vigilant, and they have to get inflation back down to 2%, given that it has been more than 5 years since we've hit that target. We're repricing a Fed response function. We're repricing the ECB.
It's a lot of uncertainty hanging over this market through to at least, potentially, April 6th. Under surveillance this morning, making time for a deal.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit. I don't look. Their capability is a lot less than it was 2 weeks ago, and with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
The President of the United States extending talks with Iran for 10 more days. The President saying talks with Tehran are going very well. Jonathan Tamari of Bloomberg Government joins us now for more. Jonathan, welcome to the programme. We're tracking two things. One, the talks, the status of them, and two, troop movement. Jonathan, what do we know about both this morning?
Yeah, the state of the talks, it depends on what you're listening to publicly, privately. Publicly, Iran says that there's not progress. The president says there is, that they're desperate to make a deal. Obviously, both sides are posturing there. And yes, there are reports that there are additional troops now moving into the region. And there's a lot of concern within Congress, I would say, about what that means, given that Congress has had really no say on this fight so far. And the addition of ground troops would be a significant red line, I think, for a lot of members of Congress, including some Republicans.
Do you think they're in a position to stop it?
Not right now. And in fact, they're about to be away for 2 weeks. And there's a concern among some lawmakers that while they're away on a scheduled recess, the president could escalate things and Congress would really be in no position physically to take action.
The calendar is not friendly to risk assets right now. Bloomberg's Jonathan Tamari there with the latest on the situation following two tracks, the status of talks and the status of troop movements.
Yeah, and people are watching those troop movements very closely. We talked earlier about that Wall Street Journal report. Congress, you think that they're going to actually step in here? They haven't even been able to make a move on TSA. I mean, that was superseded also by President
They're not
Trump.
there, even when they are there.
They're correct. Thank
Right?
you. Even the vote last night, it was basically empty last night in the chamber when they voted at 3 a.m.
Yes, and it was just basically, yay, let's get the show on the road and let's make sure TSA is funded. That exchange I had yesterday with the president, he said that their capabilities have been decimated, but it hasn't changed the facts on the ground for the Strait of Hormuz. Every single day, according to tanker trackers, we're just at 2 vessels getting through on average since this war started, and tomorrow will mark 1 month. Before the war, it was more than 100, which is why the physical market is so much higher than what we're seeing in the paper market.
We've seen the damage done to some of the energy assets in the region. It's going to take time to repair them. And we know that when you shut in production, the longer you shut in production, the longer it takes to ramp it up at the other side. So we know this is going to go on for another 10 days and the market is responding to that lingering uncertainty. Tobin Marcus of Wolf Research writing this: we don't think either side has reached the limits of its pain tolerance. The president thinks the US is winning and the Iranian regime thinks they're winning too. Tobin joins us now for more. Tobin, where does that leave us?
I think it leaves us in largely the same dynamic that we've been in, where the president faces options to escalate, to try to de-escalate, which he's doing now, or just to stay the course. I think all of those have downsides from the U.S. perspective. And I think anything other than, a surprising diplomatic breakthrough that we don't expect is going to perpetuate and intensify stress on markets.
Tubin, the Wall Street Journal also has that Iran, this requested 10-day pause on strikes, was not coming from Iran. Iran never requested this the way the president presented it to the world. What do you make of that? Is the president negotiating with himself? Is he just buying time as he has this troop buildup?
Yeah, I mean, what we were saying prior to the announcement of this extension earlier yesterday was if we do see an extension, which seems like a very real possibility as we were approaching the end of that 5-day period, which the president himself speculated about the possibility of an extension during the cabinet meeting yesterday, that if that were to happen, it would reflect basically that the U.S. wasn't ready to choose between to decide whether or not to undertake one of these decisive escalation options, rather than representing real, progress behind the scenes. And so I think characterizing it as having been demanded by the Iranians, even when the reporting contradicts that, largely lines up with that theory. So, maybe it's a very specific smokescreen for planned escalation, and he's waiting for more assets to get into the region. There's been lots of commentary about the first Marine Expeditionary Unit scheduled to arrive today, but there's more on the way. There's airborne troops on the way. So we could still be positioning for a definitive escalation plan, or he could just be buying time. If he's not ready to pull the trigger on either strikes on electrical infrastructure or one of these mooted ground operations, then, you can always kick the can down the road.
You have a new tongue-in-cheek alternative to taco, and you say it's a kebab. Kinetic escalation before abruptly backing off. What kind of kinetic escalation could we see?
I think the kinetic escalation that we had in mind when we came up with that kebab idea was what we've already seen, right? That we undertook this war. It's been, very high intensity so far. And then at some point, chickening out, I don't think is a great characterization of anything that's gone on here, but that at some point you could see the president try to just de-escalate. Notably, as people talk about, taco and the strike price of the Trump put and so forth, the one thing we haven't actually seen him do is make any actual move to de-escalate. We've seen him, open talks. We've seen him talk about talks, but those are all an idea that he might de-escalate if we see big concessions from the Iranians that there's been no indication that they're willing to make. What he hasn't done is actually reduce the intensity of U.S. strikes, actually, undertake a unilateral ceasefire and see if the Iranians respond in kind. And so I think, going back to the comments earlier about whether or not the two sides are at the limit of their pain tolerance, if we actually start to see the president in more of a panic about the market and economic and political backlash, which I don't think he's in right now, that option is still available of actually trying to de-escalate, short of, telling the Iranians essentially that we're ready to accept their unconditional surrender, which has been the U.S. message so far. And I don't think that surrender is in the offing.
Tobin, if this continues for weeks and possibly even months, how big is the blue wave going to be in come November?
So I think the kind of elasticity of political outcomes to how this goes is relatively low. The House, I think, is basically, foregone conclusion to flip Democratic, and we've thought that for quite some time. The Senate, betting markets are now starting to believe in a blue Senate. I personally don't really. I think it's a real long shot for them in these 4 red states that they would need to win 2 of: Alaska, Iowa, Ohio, and Texas. Those are all big reaches. And so I think we're in a universe where, even as the political situation deteriorates, as the war continues, as gas prices go up and so forth, there's not that many more seats you can lose in the House based on the way the maps are drawn, and similarly in the Senate. So if I'm President Trump, and I suspect that there are people around him telling him this, if the House is lost, the Senate's not that losable, that does give him room to have the courage of his convictions. If he thinks that this is a generational problem that he can, either substantively or as a way to kind of enshrine himself in the pantheon of American presidents by dealing with this, I do think that has some appeal looking past the midterms.
Tobin, it's good to see you. Thanks for catching up with us. Tobin Marcus there of Wolf Research. On the sentiment shock, you, Mitch, consumer sentiment coming a little bit later on this morning. Look out for that number. Might not be pretty. Up next, ECB Governing Council member Pierre Wunsch on Europe's path forward. Equities declining here near session lows. We're down by 0.4% on the S&P, on the Nasdaq, negative 0.6. The losses yesterday, notable. The biggest one-day loss we've seen since this war started. But one thing that hasn't been talked about enough, it's not just about the Middle East. There's something else happening here. It's also about tech and tech names. Microsoft having a really difficult go of it, down by 30% from the highs of last year. Meta down 15% this month, hammered yesterday. The Nasdaq 100 basically in correction territory.
It's down about 10% from its recent highs, but the idea that it hasn't seen a new high going back to 2025 gives you a sense of just how far we've fallen. They've lost their leadership. What does it mean at a time when we talk to a lot of investment managers saying that big tech is the haven, that we are not seeing that actually play out at a time of stress?
We've thrown so much of this market, tech problems, the Middle East, private credit, and bond yields just squeeze higher, making everything worse. Tighter financial conditions, yields up by 4 basis points, 4.45 on 10s, 2s around 4%. The president removing near-term escalation risk, but introducing longer-term uncertainty with 10 days of talks.
Especially because oil prices still are around that $100 a barrel, presenting a quagmire for central bankers. Do they hike rates? Do they keep rates where they are for a prolonged period of time, even as you do get some demand destruction? And you talk about how you do have financial conditions tightening. They're not tightening very quickly, but around the margins, just steadily increasing, with mortgage rates hitting their highest levels so far this year.
Going into spring salad season, which isn't welcome news for a lot of you working in the housing market, I'm sure, and if you're looking to sell your home or buy a home, of course. In the commodity market right now, Brent crude, Brent 110, WTI 96. It's the persistence of this story that is going to cause problems, that the Strait of Hormuz remains closed.
Absolutely, and there's a note from Macquarie today that if this goes on till June, which at this moment, potentially you could see the strait not being operational in the normal way. This can go on till June. You're looking at $200 a barrel. Caught my attention this morning, Qatar Energy. Force majeure for liftings through May. This is liquefied natural gas that the world is really relying on, especially Europe and Asia.
Stocks are softer this morning. We're negative 0.4% with some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. AstraZeneca this morning up 3.6%, releasing the results for a treatment of a deadly lung disease. That result showed that it was able to target improvement for the deadly lung disease. Bloomberg Intelligence saying that this would be a $5 billion addressable market for AstraZeneca. So shares, again, rising in the pre-market. You mentioned the tech, you mentioned the big cap, but it's also software, which continues to get hammered. The blame was originally put on that Google announcement of compressing the need for memory, but the pain has really continued. SanDisk and Western Digital and Micron all down at least 2.3%. SanDisk is down 15% in this week alone. It's also up 1,000% over the past year. So some of those gains coming off. Now, finally, wrapping things up with some deal news. Brown-Forman, those shares moving unchanged at the moment. This is the maker of Jack Daniels. They announced it as a merger of equals, which tends never to actually be the truth. But with them and Pernod Ricard, they're both heavily family-owned businesses. According to people familiar, this deal would involve a lot of stock. So those owners can keep control. So Brown-Forman, one to keep an eye on, but unchanged at the moment, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, President Trump announcing an executive order bypassing Congress to pay TSA agents during the partial government shutdown. This morning, the Senate approving a bill funding most of DHS. A House vote is expected later on today. Elsewhere, the president extending his deadline for striking Iranian energy sites for 10 days. Trump writing in a post on Truth Social, talks are going, quote, very well, even though Tehran insists it's not negotiating with Washington. And finally, the Secretary of State Marco Rubio calling on NATO allies to step up and do more to help secure the Strait of Hormuz.
There was a couple of the leaders in Europe who said that this was not Europe's war. Well, Ukraine is not America's war, and yet we've contributed more to that fight than any other country in the world. Very little of our energy comes through the Straits of Hormuz. It's the world that has a great interest in that, and so they should step up and deal with it. They should be doing something about it.
The Secretary, Marco Rubio, meeting with G7 foreign ministers in France today.
A polarizing message right now, and you hear, for example, UK Prime Minister Keir Starmer saying he's only going to harden his stance against joining this in any capacity or even opening up certain regions to U.S. troops as a result of pushback. Mark Rutte, the head of NATO, facing huge pushback among some of the other nations after going on CBS's Face the Nation over the weekend and saying Trump is doing this to make the whole world safe, saying what the president is doing here, which is taking out, degrading Iran's capability to be, again, an exporter of chaos, sheer chaos to the region, to the world, saying this is a fight that NATO should join.
I think two things can be true at once. Rutte is right. The Iranian regime is the biggest state sponsor of terror, and it doesn't help anyone in this world if they were to get a nuclear weapon. At the same time, I think the Europeans might be even emboldened by what J.D. Vance said last year. I can't get over this. J.D. Vance gave an interview, the vice president, and said the Europeans, maybe if they were a little bit more independent, if they weren't just a vassal of United States foreign policy, maybe they would have stuck up instead of going into the Iraq war with the United States, which J.D. Vance called a strategic disaster, the American-led invasion of Iraq. So you can have some capitals in Europe not really getting on board with wanting a more protracted environment and maybe getting engulfed in this sort of conflict. And that was his message just a year ago.
We've seen that pushback this month alone. Let's talk about Europe. Global central banks facing the threat of higher inflation as energy prices soar. The ECB navigating mixed signals with some policymakers ready to act fast, others urging caution. Joining us now to discuss is an ECB Governing Council member and the National Bank of Belgium Governor, Pierre Wunsch. Governor, welcome to the programme, sir. Let's just start with the nature of this shock. From your perspective, is this the kind of shock that a central bank should look through?
Well, that's, of course, the big question, and we know the textbook case is for looking through for if you're confronted with a supply shock. Now, in the meantime, we have the episode of 22, and in 22 we were a little bit late in reacting. We had team transitory, we're not alone. I was maybe one of the first governors to be concerned about the fact that the inflation might go up further than what we had in our models. So now we are there. We have, again, a supply shock, and we have to decide how to react to it. We should not overreact. I think so far we were able, I think, to communicate the fact that we would react if need be, but that we were not going to rush to do anything that would be looking like overreaction. But anyway, I mean, we have to. 22 is different. We have the textbook, and we need to find a middle way between what we have in the textbook, which is we don't react, and the experience we had in 22. But in 22, of course, there were a lot of bottlenecks in the system, very tight labor markets. You had a lot of fiscal support coming out of the COVID crisis, and that's not the situation we're in today. The labor market is a bit weaker in Europe. So we will have to find a good balance between the textbook situation and, again, what we experienced 22.
Governor, does that give you more time? Does that give you more time? And is April too soon to know what kind of shock this is, to understand if you should look through it or react to it?
Well, if the conflict is mainly over by April, then I guess we will be closer to what we have in our baseline. We had just made some projections during the last meeting of the Governing Council. I think the base case that we produced was still relatively benign. Inflation was moving to a peak of 3%, but not on a yearly basis, and then going down quite quickly to 2%. On the basis of that, it's not clear that a reaction would be warranted. Of course, we were doing the projection on the basis of 2 hikes that were priced by the market. But I would say, if we are still close to the baseline, that it's not clear we have to react. If we move to what we call the adverse or the severe scenario, then we have higher inflation and certainly more persistent in the case of the severe. And then my guess would be that we would have to do something. But even then, I think we need to make a distinction between reacting so that real rates remain stable, or reacting and increasing real rates. So if you believe that core inflation is going to go up for a period over a year, you may want to react, and the first hike might just be adjusting to this higher core inflation. And then there is a stage, if the shock is bigger and you have significant second round effects, which is, of course, a big part of the uncertainty, where you might have to tighten as such. And I would still make this difference. Hiking as such, if core inflation is going up, might not be tightening. And I'm not talking about, spot real rates, but say over a period of 1 or 2 years, depending on what our view of the world is.
Governor, it sounds like you're more patient potentially than some other members on the ECB. I'm thinking, for example, of a recent interview that ECB President Christine Lagarde did with The Economist yesterday, saying that the ECB would have to respond in a forceful or persistent way if inflation looked set to sit well above its 2% target for an extended period. Most people would agree. But she said even a more modest overshoot could call for a measured rate move. Do you agree with that? That if inflation does not look like it is poised to go down to 2%, say, by the end of this year, that it makes sense to signal to markets that you're serious about containing inflation by making a hike?
Well, if I gave the impression that was not aligned with Christine Lagarde, I'm sorry for that, because we are completely aligned, or I'm aligned to her with her view. But I was just discussing the case where by the meeting of April, the conflict would be over. And then, honestly, it's still something that is probably relatively benign, and we might have to react or not. But that's not, a difficult situation probably to deal with. My concern is, of course, and the concern of many people and of the market, is that it would not be over by April, or maybe not even over by June. What I would like to have is a better mapping of the scenarios that we're making to actually the conflict lasting until April or until June, that we have a better mapping of our scenarios and basically the meetings of the Governing Council. But it's moving fast. So one meeting is April, another meeting is June. If the conflict is not over by June, then we are, most probably way above our baseline. And that would probably warrant some kind of reaction.
Governor, do you think that the ECB is hamstrung by the fact that it is a single mandate Fed dealing with an inflationary shock that the Fed looks like it's currently prepared to look through, given that there is a serious growth hit on the other side that is potentially going to transpire?
Well, in a way, it makes it easier because if you have only one objective, you only look at one target. But we always insist that we have an objective over a medium-term horizon. So we do integrate the impact of the shock on growth, and to the extent that the impact of the shock on growth would be to some extent deflationary. I don't think that's the base case, but of course we would have to take that into account. But it's taking into account the impact of the shock on the real economy and then the repercussion in terms of whether we're going to be faced with second round effects or not. If the economy weakens fast, then the second round effects might be limited, which might warrant less of a move. And the big uncertainty is, of course, the labor market and the economy is less tight than it was in 22 coming out of the COVID crisis with all these bottlenecks in the system. But economic agents were surprised by the pickup in inflation. We had known a period of low inflation for a very long time. So people reacted as much as we did in a way slowly to the inflation developments. The big thing now we have to monitor is whether economic agents, firms, and then workers will adapt more quickly this time to the shock. If this is the case, it might lead to second round effects that will be quote unquote higher ceteris paribus compared to the level of the shock. If because of weaknesses in the economy and the labor market, firms and then workers don't react fast and basically take the hit, then the case for reacting is less strong.
Governor, just a final question. Listening to you to recap, what I hear is patience. The prospect of two different scenarios with different responses. What I see in markets, though, is tighter financial conditions, a market doing the work for you already. Higher yields on government bonds, pricing in the prospect of rate hikes from the central bank over the next year or so. When you look at that, do you consider that an unwarranted tightening of financial conditions, given the patience that you've pledged this morning already?
Well, I'm patient today, but in April, if we're still there, I might not be patient. So I don't want to convey the message that we are not ready to act. But I'm comfortable with what I see in the market. But given the uncertainty is huge. So, making any judgment today on what we can do in April or June, given the uncertainty, the market signals or reaction will be different next week and the week after next. We have to monitor that. We have to at least, we should not overreact. We are not going to control the first round effect of this shock. So we should not even try to control the first round effects. So in this sense, we have time to react adequately, depending on what is our perception of what the second round's effects will be. But April is not out of the question. If by April we have solid evidence that the shock will be lasting and will lead to a big hike in inflation that is likely to have some degree of persistence, then we might have to do something. But we still have some time before the April meeting, and I don't want to take any bet in one or the other direction.
We are all flying blind, sir. We appreciate your time. Governor, thank you. The Belgian Central Bank Governor there, Pierre Vergne, on the situation in European debt markets and in European rates.
Stephen Englander over at Societe Generale, Standard Chartered, came up with this line in a recent paper. FOMC Powell likely to aggressively do nothing. And it seems like right now ECB officials want to aggressively not take a position because they don't want to give a signal that could potentially be committal at a time of so much uncertainty.
They want to commit to anchoring inflation expectations, but they don't really want to be hiking interest rates here. That's the delicate dance for communication into the next round of meetings.
Given the lack of growth in terms of the backdrop and the potential hit to inflation longer term, it's a difficult time for them, and you can hear that.
Let's give you an update on news worldwide with some top stories. Your Bloomberg Brief, Yahira has more. Hey, Yahira.
Hi, John. The Senate's passing a bill to end the Department of Homeland Security shutdown. The bill still needs to pass the House and be signed by President Donald Trump. Before the bill was passed in the Senate, the president had said he would sign an order to pay TSA officers. A legal victory for Anthropic, the maker of the chatbot Claude, winning a court order blocking a Trump administration ban on government use of its AI technology. Anthropic argues the ban could cost it billions in lost revenue. And Apple giving rare bonuses to iPhone hardware designers. Sources telling us here at Bloomberg the company gave bonuses worth several $100,000 to many members of its iPhone design team. The company is hoping to stem a wave of departures to startups like OpenAI. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara in the next hour. Up next on the program, keeping the pressure on the Fed.
We have a great new person coming in to take over the Fed. Kevin may not ever have an office, but they don't sue the guy whose interest rates are too high. We call him Jerome Too Late Powell.
We'll spend some time on that in just a moment. Sonal Desai of Franklin Templeton joins us next. So we're recovering just a touch. We're off the lows. We're negative by a third of 1% on the S&P. We're down 0.5 on the Nasdaq. On the Russell, we're down 0.4. In the bond market, shaky. Yields bleeding a little bit higher at the long end of the curve, tens around the highs of the year. Under surveillance this morning, keeping the pressure on the Fed.
We have a great new person coming in to take over the Fed. And Kevin may not ever have an office, but they don't sue the guy whose interest rates are too high. We call him Jerome Too Late Powell. Janine Pirro, working with Pam and others, has the courage to sue to find out what happened to maybe $4 billion and a building that may never be occupied by Kevin. We're going to have to find him some space in the White House. We'll put him in the basement of the ballroom.
So here's the latest this morning. The president continuing his push for lower interest rates as the confirmation of Fed Chair nominee Kevin Warsh remains on pause. Sonal Desai of Franklin Templeton writing, even before the current shock, I was not expecting any more cuts, but it is too early to forecast rate hikes. Sonal joins us now for more. Sonal, welcome to the program. I know so many people in fixed income itching to get long duration because yields have backed up, but they're nervous. What are you advocating for?
So, we came in, thanks for having me on, Jonathan, but we came into this year actually a little bit short, and we are moving slowly towards neutral, but I am not tempted to go long yet. This is essentially, when we talk about the two, it's either a bimodal distribution or more accurately, there are two tail risks, and we certainly can't predict which of those tail risks comes to fruition if either one of them, i.e. a very protracted conflict or a very short conflict. You can't actually position your portfolio to either one of those two tail risks.
Sonal, forgive me, I keep harping on this one topic. Why are long end bond yields rising right now? And I look at inflation expectations in the break-even rates market. Long-term inflation is not ticking up. If anything, it's going down. This is a real rate move at a time when people are looking out to the potential of a decline in growth. Can you explain what's going on currently in the long end of the yield curve?
To me, actually, what the market is doing is really rational. It is anticipating that, yes, there may well be a decline in growth, and the response to that decline in growth is going to be massive fiscal easing. Your prior guest from the ECB, he only spoke about monetary policy. He didn't mention what the probable fiscal response would be if this were to be a protracted conflict. There isn't a government in the developed world which will probably not react by trying to accommodate some of that weakening through a greater fiscal push. So I think that bond markets are actually behaving pretty rationally right now.
Do we think that we're pushing up against the limits of using a fiscal lever to offset weakness based on the pushback that we're seeing right now from the bond market?
So it depends. Well, that's a useful statement. I don't think we're getting to a limit, okay? Because here's the thing. There is an enormous amount of liquidity floating around globally. There is the ability to finance more bonds. However, at this point, clearly the market is not accepting that the yield is an adequate compensation for the prospect of higher inflation and higher bond supply. But you do find a market clearing point. So how much can fiscal do? Even automatic stabilizers by themselves will lead to widening fiscal deficits. So, the fact that unemployment goes up, so unemployment benefits go up. And so you will have a widening in the event of a significant slowdown. And I think there's a big difference between what's happening in Europe, as I think you've mentioned yourself, versus what's happening in the US. But in the US, for a whole host of other reasons, we're looking at fiscal profligacy as we've never seen before. For the last 5 years, we've seen it, and I see no indications that this is going to go away anytime soon.
So now, what you just said there on fiscal, I think is really important for multiple reasons. Here's one. Do you think it increases the odds that we'll see second-order effects if governments step in and try and support consumers in this moment?
Oh, in terms of inflation?
Yeah.
Yeah, because actually it was the opposite way around. If you think back to the famous transitory period of 2021, what was really going on in 2021? We did have very easy monetary policy, but the reality is we had an enormous fiscal splurge in the first quarter of 2021 as a new administration came in. It was absolutely enormous. And so back at that time, to me, it appeared absolutely self-evident that you were going to get demand push inflation, which the Fed kept saying was a supply side impact. And eventually, of course, we got the results we got. If you do get that fiscal accommodation of a shock of this nature, you will get second-round effects. Ultimately, let's take an extreme scenario. Let's suppose that we really are hitting and taking out not just 20%, but oil facilities, say, in other parts of the Gulf, which is responsible for 30% of global oil supply. Supposing you actually do something much more terrible, which leads to a several-year contraction. You can't accommodate it because ultimately you need demand destruction, which translates into slower growth. And if they try to not do that, that's a problem.
Sonal, appreciate your time. Thank you. Sonal Desai there, Franklin Templeton. Of course, this shock is hitting just as tax refunds are hitting as well.
That's the tailwind that Torsten Slok is talking about that will leave us in a bullish place at the end of the year.
Up next, Mona Mahajan of Edward Jones, Carly Hohu of Jefferies, Michael Gapin of Morgan Stanley, Ajay Rajadaksha of Barclays. The third hour of Bloomberg Surveillance just around the corner.
We're at a world now where there's heightened uncertainty.
If we have a peace deal, then we could have a relief rally in markets.
The market has been volatile during this period, but not a tremendous amount of downside yet.
The market is pricing in that there's going to be a resolution.
We are going into an area of really uncharted waters at this point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your price action looks like this. Off session lows, but no bounce. The absence of a bounce here notable. Equity futures down by a third of 1% on the S&P, on the Nasdaq down by 0.5. Negative follow through following the biggest one-day loss of March so far. In the bond market, yields 2s, 10s, 30s higher on 10s, up 5 basis points. A new high for the year, 446 is where things stand. Off the back of this, crude. The problems persist. Triple digits, 111 on Brent, 97 on WTI. With this statement from the President of the United States, talks won't wrap up in the next 24 hours. You'll have another 10 days. New self-imposed deadline, April 6th. The market take, the problem persists.
Ultimately, as you've said many times, we don't have clarity. I would take this a step further. There is a real signal right now that's coming from the markets, which is that the power of truth social diplomacy is losing its clout. We are looking at a market that doesn't see any easy resolution to this, and it isn't one man's decision to ratchet the temperature down and solve things. That, I think, is the takeaway from this week.
These aren't paper problems that you can solve with verbal intervention. They are physical problems. Jeff Curry of Carlyle talked about it multiple times on this program. You cannot print the barrels. You cannot print the molecules. You cannot reopen the Strait of Hormuz through talks alone. If they continue, by definition, it is closed. That's the situation. And as that problem persists, the problems keep building.
I think you need to look at action in the region and not words. And what we've seen just this morning, action in the region, you're seeing missiles across Riyadh. You're seeing the IRGC not let vessels through the Strait of Hormuz. You're seeing Chinese vessels. China buys the lion's share of Iranian crude that was before the United States decided to unsanction some of it that's on the water. They had vessels going through and made an abrupt U-turn. The facts on the ground and the reporting that the president is even weighing potentially sending 10,000 more troops show that this is going to be longer and this might be protracted. And that is why the markets are starting to wake up, that you cannot, as you say, taco your way out of this.
We have replaced the threat of near-term escalation risk and introduced the persistence of long-term uncertainty, at least for the next 10 days or so. And we're tracking two things. One, not just the movement of talks and the diplomatic effort, but two, troop movement. This from the Wall Street Journal. The Pentagon looking to send up to 10,000 additional ground troops to the Middle East to give President Trump more military options, more uncertainty.
Let's go back to the conversation that we had with Colonel Sanders from Bloomberg Intelligence earlier this morning, where he said, this seems like a significant troop buildup, but when you compare it to the Gulf, you saw more than 600,000 troops deployed to that effort. That said, it indicates a potential ratcheting up, and it comes alongside the fact that the UAE and Saudi Arabia both are being vocal about, hey, you better not pull out now and leave this as the status quo, because you're giving Iran a lot of power over one of the main waterways of the world.
That's why this doesn't look to be a garrison. This doesn't look to be permanent troops on the ground. Strategic. Can they go in there, these individuals, highly trained to do things like this, to capture islands, to open up waterways? But can they go in there and fix this in a short amount of time? And the Iranian parliament is talking about, even if this becomes open in the future, there's now going to be a toll. They've effectively said, we have demonstrated we can control this strait, and we are not going to give up that leverage.
Brent crude this morning, right now, very close to 111. Coming up this hour, we'll catch up with Mona Mahajan of Edward Jones. With diplomatic uncertainty hanging over markets, Michael Gapin of Morgan Stanley still calling for 2 rate cuts this year, and Ajay Rajadaksha of Barclays on the widening cracks in the US economy. We begin this hour with stocks adding to losses as traders brace for a protracted war. Mona Mahajan of Edward Jones writing, while market volatility may persist, this may also provide opportunity. We prefer US large cap and mid cap equities, emerging market equities and cyclical sectors, including industrials. Mona joins us now for more. Mona, welcome. We face what we've called all week substantial two-way risk, and that two-way risk will hang over this market now until at least April 6th, guided by the president's self-imposed new deadline. Mona, what are you advocating for between now and then?
Yeah, John, look, this has become a show-me story, and it's not only about updates on negotiations with Iran, it's really about what's happening in the Strait of Hormuz and what's happening with oil prices. And markets are almost indirectly correlated with the move in oil. We see higher oil prices this morning. We see lower futures, despite the 10-day pause or extension in the negotiation itself. So, generally, we are waiting to see what the duration of this conflict and especially of the elevated oil prices will look like. If you look at WTI futures markets, markets are still pricing in oil returning to mid-70 levels by year end. So if this conflict does remain contained, we think the spillover effects can remain contained as well. Now, there's a probability around that. That's a base case scenario, but there are tail risks on either side.
So, Mona, that's the story. Let's talk about the price of the story a little bit more. Equities on the S&P 500 down almost 6% so far this month. So far this month on a 10-year maturity, yields higher by some 50 basis points. Is the risk-reward right now more attractive in stocks or in bonds?
We still see a compelling stock or equity story ahead. Look, this is still an environment where we think the economy is going to be positive this year. Economic growth, we still think, can hover in that 2% range. And importantly, the earnings story, we think, is still intact. And keep in mind, parts of earnings, think about the energy sector, will see some benefits from a rise in oil prices, although parts will not. Margin compression is a very real story there. But what's important in the U.S. is we have this underlying secular theme of AI technology and CapEx spending. And that, to us, will continue to be a driver. We think earnings growth can be high single digits, low double digits still for 2026, and that provides some underpinning to the stock market.
The tailwind comes from big tech, and yet we've seen big tech of late not outperform. It has lost its leadership through most of this year, and we've seen this sort of cyclical rotation into some consumer-facing names. Can that kind of trend persist, given a backdrop of higher oil prices and stickier Fed policy rates?
Yeah, it's interesting. Certainly through the Iranian crisis, we did see a bit of a pause in that broadening cyclical story. And in fact, a return to maybe a little bit of what are considered defensive parts of the market. And technology and AI was part of that, partly because they had already seen a meaningful correction sell-off prior to the crisis, and maybe folks were looking for entry points again. But keep in mind, these are companies with tremendous balance sheets still, and can be considered relative safe havens in this environment of uncertainty. So we do think that the tech AI story is still part of a diversified basket for investors, and it does come to the forefront in times of uncertainty like this. And certainly, as we think of an environment where the US dollar is rising, there are winners and losers there as well. But overall, we think the diversification is going to be an important part of the 2026 story, unlike the last 3 years where it was very much about concentrated portfolios.
John was asking Mona this idea of what you like better, bonds or stocks here. You said stocks. At what point does the rise in bond yields pressure the stock story based on the fact that it's really come from real rates, and usually that does crimp potential for multiples?
Yeah, look, we are looking at, we called for a 4.5% range on the 10-year Treasury. As we get perhaps above that, or if we do get above that, we would start to look at duration more meaningfully. Keep in mind, when we think about a Federal Reserve and what they might do going forward, we still don't see the potential for rate hikes on the horizon. We do think that this is a supply-driven shock. If oil was rising because demand was overheating, then yes, rate hikes could make sense. But very much this is, supply shock, and a rate hike in this environment probably won't help that problem at all. So we think the Fed is on hold here, but we do think over time, and they indicated this still in the meeting last week, they are looking at 1 to 2 additional cuts in this cycle as well, which of course is broadly supportive. So we are looking at still, if bonds get above that 4.5% range, we'd consider that more interesting here.
Mona, though, if this is a protracted conflict, do you think the Fed would be able to cut interest rates?
We certainly think in the scenario that this is, the tail risk emerges and this is protracted, deep, prolonged, then we do start to think about a market that doesn't look as strong, that earnings growth does fall more meaningfully because consumers are pressured and corporate margins are pressured, especially those corporations that have energy needs. And in that environment, the Fed is likely to cut, but cut for the wrong reasons, which, we don't want them cutting because they see an imminent downturn or recession in the economy. If we do see rate cuts, we'd like to see them because they want to neutralize the Fed funds rate a bit more, and they're too restrictive at this point. So, in this scenario, historically, when we look at the Fed and what it means for markets, when the Fed is cutting because the economy is faltering, markets actually don't react as well. When the Fed is cutting because they're neutralizing, markets actually prefer that environment. We're hoping for the latter.
Mona, good to see you. It's good to catch up. Mona Mahajan there of Edward Jones. This is the communication dilemma for a central banker right now, whether they're in Europe or the United States. What they want to communicate and what they actually want to do, two different things. They know they have to pledge to anchor inflation expectations. And because of that, they can't invalidate market pricing, which is pricing interest rate hikes, particularly in a place like Europe. But they definitely do not want to be hiking into an energy shock right now or anytime soon. There is a real reluctance, and I think you can sense that from what you hear from some of these officials at the moment.
You mean the ECB banker who said absolutely nothing?
Without a doubt.
Ultimately, you're going forward.
Brutal, yes.
But they're aggressively saying nothing, and that's on purpose. That's a policy decision, given the fact that ultimately, to your point, if you've got tightening financial conditions, that will crimp growth and potentially curtail the potential for inflation, both in real terms as well as in expectations.
We talked about it briefly earlier, and I'm looking forward to this conversation with Mike Gapin over at Morgan Stanley, because they've broken out 3 scenarios, not 2. And we've been talking about it around this table that essentially the market's focused on 2, the prospect of much higher crude prices or the prospect of much lower crude prices. But there's a middle ground. And the middle ground's more problematic for this Federal Reserve. And I think for any central banker, central bankers seem more comfortable at extremes because they know what to do and they can do it with confidence. If you get a major recession, you throw the kitchen sink at it. And I've always said I don't think that's particularly brave or impressive because you know exactly what you need to do. It's moments like these that are really difficult to understand, to know what to do. And Mike Gapen's work on that, we're going to touch on it later, is pretty interesting.
Especially because they did give a three-pronged scenario, and they said that the one that presents itself to central bankers as giving the most reason to hike is the one that we're in right now.
The 110.
The 110 rate. That is actually this uncomfortable situation that could prompt a Fed or an ECB to raise interest rates.
That conversation just around the corner. Look out for that. Let's get you an update on news worldwide with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump pushing back his deadline for a deal with Iran, saying he will pause attacks on the country's energy sites for 10 days. Trump also saying talks with Tehran are going, quote, very well, but Iran says it's waiting on a response from the U.S. after rejecting its peace plan and offering its own conditions to end the war. Israel saying it will step up strikes against Iran despite President Trump's delay. Defense Minister Israel Katz saying the attacks will escalate and expand to additional targets in areas important to the regime. Katz warning the Islamic Republic will pay a, quote, heavy price. And China has launched investigations into U.S. trade practices. It follows similar moves taken by the U.S. against China that the Trump administration launched after his tariff agenda was upended by a Supreme Court ruling. It comes days after the White House announced President Trump will travel to China in mid-May. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. Up next on the programme, the Morning Calls, plus Carly Coho of Jefferies with the war in Iran weighing on consumer sentiment. We'll break it down, what it means for the consumer and what it means for consumer-facing companies. From New York City this morning, good morning.
$150 price of oil per barrel starts to bring in the recession risk much more prominently. But the equity market here is actually the wild card. The equity market would have to start pricing in downdraft in earnings. It would have to shake confidence of CEOs and on the consumer side, and you would have to see that foundation really become rocky before we're starting to talk about Fed easing here.
Down almost 6% for the month so far on the equity market on the S&P 500. That was Joe Davis of Vanguard. Yesterday, the biggest one-day loss we've seen since this war started. Some negative follow-through here on the S&P, on the Nasdaq, on the Russell was softer by 0.5%. On the S&P, on the Nasdaq, down by 0.6. In the bond market, we keep going back to it. We've had some sloppy auctions this week. 2-year, 5-year, and 7-year, 3 for 3. Yields up this morning by 4 basis points, 4.46. And of course, Lisa, what's notable about this is yields are basically back to where they were on Monday morning before the president said there were talks with Iran.
There have been no developments that have removed the uncertainty around Fed policy and around ECB policy, and you still see a complete volatility in bond market pricing. I mean, even the MOVE index, the implied volatility going forward, creeping ever higher. How do you get ahead of this? I mean, the idea that Bob Michael was saying this is technical, how is anyone going to step in and say, I have any conviction to buy?
Technical, fundamental, I tell you what, it's painful. Painful. It's not what the market was positioned for, that's for sure, in the bond market or foreign exchange. Let's finish on crude. 111 on Brent, 97 on WTI, pushing higher by some 3%. Persistence is the problem. How many times have we said that this morning? And the president's basically just told us, new self-imposed deadline, this will persist. See you on April 6th.
Yeah, living in purgatory at the moment, basically, for the crude market. You have this environment where even Qatar Energy, when it comes to LNG, they're talking about force majeure, people close to the matter telling Bloomberg. And then still, the Strait, what you see right now is just 1 or 2 vessels, 3 or 4 a day getting through. This is so low compared to where we were before the war, where more than 100 vessels went in and out unimpeded whenever they wanted. Until that opens up, you're going to see prices at minimum this level, maybe higher.
Brent lingering around 111 this morning. Let's get you some morning calls. First up, JP Morgan raising its price target on Halliburton to 40, expecting limited impact from the Iran war in its first quarter. The second call from Wells Fargo boosting its price target on Alphabet to 397, seeing higher compute and the opportunity for new profit sources. That stock's still lower by 1%. What a rough ride it's been for tech recently. And finally, Mizuho raising its price target on Carnival to 39, saying current levels underappreciate long-term earnings power. That name is down by 1.7%. Fuel and travel is a problem right now, Bramo.
Every time I feel like someone's trolling you, though, when you put up the cruise liners.
The cruise stuff?
Yeah, I just feel like, look, they are under pressure. Who's going to be the winner? Well, clearly, it's going to be some of the big guys, which you see potentially consolidating the power of the seas, getting John on the cruise ship.
Mrs. Farrow was trolling me the other day. She brought up the prospect of a Disney cruise.
I think that you should go.
Absolutely not.
I think that in about a couple years, you'll
Not a
be
chance.
seeking somebody to entertain the
In
child.
fact, I can't think of a single person in the Farrow family who wants to go on a cruise, to be honest with you.
I think that maybe you might change in 2 years.
Yesterday in the press room, I heard The Atlantic, the magazine, was doing a tie-up for a luxury cruise.
Good for them.
And like hang out with some
Okay.
editors and journalists. I'm not really sure that's a vacation.
I cannot think of anything worse than that, to be honest with you. All right. Retailers competing with high gasoline prices. The national average still hovering near $4 per gallon. The team over at Jefferies writing expectations were largely transfixed on consumer tax relief, bolstering the physical economy. However, driven by the conflict in the Middle East, investors have been forced to quickly reframe expectations. Kylie Cohu of Jefferies joins us now for more. Kylie, good morning.
Hey, good morning. Thanks for having me.
How have you reframed expectations since this war started?
Well, what haven't we reframed, right? So coming into the year, one of our biggest fears really in the retail space was disinflation. That has completely been thrown out the window. And now the real input is where are costs going, where are prices going, and how is the consumer responding? Right now, we haven't seen any major changes in volumes as a whole, but to use the buzzword of the last 24 months, this K-shaped economy is real, and this could catch up with us sooner rather than later.
The biggest surprise for me would be, Bram, I'd love your thoughts on this, the opposite happening, which is people got the tax refunds, they've got this confidence, you don't see it in the sentiment numbers, but they keep on spending. And that's essentially what Torsten Slock of Apollo is making an argument for. That would be the shocker. Think about what everyone's calling for right now. No second-order effects because the labour market's not as tight, the consumer's not as strong. That would be the major surprise for the year ahead if actually the consumer stares down these prices and keeps on spending.
Especially if you get policy panic like the one that Michael Hartnett is talking about to juice the economy heading into the midterms. That leads to an inflationary pop, really bad for bonds, but potentially really good for some of these consumer-facing names, which is exactly what Michael Hartnett was pointing out.
So, Kylie, a little bit later this morning, we get UMich consumer sentiment. I'm not expecting it to be any good. We know UMich is shaped by energy prices to a greater extent. What are people doing, though? Your channel checks, the visibility on the consumer, the spending right now, the momentum we had into 26, has it held up?
So far, yes. What we are seeing, I was walking a Target last night, almost all of the Easter decor is gone. So kind of all these seasonal trends that we started to see are still playing out. People are still spending in pockets where it might have been light, say something like a toys, I cover that space as well, still looks kind of light. The inventory's there, it maybe not be moving as much. So to your point, we haven't seen the big shift yet. What I think people are most concerned about is the prolonged effect of this, right? So, when I'm thinking about peak shipping times for those more discretionary goods, that's where we start to talking about some timing risk.
So near term, you're starting to hear some consumer-facing brands raising prices, the airlines in particular. We were talking with United earlier this week, talking about the potential for a 20% increase in fares in response to the hit that they're experiencing from oil prices. Do you think that there is a counterintuitive shift where suddenly some of these retailers have pricing power because they can say, look, we're dealing with supply shocks, you're experiencing this throughout the universe, but you guys are getting tax refunds, you're still going to keep buying. We can nudge up prices to compensate for increased costs.
Well, that kind of goes back to the point of the biggest fear was disinflation. And now all of a sudden, wait, do we have a little bit of room here, especially for some of these items that are new, innovative, things like that, that the consumer was already drawing towards. What we also see, though, is consumers are becoming more choiceful. So what they might say is, okay, it's the buzz term, right?
Kylie, we throw people out of the studio for choice.
I
was waiting for
Shut it down.
Yeah. Well, I say that though to say that we're going to see maybe more private label mix, things like that. And really, like I said, in terms of units, in terms of overall spend in stores, we haven't seen any major changes yet.
So what are you telling clients when they come to you and they say, okay, so is this a good time or a terrible time for consumer-facing stocks? Do you just look at them, shake your head and say, I have no clue. Why don't you just check the price of oil and get back to me in a week?
Not quite. We do have more of a view, like I said, that the trends that were happening are continuing to play out. The big are getting bigger. Again, we're very bullish on Walmart. And although that stock has seen a little bit of pressure lately, you're still going to end up seeing those structural moves into the players that were gaining share before this.
I was struck a few weeks ago when Ulta Beauty came out, and it was just after the war started, and said that there's geopolitical risks. This is a makeup brand, like a makeup store. Do you think that in this environment you can see like winners and losers, those that are just maybe using this as an excuse because there's underlying issues at their company?
There could be, and that's definitely been topical with some conversations I've been having with investors specifically. I specifically just cut numbers for toys, and they were kind of calling some of this stuff to be tariff related. And some people think that it's read-throughs to just maybe being weaker demand, maybe, more input costs. So yeah, there are kind of some puts and takes of what are we kind of covering up here, what's real, what's structural. And truthfully, right now, everyone's kind of responding in different ways. We're not sure what the long term is. So no, there's definitely pockets where we're positive, but who knows?
Kylie, good to see you. The problems continue. Kylie Coho there of Jefferies on some of the retailers right now and the shock to the consumer and the data. Potentially the data, a real shock to the data. What is March and April going to look like? I think we've got a decent idea of what the price pressures will look like, but what about the output numbers? What about unemployment and payrolls over the next week?
Yeah, next week we get JOLTS, we get payrolls, we get the ADP numbers. That's all going to be incredibly important given the fact that so far initial jobless claims have not ticked up. You haven't seen real pressure there. Is there going to be the ability to, as John tells us every single day, go to your boss and tell him you want a raise?
You should always ask for a raise.
All right, I'm going to blame you.
Know your worth, Bramo.
Okay, all right, thank you.
Always back yourself.
Is anyone listening to this? Hey, Rachel.
Never allow your employer to think
totally.
that labour market conditions have deteriorated. You should also always let them know you've got options, that you can always go somewhere else.
Single-handedly creating
and get
a
more
wage
money.
price
Of course you should.
Love
Everybody
it, John.
should do that. Coming up on the programme, Michael Gapen of Morgan Stanley. Mike does that. Still expecting 2 interest rate cuts later this year. We'll get his thoughts in just a moment. From New York, you're watching Bloomberg TV. The president extending talks and with it extending uncertainty. If I asked you to guess this week, what's crude done on the week, would you guess that it's lower on the week? Crude is lower on the week. It's up on the session by about 3%, 111 on Brent. But it's these levels that are the problem. And we've talked about it all morning. You don't need crude to go much higher from here. Just holding on to these levels is sufficient enough to cause problems. And you're seeing those problems. Cross-asset. Turn to the equity market. Yesterday, biggest one-day loss in the S&P 500 so far for the month of March since this war started. We come into Friday at 7-month lows, the lowest since early September. Futures extending losses down another 0.4% on the S&P, on the Nasdaq by 0.6. In the bond market, unlocking higher bond yields, pushing higher again. The 10-year bond yield up 5 basis points, 446 on 10s. Where were we on Monday morning? Lower than where we are right now. So even the diplomatic effort has not turned around the story in fixed income.
I'm laughing because you say that oil prices are lower today than they were when we started the trading session on Monday. And it makes me think of Kingda Ka, which is this roller coaster in Six Flags, if you have kids and have ever brought them there. It's sort of, you begin and you end in the same spot, but the ride in between matters, especially if you get sick to your stomach. And it seems like that is adding a risk premium to every single asset class, which is the reason why Russ Kostrich said, at this moment, nothing seems to be working.
We have a physical problem, not a paper issue. So you can push around paper markets all you like. We saw that on Monday morning. But you haven't addressed the physical problem. And you can't address the physical problem with verbal intervention alone. That's the issue that policymakers and officials have got right now.
Because we do not control the Strait of Hormuz. And this crisis just shows that this threat that Iran has always said, that this leverage they use across the global economy, they're actually using it. And today you see it. The IRGC is turning around ships. You're even seeing Chinese vessels having to take U-turns. They are not getting through. How do you address that? Potentially the military operation, which is why the Wall Street Journal is talking about they're even weighing sending 10,000 more troops on top of the Marines and the 86th Airborne Division they already have deployed.
3 options, 3 doors. Which door are you going to walk through right now? The resolution to a positive outcome, a positive future, door number 1. Door number 2, escalation risk. Things get a whole lot worse from here. You start hitting energy plants. You see retaliation across Gulf nations. They get pulled in. Terrible stuff. Door number 3, far more complicated. The status quo, the new status quo. That these problems just linger. This persists through the next several months?
I picked door number 1, just letting you know.
I hope I'm there with you.
I think that increasingly, though, people are thinking about what door number 3 looks like, and let alone door number 2. And the question of something that Morgan Stanley's talked about, the non-linearities, the idea that once you get past a certain point, suddenly the pain gets much more severe, not in a linear fashion.
We'll talk to Morgan Stanley about that in just a moment. This is how the stage is set going into the opening bell. 1 hour away from the cash open. Futures negative by 0.4%. With an update on some single names, some morning movers, Danny has more. Hey, Danny.
Hey, John. Adding to the not so very good day yesterday and the not so very good morning this morning is a sell-off we're seeing in tech. It started, at least it was attributed to this new announcement from Google about compressing the need for memory. But it feels like it's taking a life of its own because you continue to see SanDisk and Western Digital down this morning. Micron down less, but still down 0.5%. They're down 15% so far this week. We're also seeing a lot of the software names sell off this morning. CrowdStrike is down. Palo Alto is down. Microsoft is down. There's a lot of speculation that hedge funds had started to short cover in this war when they tried to get low to the ground. Maybe that short covering is over and they're reloading up on those negative bets. Elsewhere, AstraZeneca, that is trading to the upside. Releasing a study around a treatment for a deadly lung disease, the results of which are being interpreted as very positive. Bloomberg Intelligence says that this is an addressable market as big as $10 billion, so shares up just about 3.75%. Wrapping things up with Carnival, we should hear from them in about 45 minutes' time for their earnings. It's had a very bad month. Since the war has broken out, they are down nearly 20% for their worst month since 2022. The concern, both consumer appetite and higher fuel prices. What will they say on their earnings call? Shares already negative ahead of it, down 1.7%. John.
Danny, thank you. Thanks for the update. Look out for Danny alongside Matt Miller at the top of the hour, about 25 minutes from now, to guide you into the opening bell. Turning to the economy, lots of data coming up over the next hour or so. Consumer sentiment numbers we need to talk about, and Fed officials warnings on inflation following this war and this spike in crude prices. Mike McKee has more. Morning, Mike.
Morning, John. Any of you guys remember Muzak, the people who, in theory, invented the hold music for telephone? Well, Muzak is now Fed speak because we're seeing everybody at the Fed put the central bank on hold for right now. We had 3 more members last night, all of them on the Board of Governors, saying they're worried about inflation and there's no reason to do anything about interest rates right now. Lisa Cook, I would argue that the inflation risk is greater right now as a result of the Iran war. With respect to the labor market, I see it as being in balance, but precariously so. Joined by Michael Barr. The spike in energy prices and other commodities could have broader implications for both prices and economic activity. And then Philip Jefferson, the Federal Reserve Vice Chair. An extended bout of elevated energy prices could put upward price pressure on a variety of other products. Now, nobody is talking rate increase at the moment, but they are setting the stage for Wall Street to start worrying about it. And what's really interesting, you go back a couple weeks, this is not what the chart of Fed funds futures look like. Right now, all of the futures are basically pricing in out to 2027 rate increases of one level or another. We're not there for a full rate increase yet, but the graph has turned around. Everything, all those bars were going down before. Now they're all going up. Joining them in their concern about inflation, but not as bad as Wall Street economists. The Bloomberg survey of economists out this morning shows that they expect 2026 PCE inflation of 3.1%. That's up from last month's estimate of 2.6%, a big jump. Not a lot of change in unemployment. And they're still forecasting 2 rate cuts, but recession odds have risen a little bit. So the Fed on hold, and right now, nobody really knows what's going to happen, but the economists are a little more optimistic about rate cuts when we get to the end of the year than it looks like Wall Street investors are.
And Mike, you know how much I respect you, but I have to concede I didn't listen to a word of anything you just said because I was searching for Muzak.
Really?
On the internet, yeah.
Music? You didn't know what
I didn't know what
was?
the brand Muzak was, no.
Oh, my goodness.
I grew up in the UK.
Yeah, but
so
you probably were exposed to it as well.
I was exposed to it, sure, but I didn't know where.
There's music absolutely everywhere. Oh, it's fantastic.
Yeah.
Yeah, I think it's making a comeback.
Appreciate it. Mike McKee there. Did you know what that was?
Nope, and I just was sitting there wondering how long did it take Mike McKee to come out with that?
Oh my God.
You know, that gem of the morning.
Hold on a second. How could you guys possibly not know what Muzak is?
Well, I live somewhere else.
Yes.
And Anne-Marie's on a different side of 40.
Oh,
right. So,
let's move on.
So there you go. Mike Gapin of Morgan Stanley with this to say. In light of higher oil prices, we revise our outlook for 26 in favour of less growth, more inflation, higher unemployment and later Fed cuts. We now project 25 basis point rate cuts in September and December. Mike joins us now for more. Mike, good morning.
Good morning.
It's good to see you, buddy. Let's talk about your three scenarios, because we've been talking about it all morning. We've been obsessed in this market over two-way risks. The prospect that prices go a lot higher from here, or they go a lot lower from here. There is a middle ground. Can you go through the three scenarios for us and what it might mean for Fed policy?
Yeah, I think as you alluded to in the last segment, door number one is uncertainty diminishes, risk, walks back, oil comes back down. So we return to where we were kind of pre-February 28th. And as you said, in the other direction, door number three is oil goes a lot higher and kind of clearly triggers nonlinearities and it weakens demand, and the labor market and activity clearly suffer. The door number two is that kind of in-between scenario where oil stays elevated for a long time. So there's lingering term premium in the oil market. And it's hard to know what to do as a central bank policymaker in these worlds. And because oil up to a certain level is mainly an inflation story. And so you want to lean against that. And the Fed already seeing its policy rate as being restrictive, that's a Fed that's probably on hold for the foreseeable future. But somewhere in there, if oil goes high enough and activity weakens, the Fed may want to cut. So there is a convexity. We think it's around $125 a barrel, that as you move above that, you'll probably start seeing demand for oil and other products be destroyed. So we don't know quite where that level is, but that's the idea. Some oil means some inflation, means at least the Fed on hold for a prolonged period of time. Our forecast is in that world, the unemployment rate drifts a little higher and the Fed turns to rate cuts later this year. But that's, we'll see how that goes.
We're kind of in the middle window right now.
Right. We are in the middle
problem window. Can we talk about where we are now and the prospect for a broadening out of price pressure? When you're around 110, 111, from the 60s, from the 70s, and you spike up that quickly, what is the prospect of the bleed through to other prices?
Well, the standard analysis here is you don't get bleed through to other prices, right? So the kind of the last 35 or so year history of the U.S. is that oil will be a headline inflation story. It destroys demand on the other side, therefore it doesn't pass through to core. So the history says you probably won't get it. But the story where you might get it is a combination of, well, we're 5 years above the 2% target. This is our third kind of consecutive supply shock. Is it the case that there will be second round effects, either because firms are seeing higher input costs, right? So in one way, there's a price story here, but there's also a quantity story. In the U.S., oil's available at a price. In other parts of the world, it's getting to the point where, as you noted, the difference between paper oil and physical oil. If physical oil starts to become a problem, then you start to get kind of supply chain disruptions like we saw in the pandemic. That could kind of create second round effects on core inflation that you would not expect from a econometric exercise where oil goes up and then oil comes back down. So the longer it stays at 110, the more you start to risk second round effects.
Especially if the economy is as hot as Torsten Slok over at Apollo seems to think that it is. I mean, one of the complications here is the complete disagreement about the state of the labor market and the state of the U.S. economy heading into this period. How important is next week's employment report going to be to give a sense of how much wage inflation there is potentially, how tight the labor market actually is?
Well, as you know, the survey for that would be taken around March 12th, the middle of the month, only about 2 weeks into the uncertainty that we've been seeing. So I don't anticipate that it's, say, a clean reading on what the labor market looks kind of post-Middle East conflict. So we're expecting, I think, a pretty decent report because we'll get some payback from the workers who are on strike and some of the weather. We think 60 to 70,000. So I don't think you're going to see a lot out of it yet. That's probably more the April employment report. And the retail sales data coming, it's delayed. We need timely data. We're not getting it. But the analysis suggests that oil price shocks tend to hit spending on goods more than anything else. So I think that one will be critical. And the other thing I'm watching is the inflation swap data, meaning the inflation market, I think, is a very good indicator for when we might hit that nonlinearity in oil prices. So a year ago after Liberation Day, when tariffs were very high, one-year inflation swaps went down. So it was an indication that the market saw those tariffs as embargo-level tariffs, and activity would fall and inflation would come down. So far, that hasn't happened in the current volatility. One-year inflation swaps have generally moved up. So that is kind of a trigger point or an indicator I'm watching for maybe when financial markets think oil prices have gone too high.
There's also the issue that financial markets have started to feel some moderate constraint, particularly in the bond space, and you start to see some real pushback around levels across the curve. At what point is that enough to crimp growth in and of itself, to act as sort of a constraint on how high inflation could go?
Well, I think we're there because we made revisions in that direction, taking some of this into account. So I do think financial conditions have tightened anywhere on the equivalent of about 2 federal funds rate hikes. So bond spreads have moved up. Oil, of course, has moved up. The dollar has moved up. Equities have moved down. You combine all of that, and it is probably the market is doing the Fed's work for it now. So I would say we're there, and we've taken some of that into account into our revisions.
You're getting some feedback from Bloomberg subscribers. This, most likely there's no data that's super important now. This third supply shock, trade, labor, now energy, has lasted too long to just assume it away. The backward-looking stuff is even more backward-looking.
Which a lot of people would agree with, and we've been getting data, and people point to it, and it makes no difference whatsoever in markets. Is there, though, a difference if you do get a sense that there is a heating up of the labor market, that potentially this could lead to a greater wage price type of reaction to what we're seeing with respect to the oil price
I always
shock?
think that shocks like this bring the best out of research teams on Wall Street. Really enjoyed the work from the team over at Morgan Stanley. Mike, thank you. Mike Gapin there of Morgan Stanley. Let's give you an update on news worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Anthropic considering going public as early as October. Sources telling us here at Bloomberg, the maker of the Claude chatbot is in talks with Goldman Sachs, JP Morgan, and Morgan Stanley about playing a key role in its listing. The information reporting an Anthropic IPO could raise more than $60 billion. Baseball is back. The Mets off to a hot start after beating the Pirates 11-7. Milwaukee dominating the White Sox, scoring 14 runs and striking out 20 batters. And the defending champion, the Dodgers, beating the Arizona Diamondbacks 8-2. And Netflix announcing it's raising prices across the board. The streaming giant's subscription with ads will now be $8.99 a month, with the premium plan increasing $2 to $26.99 a month. This marks Netflix's first price hike in over a year and is effective immediately for new customers. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. Plus, Ajay Radhaksha of Barclays joined us on the widening cracks in the U.S. economy, and we've got to get his view on why they upgraded their outlook for U.S. equities in the last week. Barclays pushing their price target on the S&P higher. That conversation up next.
Things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for a recession. So in the meantime, just let the markets go to wherever they're going.
In the meantime, as we've said a few times already this week, it feels like trying to catch a falling chainsaw. That was Bob Michael of JP Morgan Asset Management. Equities this morning, negative once again, inching closer to the cash open. The open about 41 minutes away. On the equity market right now, we're negative by 0.5% on the S&P, down 0.75 on the Nasdaq. In the bond market, yields bleeding higher. At the long end, 10's up by 5. The 10-year this morning, 4.46. And in commodities, Brent WTI looks like this. Are we going to have another weekend when Monday morning starts Sunday evening?
Please not.
When the oil market opens up? Brent crude, 110.86. WTI, just short of 97.
Probably. I mean, based on
Feels
the
that way,
record, right? Ultimately, people are still going to be logged in, regardless of whether there's any news over the weekend, because this is going to set the tone for the rest of at least Monday morning.
Set the scene. You run research at a bank, and your equity strategist knocks the door, you open it, what do you want? I'm busy. And then they say, I want to raise the outlook for our price target on the S&P 500, and you say there's a war. What's wrong with you? Let's have that conversation right now with Ajay Rajadaksha of Barclays. Ajay, good to see you.
Well, I wish I could say the same, but thank you for that.
So that happened in the last week with the team at Barclays. Your chief strategist, your equity strategist, comes to you and says, let's raise the outlook for stocks. Give me an idea of what that conversation sounded like.
So, honestly, those numbers are not built on air. The bottoms-up consensus analyst estimates, you know, there's an analyst at each shop with a bunch of juniors who follows every major name, right? They do channel checks, they do what the guidance looks like, etc. The bottoms-up analyst estimates for S&P 500 show the strongest year-over-year rebound if you exclude the post-COVID rebound. And the numbers are the numbers. I mean, you know, we sometimes tend to be too fixated, tend to extrapolate too much what is happening in the here and now.
Sure.
Take 9/11, which was about as existential as can be, right? I mean, we were completely shell-shocked as a nation, as individuals. 3 months later, the S&P 500 was up 2.5%. 13% higher the day boots went on the ground in Iraq during the Second World War. 60% higher since Russians invaded Ukraine.
So are we underestimating second-order effects here? If you're saying the outlook for growth is pretty good, I'm wondering what the outlook for inflation is with crude at these levels.
I think Governor Waller said it best. If you remember 2 or 3 weeks ago, his initial response was that this is a one-time shift in the price level. Base effects are a central banker's best friend. Unless you think that this leads to the Fed losing inflation credibility. And honestly, guys, if the Fed didn't lose inflation credibility when headline ran at 8% for 2 straight years, it's not doing it now. You know, there's no reason to, the Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
Are people overly conditioned by previous crises of confidence where you did see big drawdowns in the market, that there can be a policy response that offsets any of the potential downdraft to growth?
I think that is a fair pushback. I don't think most people believe that now because everyone realizes that a policy response doesn't help get ships faster through the strait. A policy response doesn't help really offset demand destruction. If oil goes to $150 a barrel, right, there is an element of demand destruction, and the policy response doesn't help with that. So I don't think the market is counting on that. I think there's 2 things that the market is counting on. One is the energy intensity of the world economy is significantly lower than it was 10 years ago, 15 years ago, 20 years ago. The second is that $100 oil, a barrel of oil, is not the same thing as $100 in 2022, let alone 2011. And I'll remind you, we were there in 2011. We had a ton of inflation since then. And then finally, the world's largest economy is a gigantic energy superpower. We shouldn't forget that.
Well, this all comes along with the often pushback against the bears, that the technology story is strong and that the U.S. is the epicenter of a lot of it, but the tech story hasn't been working. And that raises a real problem for people who are banking on the AI investment structure. I mean, how solid is that, especially in light of tightening financial conditions in the face of this oil shock?
It's incredibly solid. I would argue that the AI capex cycle is a cyclical. I agree with you, Lisa. It's not been working for the last 4 to 6 weeks because we have all been like a deer in headlights caught when it comes to Iran. That's happened before. 2023, SVB goes under. For 6 straight weeks, the only thing you and I were checking was a regional bank ETF. Tiny, but you know, we shouldn't have. The bond market felt like the Fed would cut 100 basis points that year. Remember how many times the Fed cut? 0. We grew at almost 3% Q4 over Q4, just effortlessly shrugged it off. So there tends to be a tendency to extrapolate. What I know are the numbers. I know Satya coming out and saying that the cloud computing backlog in Q4 was $368 billion. I know that Google Cloud is going up 50% year over year. And Pichai is still telling us that their backlog is $240 billion. Those are real numbers. You can't wish them away.
Could you have $150 oil or $200 oil and still have your outlook?
No, then I'm just wrong. I mean, if we are here in 2 months...
But that's what the energy world is saying, because that's where the physical market is.
But you are supposed to look, the forwards are the collective cleanest indicator, unless you believe that there's this gigantic conspiracy, right, where every government sitting around the world is paying futures down hard.
Some people do, but yeah, carry on.
Yeah.
Yeah, but see, Stan Druckenmiller, his first mentor, had this phrase, 60 million Frenchmen cannot be wrong, which is, you know, I'm assuming the guy was French. But the point was that the base case tends to be true 80 to 90% of the time. Markets do a poor job pricing in a tail for obvious reasons.
Yeah.
But in general, it doesn't pay to be a contrarian. And at this point, I think things are nowhere near as bad as people think, which is why the equity market, the S&P, is down only 7 to 8% from its all-time high. That's not a big move.
This was, at risk of offending a lot of people this week, my favourite conversation this week. Thanks for being here, sir. Thank you. Thank you. You tell him. You tell him. Ajay Rajadaksha there of Barclays. Thank you, sir. Coming up on Monday, it's going to be another long weekend. Monday, of course, starts Sunday evening. Look out for the coverage out of Asia on Sunday evening. Coming up on Monday, Laurie Cavacina of RBC, Vinu Krishna of Barclays on that equity call, Bob McNally of Rapidan Energy, Osen Kwan of Wells Fargo. From New York City this morning, good morning. This was Bloomberg Surveillance.
To do it, China has yet to respond. And what you have from the European Union is this discussion potentially of their naval fleet they have in the Red Sea moving to the Strait of Hormuz. But then when you look to the individual leaders like Keir Starmer, like Frederick Merz, they're basically saying not so fast. They don't want to touch this right now with a 10-foot pole.
You break it, you own it, fix it. Seems to be the response from some NATO allies at the moment, whether they feel the repercussions of it or not.
So Luxembourg's foreign minister had this to say: blackmail is not what I wish for. Then you had this UK official saying, it's also important to remember that we have not sought to be a protagonist in this war. So definitely a feeling of not wanting to get involved.
I think an important comment this morning comes from the Iranian foreign minister. The reason we say we do not want a ceasefire is not because we are seeking war, but because this war must end in such a way that our enemies never again think of repeating these attacks. When analysts come on and continue to say that their worst case scenario is that this is prolonged, that is basically the base case for people that are living in the region and are touching this story every single day. Because of this reason right now, they took out the Ayatollah, they took out the top brass, they went after Karg Islands. Right now, it doesn't seem like the Iranians feel like the U.S. has suffered enough.
Market participants called it a risk. The Iranians called it a goal. Right now, Brent crude around triple digits, Brent at 103 and just about unchanged on the session. Coming up this hour, Stephen Parker of JP Morgan Private Bank as crude adds to recent gains. Henrietta Trays of Veda Partners as President Trump demands support in the Strait of Hormuz, and Francisco Blanche of Bank of America with the White House forecasting a dip in energy costs. We begin this hour with stocks pushing higher on the S&P 500 by about 0.7%. Stephen Parker of JP Morgan Private Bank with a 7,400 to 7,600 year-end S&P target and writing the following: we've not changed our base case forecast for growth, but acknowledge increasing downside risk the longer energy prices remain elevated. Stephen joins us now for more. Stephen, good morning.
Morning.
It's good to see you. So let's talk about what we've seen so far. 5% move on stocks. 60 basis points of widening on high-yield spreads from the tights of the year so far. Is that a sign of resilience or complacency?
You know, I do think the markets are probably a bit complacent given the move that we've seen in energy markets. We've always said to clients, when it comes to geopolitics rarely have long-term impacts on markets, but we have to acknowledge that particularly when energy is at the center of the storm here, they can certainly have a bigger impact on markets in the short term. You mentioned the pullback that we've seen in the U.S. We've seen a bigger impact in international markets, particularly in places like Europe and Asia, who are more exposed and more at risk to these higher prices. But there does seem to be a bit of complacency in markets.
Where do you see that complacency concentrated at the moment?
Well, I think that investors are just looking at the fact that the expectations for energy prices are to recover and be back around $80 in the not too distant future. And in that sort of world, then we can get back to the fundamental story around U.S. equity markets and double-digit earnings growth, which is what we expect. The challenge is if we end up in a situation where we're looking at triple-digit oil, not just for the next month or two, but for the next 3 to 6 months, then you have to start asking yourself about the outlook for growth and the outlook for inflation.
Are people more accurately pricing in that perspective internationally? You talked about the hit to international markets.
Well, I think you're seeing two things. One, places like Europe and Asia are more exposed to higher prices in the near term, and the risks of those prices remaining higher are there for a longer time period. The U.S. is buffered by a greater sense of energy independence. I think you're also seeing a bit of a flight to safety, a flight to quality. You're seeing it in the rally in the dollar. You're also seeing it in the recent outperformance of tech. Not too long ago, we were talking about tech being under pressure, the rotation into more cyclical parts of the market. I think investors are looking at this environment and saying the long-term structural fundamentals, the earnings growth, the upgrades that we're seeing in the tech sector, and that's bringing money back into the U.S. and supporting U.S. equity markets.
Do you think this has materially shifted the narrative that took hold in the first 2 months of the year, which is diversify outside of the United States, diversify outside of tech? Has that pulled it full circle and actually caused the leadership to come from the United States and from big tech?
I think perhaps in the near term, but I do think that longer term there is still that diversification story. In particular, we think there are interesting opportunities in emerging markets who have been hit the hardest in this recent move higher in oil prices. But still, there's a really interesting story, particularly in Asia, around the tech story there, the hardware sector. We've seen massive earnings upgrades in places like Taiwan, Korea, India. We think that story continues, and we're looking to build a shopping list with our clients to say, if this volatility continues, what are we thinking about adding? Emerging markets would be squarely in that bucket.
At the top of the shopping list over at Neuberger Berman, just on the programme moments ago, the bond market. They believe all roads lead to lower bond yields here. Even if you fix this crisis over in the Middle East, lower bond yields. If you don't, lower bond yields. Because if you don't, ultimately, it's going to hit growth and yields at the long end of the curve are going to roll over. Is there an opening here in the bond market?
You know, our view around rates is that we're probably more range-bound. We came into this year a little bit more conservative than the market. We thought we would see one cut from the Fed. That's still our base case view. The challenge is going to be this push and pull between potential for lower growth and potential for higher inflation. That's why it's going to be interesting to listen to what we hear from the Fed this week as they try to set the narrative, as they try to guide markets in terms of which one they're going to prioritize. I still think that there's room potentially for another cut, but we don't think necessarily that rates are going to move meaningfully lower from here.
How do they guide the market in this moment when in the past, when we saw energy price spikes, they just called it transitory and they were wrong?
Yeah. Well, I think what's going to be interesting is to listen to their comments on not just energy markets, because I think those are more difficult to prognosticate, not just for us, but also for the Fed. I think it's going to be interesting to listen to what they say about labor markets. Obviously, recent data has been a bit weaker than what we would like to see. The question is going to be about not just sort of the demand for labor, but the supply of labor. And if they indicate that that is front and foremost, you know, at the top of their mind, that could indicate that they're willing to let inflation run a little bit hotter at the expense of supporting labor markets.
You mentioned semiconductors, some of these companies you like. Have you thought about other issues with the Strait of Hormuz besides oil? Helium. A third of global helium goes to the Strait of Hormuz. That is needed when you make semiconductors.
Yeah, I mean, what we're seeing, everyone is looking at the first order effects, which is higher energy prices, higher gasoline prices. But as you pointed out, Anne-Marie, there are long-term meaningful impacts around supply chains, broadly speaking, in different industries around the world. And the challenge is, if these things get turned off, they don't just get turned on with a flip of the switch. One of the themes that we've been talking about a lot with clients is this idea of the shift from globalization to global fragmentation, and the idea that countries and companies are going to be more concerned about supply chain resiliency rather than supply chain efficiency. And so one of the areas of focus has been on this idea of national champions in strategic industries as the U.S., as Europe, as Asia look to develop these national champion companies in places like power and infrastructure, security and defense, and technology.
I'm going to ask you a really unfair question, so brace yourself and forgive me. Forgive me for doing this. But as I sit here and listen to this and you bring up chips and we're talking about geopolitics, a lot of this is scenario analysis, but I think it's a scenario that we need to explore. How would you react if China used this as an opportunity to go after Taiwan?
I think that question is coming up more and more in our conversations.
What do you say back to clients?
I think we have to acknowledge that it is a significant risk, and I think that markets would react more aggressively to that type of news even than what we're seeing as it relates to energy prices. I do think at the end of the day there is still an economic agreement amongst the world, and the impact that might have on the economy probably reduces some of the risks there, but it's a risk that we need to acknowledge. And at the end of the day, when it comes to geopolitics, we don't manage portfolios around tail risk scenarios. Of course. In the long run, that's a losing strategy. It's why we lean into diversification. It's why we think about global investing, stocks and bonds, but also diversifiers in a portfolio related to higher inflation, which has been top of mind for our clients.
And that's the risk. It's because those supply chains aren't diversified enough right now. Stephen, it's good to see you. Thanks for being here. Stephen Parker there of JP Morgan Private Bank. It's a conversation coming up with clients. It's a conversation I'm hearing as well over the weekend.
Yeah, especially because there were Chinese ships that were getting close and doing some war exercises near Taiwan, according to a number of reports. There was a question of whether this was actually going to come to pass. As I listen to this, I do wonder how you can get the confidence to lend longer term to companies. If you're dealing with this number of variables and this number of potential tail risks, wouldn't you charge a higher premium? This sort of speaks to the question of at what point do you have to start seeing a risk premium baked into credit markets, not only commodities markets, to reflect some of these potential scenarios?
It's a great point, and for a lot of people, it feels very existential because while the U.S. is focused and their Navy is focused on the Middle East, China right now potentially could make a move with the U.S. unable to respond. Now, Xi Jinping has to weigh other things the president could do, and some of them could be, the nuclear option, literally a nuclear option. But this is something that continues to come up. And our stock market is 90% tethered to Taiwan because of how important hyperscalers and these tech companies are to our S&P 500.
Probably not the conversation you wanted to hear this morning, so again, forgive me. Equity futures on the S&P positive by 0.7% with an update on stories worldwide this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. The key port of Fujairah in the UAE was hit by a drone this morning, halting oil exports. It's the latest in a series of strikes threatening the country's only export route. Fujairah is a major hub for both crude and fuels. It has taken on increased importance for global markets because of its position outside the Strait of Hormuz. U.S. allies responding to President Trump's calls to form a coalition to support safe passage through the Strait of Hormuz. UK Prime Minister Keir Starmer saying efforts to reopen the strait won't come as a NATO mission, but the UK will work with partners on a plan. A spokesperson for the German government also saying Germany won't provide military support in Iran, calling the war unrelated to NATO. And Meta will pay as much as $27 billion over the next 5 years for access to AI infrastructure from the cloud provider Nebius. Nebius is set to give Meta $12 billion of dedicated capacity starting early next year. Meta is building a portfolio of massive AI partnerships, including with NVIDIA and AMD. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Appreciate it. Look, when I say this, I understand people on Wall Street are blessed. They just have to price risk. They just have to price war risk. They don't have to fight it. It's a very, very different story. So take this comment with a pinch of salt. This from Peter Bookvar, publishing just moments ago. Is it Friday yet? That's the sense of things on Wall Street, right? It's like no weekends anymore. Is it Friday yet?
Try keeping up, and not only is it not weekends anymore, but I keep saying it feels like 52 pickup, where someone's throwing up all the cards and then saying, try to find them all and put them in order, and you're just sort of in this role of, trying to put this all in some sort of incomprehensible order.
Monday morning on Wall Street. Is it Friday yet? Up next on the program, securing the strait.
The whole world will be united on the need to open Hormuz, and clearly we will have the support of other nations to achieve that objective.
Up next, Henrietta Trays of Veda Partners, live from New York City this morning. Good morning. Three-week losing streak on the S&P 500. Haven't had one of those in 12 months. Responsible for 2 weeks of that, this right here. Brent crude, 102.83, just about holding on to triple digits and pulling back by a third of 1%. WTI breaking 97. We're down by 1.8% on the session. In the equity market, near session highs. On the S&P, the Nasdaq and the Russell. The S&P up by 0.7. The Nasdaq higher by 0.8. Likewise on small caps this morning. Under surveillance this morning, securing the strait.
The world depends on the flows through Hormuz, and most importantly, the Asian nations, Japan, Korea, China, Thailand, India. A meaningful part of their total energy supplies come from the Straits of Hormuz. So, of course, the whole world will be united on the need to open Hormuz, and clearly we will have the support of other nations to achieve that objective.
So here's the latest this morning. The president demanding other nations help open the Strait of Hormuz, with crude holding above $100 a barrel. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John, good morning. Well, as disruptions continue, the White House intensified its calls over the weekend to reopen the Strait of Hormuz. And new within the last hour, a NATO official in an emailed statement to Bloomberg News does confirm that individual allies are speaking directly with the U.S. about what more they can do, including in the context of securing the strait, though it appears that allies still remain wary. We heard from the UK Prime Minister Keir Starmer just moments ago, a headline crossing, where he said that the effort to reopen the strait will not be a NATO mission. President Trump told the FT in an interview over the weekend that the NATO alliance would have a, quote, very bad future if allies did not help out. And that's not the only threat that we've seen lobbied from the president in recent days. He also threatened to delay his planned visit to Beijing, set for the start of April, if China does not come and send ships. According to data analyzed by Bloomberg Economics, nearly 38% of total oil flows through the strait do go to Beijing, but our own analysts say that it is unlikely that we would see China send ships, due in part to the fact that some of the vessels that are getting through the waterway right now are headed towards Beijing, and the country also has a vast stockpile from the past few years. The Wall Street Journal did report over the weekend that we could see a coalition announced as soon as this week, but at this point it's unclear what that would actually look like and when it would take place, either before or after the conflict resolves. John, in terms of other threats, President Trump is now saying that the U.S. could target energy infrastructure if disruptions through the Strait of Hormuz continue. As you well know, the U.S. confirmed that it had hit military targets on Karg Island on Friday, the country's top oil export hub.
Tyler, appreciate the update. Tyler Kendall there from outside of the White House. Tyler, thank you. Henrietta Trace of Vader Partners has this to say: permanently securing the Strait of Hormuz will likely require a sustained presence to override Iranian weaponization on the economic front. Henrietta, welcome back to the program. The financial asymmetry is pretty obvious here. It's costing America a lot to fight this war. Just how much is this costing?
Over $1 billion a day, over $200 million a day for Americans buying gas at the pump. And I think there's just this uncertainty overhang, this cloud that markets hate so much, as the president gets sort of increasingly hysterical with regards to our NATO allies, whether it's the UK or Germany or France, Spain, just going after them in ways that remind me a lot of 2025, except now he doesn't have tariffs. And I think it's striking that just 8 days before they started bombing Iran, the Supreme Court took away the president's tariffs. And it seems obvious to me that he misses those IEEPA tariffs quite a bit. I think it'd be a different situation if he still had them. So, his Twitter posts going after it, as extreme and dramatic as they are, really underscore how much he misses that cudgel that he just doesn't have anymore.
Henrietta, an energy shock in the United States is never good for U.S. president. It's even worse in election season. Right now, you have the national average $3.72 per gallon of gasoline. In California, already above $5 a gallon, potentially going to $6 sooner rather than later. What could the administration and Congress do when it comes to protecting Americans at the pump?
There's not a lot. There's actually, that's the wrong way to say it. There are a lot of little things. So they can change the ethanol blending rate to an annual blend instead of exceptions for certain times of the year. They can release some of the SPR. They can change the Jones Act. They can continue jawboning the way that the president is trying to do about victories in Iran and how everything is going swimmingly. But the reality is you need the Strait of Hormuz to be reopened. And we need, for example, military ships from France that have anti-mine capabilities. We need the divers in France that have the anti-mine capabilities. And the president is just not getting those allies on board with this war of choice that he has decided to engage in. And the extremes that he is trying to push on them are just not working. As I mentioned, you can feel the absence of the tariffs.
Some of the other tools the president also has is maybe an export ban when it comes to U.S. crude and crude products, as well as gasoline price caps. What would Congress say to that?
Yeah, I think the export ban is really interesting. I get that question a lot from clients. I think it's counterproductive, though, because obviously the problem is not domestic. We have a lot of energy production. We have a lot of supply. We have shale revolutions. We have alternative energy sources. It's getting the oil around the globe to places that are extremely exposed to Iran. That's the problem. So I think restricting exports would, while it sounds good, be counterproductive in the long run. And I think that would frustrate the White House. So I'm not expecting to see that. Congress, for its part, I just spent a week up on Capitol Hill. I don't think they're ready to address the war in any kind of material capacity. I think we're going to have to get past the spring recess, which basically puts us into mid-April, before they start to act on actual legislation around another government stimulus package. The farmers are going to need a second bailout. It's not just oil, it's all the fertilizer, as y'all well know. They're going to need another $15 billion, and the USDA is working on that. So I think we are probably at a situation where it will be at least 3 weeks of the continued war before we see any action from Congress. They're much happier to not focus on this, and they're going to be happy to go on recess.
Henrietta, I don't mean to be snarky, but are they prepared to do anything on anything in the next couple of months?
No, definitely not. And I don't think it's snarky at all. I mean, the president and the Republican conference are at very different loggerheads when it comes to the Road to Housing Act, when it comes to the crypto legislation, and the president stressing at the Republican retreat last week that he wants to focus on the SAVE Act, which is associated with mail-in balloting and transgender sports. We do not have a package that is moving through the Senate that can also pass the House, that can also get the president's signature, and they don't have an agenda list either. So the entire thing really, I think, rests on a DHS reopening package. We're on day 30 or whatever of a DHS shutdown. They're going to need to address that, but I don't think it's going to be until after the spring recess. So the whole agenda, I think, is suspended and will be for the rest of the year.
So you don't think that DHS and that sort of partial shutdown that's getting people in lines and waiting forever when they go to the airport is going to get resolved? I just wonder if in some ways Congress has absolved its role as an equal power with the executive branch. But if we've seen a fundamental shift that will not go back to where it was before.
Absolutely, Lisa. I mean, I think that we saw that all through 2025. And everybody's just waiting to get through the midterms. The popularity of President Trump with his voters is so overwhelming that Republicans do not have an opportunity to step outside the lines. With a couple lone exceptions, I would say Senator Tillis, who we had the opportunity to sit with for an hour, he is seriously going against the president's agenda. The social media post the president put out about the Federal Reserve Chairman is not going to land well with Senator Tillis, and he is absolutely living his best life right now, having a great time standing up for the Fed and saying, we want Fed independence. I want this entire case thrown out. I want it, completely eliminated, and I will stay in this seat until January 3rd of 2027, making sure that that ends up happening. And I think he's raising the odds that Jay Powell stays on after his replacement is confirmed, just to make sure that that sticks.
Yeah, just to echo that, based on our conversations with the senator from North Carolina, seems like he's having a good time at the moment. Henrietta, thank you. Henrietta Trace there at Fader Partners. As we've been having this conversation, an update from the UAE on oil production from the team and some reporting elsewhere as well. Production there for crude has fallen to about 2 million barrels per day. That was around 3.5 million. Around 3.5 million before this war broke out.
And we're just 3 weeks in, so potentially this number can actually get a lot smaller, which is why when the IEA comes out with 400 million barrels a day and stockpiles being released, it is not enough to fill the gaps that we are seeing right now.
Equity futures this morning positive by 0.7% on the S&P 500. In just a moment, we'll talk about crude with Francisco Blanch of Bank of America on the growing threat to global energy supplies. Plus, Danny has your morning movers. Meta moving higher on some big reports of some big layoffs. That stock is higher by 3%. Crude looks like this morning. Brent after a 40% move so far this month. Brent and WTI shaping up as follows. Brent crude at the moment 103.65, just about positive by 0.5%. In the equity market on the S&P 500, holding on to gains following a 4-day losing streak up by 0.6%. Plenty of Monday morning notes are dropping, including this from Mike Wilson over at Morgan Stanley. Lisa, the bar remains high for the oil spike to threaten the business earnings cycle, while we can't rule out modest downside in the near term. If the rate of change on crude and the dollar accelerates further, we maintain our view that this correction is closer to its ending stages in time and in price.
Yeah, they're not alone. There are others as well, including Goldman Sachs and others who have come out and said something similar, because the U.S. economy is more immunized from any kind of oil price shock to the downside. And frankly, there's a lot to like, and people keep pointing to that. We were bullish just 2 weeks ago. Do we really have to change everything all over again?
A 5% move on the S&P 500. Is that your dip? Is it time to buy? Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, I want to start with where the oil majors are trading this morning. They still are moving higher, even though NYMEX crude is to the downside this morning. Exxon and Chevron. Chevron has been up some 5% since the war started, to close Friday at a record. Exxon closed just under a record. That's up less, about 2.5%. Some of the other corporate news we are tracking: Reuters reporting that Meta plans to lay off staff. It could affect about 20% of them. The idea is to funnel those savings into AI infrastructure spending. They're going to be spending about half of their revenue on capital expenditures. So a lot of maybe efficiency Mark Zuckerberg wants to bring back to the company. Those shares up 2.5%. And then the other side of this trade is Meta signing one of their biggest ever single contracts with Nebius. This is a Neo cloud. It's worth about $27 billion over the next 5 years. Nebius is going to provide them with about $12 billion worth of space in their Neo cloud. So those shares moving 14.2% in the pre-market, John.
Danny, appreciate the update. More from Danny in the next hour. On our radar this morning, Apollo executive John Zito calling out, quote, arrogance in private markets and blaming the media for creating a frenzy around private credit. According to audio obtained by the Wall Street Journal, Zito believes his firm is on solid footing. Elsewhere, the president saying Iran wants ceasefire talks. Iran's foreign minister refuting those claims.
No, we never asked for a ceasefire, and we have never asked even for negotiation. We are ready to defend ourselves as long as it takes.
Tehran launching fresh attacks across the Persian Gulf as the war enters its third week. And finally, the world's largest single-site aluminum smelter is cutting output as shipping through the Strait of Hormuz stalls. Aluminum prices on the LME, the London Metal Exchange, briefly jumping to the highest level since 2022.
It's important to remember we're not just talking about crude when we're talking about the Strait of Hormuz, and this story really highlights that. Yes, it's aluminum, but as we were talking earlier and Anne-Marie mentioned, it's also about 30% of the helium, which is a key ingredient to semiconductors, also travels through there. Also 30 to 50% of the world's urea, which is a key nitrogen ingredient in fertilizer. Also, of course, about a quarter of LNG, liquefied natural gas. So we're not just talking about an oil shock. We're talking about a whole slew of commodities that are also getting severely impacted.
Well, it's not just this aluminum smelter, it's also Total Energies overnight talking about some of the production they need to unwind in some of these countries. On top of that, when it comes to countries like India and places in Asia, which is really on the front lines of getting hit when it comes to an energy shock, liquefied petroleum gas, what they use to cook their meals with. There was a story over Bloomberg over the weekend, the fact that a number of Indian weddings, these wedding venues had to go out and tell brides and grooms, we're going to have to cut back on the menu because we cannot afford right now where prices are and we don't have the stock when it comes to this gas we need to make this food. It is incredible what is going on right now, and it's not just the crude complex.
It's getting serious, that's for sure. I just want to issue a quick correction. I've lived here more than a decade. I love this country, forgive me. Aluminium. Every time I say aluminum, I just don't feel good. It's particularly aluminium on the London Metal Exchange.
You know,
right? Just to.
I think that it's fair. I think it's fair for you to say aluminum.
You'll give me whatever that was.
But it wasn't
aluminium or aluminum.
But it wasn't worth the correction. It's just a difference, an alteration.
Adidas, Adidas.
My brothers and sisters over there might be getting,
really upset.
Upset,
might
maybe.
Make Thanksgiving
the family group chat.
Brent crude climbing over $100 a barrel following President Trump's threat to extend attacks on Iran's oil hub. The NEC director, Kevin Hassett, dismissing concerns about elevated energy prices.
You can also look at futures markets, which are interesting because you've cited over and over the spot price of gasoline, which of course is affected right now by the disruption of the Strait. But if you look at the futures prices, they're expecting a rapid end to this situation and much lower prices. In fact, I don't think I've seen a sort of future price path with as steep a decline in all my years watching futures.
Francisco Blanch of Bank of America writing this: Brent could well average $100 a barrel for the year if the war impacts oil balances significantly into the third quarter, and could average near $130 if the disruptions extend into the fourth quarter. Francisco joins us now for more. Francisco, welcome to the program, sir. I want to start with a key assumption of yours in your research. We do not embed any permanent supply loss from this war. Francisco, why is that line so important?
Thanks for having me, John, and great to see you again. It's very important because if we end up with some meaningful destruction of energy assets, we're going to see forward points increasing very quickly in the curves, right? In these curves that Mr. Hassett was referring to in his comments. So, of course, we've seen Hark Island, Iran's main oil loading terminal, being struck over the weekend, and there was a clear point made that energy infrastructure was still intact, even though military assets had been specifically targeted. So I think it's very important, but of course, in wars, as you know, it's difficult to find sometimes a closure, and you know, we are always one step away from a major escalation on the energy side, and that's, I think, the fear the oil market has.
There are supply chain realities, though, that we could discuss right now. If you shut in production, how hard is it to restart it and get back production to where it was before?
Well, I mean, I think there's some concerns around that, but again, most oil fields across the Middle East are conventional, so I would expect a lot of the production to come back relatively quickly. Refineries are another point of concern. We saw the Tehran refinery, or at least Tehran refinery fuel depots being targeted. The refinery itself is unclear what's its current status. But I think generally most assets should be able to come back within a month to 2 months, if and when the war ends. And now, having said all that, another key assumption in our numbers is that Hormuz is going to be reopening sometime soon and recover the majority of its traffic, which might also be maybe too far-fetched an assumption. That's one very, very important concern. Hormuz, as you pointed out, is the choke point for a lot of the commodity flow in and out of the world.
Francisco, do you have a day circled on the calendar this week, to John's point earlier, where you start to challenge some of your assumptions and shift to some of the $130 a barrel base cases?
Well, look, I mean, we know the Houthis were able to disrupt traffic in Bab el-Mandeb for about 28 months. So I want to remind everybody of that. Flows were down from around 9 million barrels a day to 4.1, 4.2. Now, the difference between Bab el-Mandeb and Hormuz is that there's clear alternatives that allowed shippers to reroute those 70 vessels that used to cross. A lot of them rerouted through the Cape. So that was, I think, a big relief valve for Bab el-Mandeb. Here, there's no clear rerouting. So I think the options are not great to reopen the strait, particularly in the light of all the capabilities that Iran might have, and also, to be honest, this quickly becomes a bit of a guerrilla war like we saw in Yemen, and I think shippers themselves will be very, very cautious not to take that route if there's risk of their vessels ending up in fire, and we've seen 20 of those already being attacked or so, I think. So it's a difficult time for shippers, for insurers. Everyone's kind of waiting for a resolution, but if it doesn't come up in the next few weeks, I mean, I'm going to give it maybe until the end of the month, things can get very, very complicated for oil prices.
We had Jeff Curry of Carlisle on last week, and he was talking about how even if the Strait of Hormuz is opened this week or next week, there is going to be an extra risk premium placed not only on oil, but a whole bunch of different commodities, partly because there'll be nations that are stockpiling, akin to what China has done, and partly because people will understand that there is that risk of transporting goods on the seas. Do you agree with that thesis?
Yeah, I think the war is gonna transform the way we think about commodities more fundamentally. Remember, in the 1990s, Japan pushed for just-in-time, and in the 2020s, it's been China's just-in-case strategy of inventory accumulation. So they've been building up huge oil reserves, and we've seen, obviously, in part because of trade tensions, in part because of political/military tensions, we've seen a big buildup in commodity inventories. I think this trend only speeds up once the war's over, and I think that provides support to long-dated commodity prices sooner or later, and we'll see, I think, a bit of a mad rush once we are out of the war. But again, we need to see this war coming to an end, because if we don't, I think the risks of recession will grow by the week as we head into April, and definitely if we are still in the same place in May, looking into a third quarter, I've already mentioned we could see spikes to $160 a barrel. If things keep going, we could see Brent breaking $200 a barrel. I think it may take a little longer to get there, but it's important to understand that we don't have that much time. And obviously, the U.S. is a little more insulated than other regions. But I think in particular, Europe is very, very exposed, as are many other Asian countries, particularly Northeast Asian countries.
Francisco, I know that you track what is going on in terms of the OPEC countries, and we've learned this morning at Bloomberg that the UAE production has fallen to about 2 million barrels a day. It was closer to 3.6 in February. What other countries do you see production really falling off a cliff when it comes to the Gulf?
Well, it is known that Iraq has been curtailing output, as has Kuwait. Remember that, we think probably about 10, 11 million barrels a day of production has been curtailed in the past 2 weeks. So that's about 10% of the world's supplies. About 20% is what passes through Hormuz. So we've seen about production cutting about half. The other big issue, I think, is refined petroleum products. Refineries have been shut down across the board. And the issue with refineries, as you know, is we don't really have a strategic petroleum reserve for petroleum products. We have it for crude oil, so it's a little bit mislabeled. The strategic petroleum reserve is really a strategic crude oil reserve. So if we lose refining capacity, that impacts petrochemical units. You pointed out the weddings in India for LPGs like propane, and honestly, like it's the supply chain dislocations that are building up in the background are gigantic. I mean, remember, 1% of energy is roughly 1% of GDP. So if you take out 10 percentage points of oil, and oil is about a third of energy, plus obviously we're losing on gas, we're looking at potentially 7 or 8 percentage points of energy sucked out the world's system right now, and that's going to have a big knockdown effect on GDP very soon if that disruption doesn't get resolved.
I'm glad you brought up products, because a lot of the conversations I had over the weekend was centered around jet fuel, diesel, LPG. When it comes to these Gulf exporters, are they having to start to pick and choose what they're going to export? What's the most important for the global economy?
Well, we are seeing very little petroleum, in terms of petroleum products flowing through the Gulf. I mean, my understanding is whatever has been flowing has been Iranian crude oil to the tune of 1.5 to 2 million barrels a day. And again, those are crude vessels heading for China, which I think sets a very interesting next set of days with Harg Island now being a bit in limbo. But also importantly, I think the petroleum products are already experiencing huge distress. Jet fuel prices are $250 a barrel already, right? So we've seen that, and we've seen, in fact, Dubai crude oil over $150 a barrel. Again, that's crude oil for delivery in the Persian Gulf, and of course we know China has actually banned the export of petroleum product fuels like gasoline, jet fuel, and diesel, which is in part exacerbating this problem. So I think the question is, who else is going to do it? Who else is going to preserve or limit those petroleum product exports? And of course, we know who is most dependent on those petroleum product exports. Number one exporter in the world of petroleum products, America, 7 million barrels a day. So not a bad time for U.S. refiners, but obviously a point of concern as those petroleum fuels that are being exported also impact domestic prices for gasoline at home in America. So lots of question marks as countries go on to protect their own market.
Francisco, always good to catch up and get some clarity from you, sir, at a very volatile time. Francisco Blanch there of Bank of America on the broader commodity market. The latest on China, a big factor here. The president spoke to the Financial Times over the week and had said this about China. I think China should help too, because China gets 90% of its crude from the Strait of Hormuz. Before going on to say that we need to address these issues, and ultimately he might have to delay his trip to China, which was set to take place in the next couple of weeks. The Treasury Secretary has been meeting with his Chinese counterpart over the weekend in Paris in preparation for that get-together, that meeting over in China. And this is what the Treasury Secretary had to say to the American press just moments ago. If you're connecting those stories, don't. It's false to say if China doesn't open Hormuz that the trip will be delayed. If the president delays the China trip, it would be due to prosecuting the war. The Treasury Secretary just moments ago.
So he's trying to put some distance between that trip and what is going on right now with the Strait of Hormuz, and the fact that the president is coming out and saying that he is demanding, saying it is appropriate last night, that people who are the beneficiaries of the strait will help to make sure that nothing bad happens there. The biggest beneficiary of the Strait of Hormuz is arguably China, with Iran's exports 90%, 95% going to Beijing. But the Treasury Secretary is trying to put a gap in between almost what the president threatened last night when it comes to Air Force One in that interview with the Financial Times.
Besson doing what Besson does, which is calm things down just a little bit. Crude right now, 103 on Brent, WTI 97, with an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. As Anne-Marie mentioned, the UAE's daily oil output has been cut nearly in half. Reuters reporting crude production has fallen to 2 million barrels a day from over 3.5 million in February. The Iran war and the effective closure of the Strait of Hormuz has forced widespread production cuts both on and offshore. Elsewhere in the UAE, Dubai's main airport resuming operations after a drone attack sparked a fuel tank fire that suspended flights. State-owned carrier Emiratis restarting a limited schedule after a more than 7-hour ground stop. The world's busiest hub for long-haul flights suffering 3 disruptions since the war began. And here in the U.S., FCC Chairman Brendan Carr threatening the licenses of major media broadcasters. In a post on social media, Carr writing broadcasters that are running hoaxes and news distortions have a chance now to correct course before their license renewals come up. Carr's warning follows a post from President Donald Trump complaining about coverage of the U.S.-Israeli strikes on Iran. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara in about 30 minutes' time. Up next on the program, short-term pain for long-term gain.
The conflict will come to the end in the next few weeks, and we'll see a rebound in supplies and a pushing down of prices after that. This is short-term pain to get through to a much better place.
Up next, Vishal Kanduja of Morgan Stanley from New York City. You're watching Bloomberg TV. Getting a real-time update on crude production from the team here at Bloomberg. So according to sources familiar with the matter, Kuwaiti oil output has fallen to about 1.3 million barrels a day. Before the war, that was 2.6. That's the latest on Kuwait. This is the latest on UAE. Oil production there has fallen to about 2 million barrels per day versus 3.56 back in February before this war. Just gives you an idea of how much production has been cut in certain places by about half. Brent crude right now positive by 0.2%, 103.34 on Brent. WTI at about 97. We've started to calm down just a bit in the commodity market. In the equity market, it looks like this. Equity futures on the S&P 500 positive through the last few hours, positive by 0.75%. Under surveillance this morning, short-term pain for long-term gain.
I think that this conflict will certainly come to the end in the next few weeks. Could be sooner than that, but the conflict will come to the end in the next few weeks, and we'll see a rebound in supplies and a pushing down of prices after that. This is short-term pain to get through to a much better place where the Middle East can no longer be held hostage by the one rogue nation in Iran.
So here's the latest this morning. Rising oil prices and the threat of higher inflation leading investors to scale back rate cut bets. Vishal Kanduja of Morgan Stanley saying the onset of the war changed the dynamics. The stagflationary shock will delay central bank easing and inflation will cause further macro dispersion. Vishal joins us now for more. Vishal, welcome to the program. Ultimately, what does it mean for this Federal Reserve as they get together down in Washington, D.C. tomorrow?
Morning, John. Thanks for having me on. Interesting times that we live in. Not just inflation shock. I think we are seeing a growth shock as well that will probably subsequently follow. We've seen how history is proving to this or guides us towards this action this week.
Vishal, do you think that this is an opportunity to buy longer-term bonds if you believe this is going to be more of a growth shock and not necessarily a longer-term inflation shock?
We do think that way. I think around that 10-year, 7 to 10-year point of the yield curve does provide you quite a bit of protection, both from a growth shock subsequent that will follow, as well as I think that sort of if you go back to what the Fed was telling us, they felt that the rates even before this were in the restricted territory. And now we've backed up not only rates, smidge on the interest, spreads as well. That gets the overall sort of monetary policy a little bit more restricted than what it was. Now, the Fed, if it had it in its own, could have two rates, one for the lower end of the economy and one for the upper end of the economy. But I think they have to suffice with one. And we do think that they will focus on their second part of their mandate, which is the labor market, a lot more going forward.
Who would you rather be this week, Vishal? Fed Chair Jay Powell or ECB President Christine Lagarde?
Absolutely, Jay Powell. Easier shoes to fill. Economy can withstand this. We are coming into this with very, very strong balance sheets. Now, again, both those central bankers have to focus on the dispersion of opinions and dispersion in the economy that they're going to go through as well. Europe with different countries coming together, one country doing really well versus the other four. And in the US, you're seeing a significant K-shaped economy. And this thing, the extra $200 million that the oil price jump will impact, it's going to impact more on that lower end of the K-shaped economy. So tough jobs they have to fulfill, tough shoes to fill in this week.
Vishal, is this a different ECB? Is there anything left of the Trichet ECB in 2008 when they did hike interest rates?
They are looking at history and significantly worried about this thing. They do not want to hike in a period where growth dynamics were deteriorating. Certain parts of their coalition are suffering through deficit issues similar to the US, France, Italy being case in point. They're going to go through some elections. Taxes are very, very high. UK, not in the EU, but still in that similar region, is facing similar issues as well. So they're looking at history and negotiating over this oil shock that we're going through. And that's why we believe that there might be sort of pain points or pain thresholds that we are crossing through as we are extending the duration of this conflict.
History has not been kind to that decision, that's for sure. Vishal, it's good to see you. Thank you, sir. Vishal Kunduja there of Morgan Stanley. The ECB, their decision on Thursday. The two-day meeting of the Federal Reserve begins tomorrow, concludes on Wednesday. Coming up in the next hour, Liz Thomas of SoFi, Jay Goldberg of Seaport, David Seif of Nomura, Barbara Reinhardt of Voya Investment Management. The third hour of Bloomberg Surveillance is up next.
Investors are giving this bull market the benefit of the doubt.
This is starting to weigh on the market, but we have not quite seen that typical pullback.
Markets have essentially got an assumption that this could be a quick war.
We don't have a lens on when this is going to end. Nobody does.
The market right now is overly complacent in my mind.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equities near session highs on the S&P 500, higher by 0.8%. Small caps outperforming, up by 1 percentage point. In the commodity market, Brent and WTI taking shape and looking like this. Brent crude unchanged at 103, WTI at 97, following a weekend full of escalating strikes into this week. This week right here, full of central bank decisions. A Federal Reserve on Wednesday, an ECB, BOE, BOJ a few days away as well.
Yeah, how do you respond to a stagflationary shock? How do you deal with the fact that inflation expectations in the short term are picking up to a significant degree at the same time that potentially this could crimp growth? Not well. That's sort of been history. And right now, the Fed has an easier job, arguably, of the different panoply of central banks that are going to release decisions. The ECB, the Bank of England, I do not envy them, given the fact that they face a bigger hit to growth and potentially a bigger fiscal response that will create some issues for them on the fiscal and the debt side.
We've repriced energy. They need to reprice growth if these moves hold. This from Kuwait moments ago. The team here at Bloomberg just breaking down the cuts to production we've seen across the region in the Middle East right now. Output in Kuwait has fallen to about 1.3 million barrels per day. Before the war in February, that number was 2.6, double what it is right now. For the UAE, that number now has fallen to about 2 million barrels per day. The number before the war for the month of February, 3.56 million. That's just two nations. There's others in the mix as well. But you can see the cuts here. We're talking about half, production cut in half at key producers in the Middle East.
And this is only the third week in. And this is what happens when basically you have the Strait of Hormuz blocked and this product has nowhere to go. We're still waiting on other numbers officially. We know that Iraq's numbers have come down, waiting on the Kingdom of Saudi Arabia. How much have they had to wind down some of their production given what's happening right now? And the issue with the Strait of Hormuz is that there's no answer right now. And everyone says you can pick apart and do little tools here and there, but the only silver bullet you have is reopening that strait. When it comes to the coalition, there's not a lot of countries that are running to the president's help.
The Iranians want you to feel it. They want you to feel the pain to make sure this never happens again. That's the goal of the Iranians. It's basically what we heard from the foreign minister earlier on this morning.
Ceasefire isn't the goal. That's not exactly what they're trying to do. What they're trying to do is to prevent this from ever happening again. And they've talked about $200 per barrel that is being an inevitability and, frankly, almost a goal. What can you do to offset this? What do you do if you are a corporate executive trying to come up with a plan and giving guidance? Good luck.
It's going to be very challenging, whether you're an oil executive or an executive that requires the use, which is pretty much every company, diesel, jet fuel, helium, fertilizer. This is going across not just the crude landscape, but other commodities as well. When it comes to the Strait of Hormuz, then what the Iranians are doing, there have been a tremendous amount of pressure put on this regime, and they are still not saying that they want to come to the table. Not just the Ayatollah and top brass of the regime taken out, but Karg Island was hit. The military complex on Karg Island was hit. 9 out of every 10 crude barrels that Iran exports goes through that island. So Trump is showing them he can really hit them where it hurts, and it's not working right now.
And here we are Monday morning with equities up by 0.8% on the S&P 500. Coming up this hour, Liz Thomas of SoFi with stocks on a 3-week decline as conflict in the Middle East sparks volatility. Jay Goldberg of Seaport looking ahead to Nvidia's AI conference, and David Seath of Nomura counting down to this week's Fed decision. We begin this hour with stocks aiming to snap a 4-day losing streak. Liz Thomas of SoFi writing, periods like this are incredibly uncomfortable and impossible to predict, but it's unlikely that the stock market experiences a prolonged or deep drawdown. Liz joins us now for more. Liz, good to see you in the studio. Good morning.
Good to see you too. I sound optimistic in that statement.
On the edge of optimism.
Yes.
After a 5% decline, is that it?
In my defense, I wrote that last Wednesday. So
how much has changed in a few trading days?
I mean, here's the thing. This is all about how long this lasts and how many countries are impacted from a growth perspective. Now, this word of stagflation is back, and it's back in a strong way. And I think we're worried about that globally. But I do believe that if this only lasts for, let's say, a month or less, we will be okay. There will be a snapback. And generally, I would say it's likely that we go back to the trends that were in place in January and maybe early February, that sort of cyclical rotation in the market. It's obvious to me that investors still have risk appetite. They're looking to position themselves in places that have been beaten down. So we've had some rough days throughout this conflict, but it was interesting, even in the early days, you saw something like software bounce on those rough days. So there's risk appetite there, I think. As long as we don't destroy that risk appetite, we still have an opportunity to bounce back if this de-escalates.
You can see how this has played out in commodities and energy, obviously, and you can see that's how this has played out in rates, in yields, and how we're pricing central banks and easing or not over the next year or so. Where have you seen it play out in equities? Have you seen any pockets of capitulation in the equity market?
Well, I think the ones that had been beaten down already, I already mentioned software. I think that found its bottom, or at least is in the bottoming process, and investors are looking for ways to position in some of those that maybe were called falling knives before, but now the knife has fallen, right? So looking for opportunities. And something like software, even before this conflict began, it was trading as if the entire industry was going to disappear. And that's probably not going to happen. Will there be disruption? Of course. But disappearance? Probably not. So I think I'm willing to leg into it and watch how this plays out as the year progresses. Other places that have been hit pretty hard by this, I mean, all of the cyclical sectors have been hit hard. Industrials, materials, even consumer discretionary and staples have been hit because we have this big question mark of how much will companies pass through if there is an inflationary shock and the consumer has to pull back. Rather than saying a certain spot in the market, I'd like to see consumer confidence bounce back. And if inflation feels like it's more under control or we're not going to have this prolonged shock, I think consumer confidence will bounce back pretty quickly.
I think that John's question really points to the paddling duck aspect of this market, the idea that each sector has been really operating on its own dynamics. And you've seen, half the stocks go up 20%, half the stocks go down 20%. And sure, the index looks flat, but a lot's going on under the surface. How long can that feature be a feature of resilience versus really challenged should there be a true growth scare in the United States?
So what I think you need to see, and this is, I'm going to answer both of your questions at the same time here. True capitulation is something that happens when you see correlation and volatility rise together. And I don't think we've really seen that yet, at least not even for a full trading day. We saw it the Tuesday after this conflict began. We saw it in the morning. It was a really rough Tuesday morning. Everything was down. The good stuff was being thrown out with the bad stuff. If that happens for a few days, then I think you've reached that peak fear. I don't think we've priced in peak fear yet. And unfortunately, we might need to see a full flush before we can find some more footing. But as I mentioned to John, the risk appetite for cyclicals and some of the spots that are looking more attractively valued, I think, is still healthy. So it's still alive. So that sort of paddling duck under the surface is still looking for places to buy in equities. And that, I think, as long as it remains alive, is a good thing for strength ahead. That's all sort of caveated by, let's say this does last over a month, and let's say break-even inflation rates spike and stay elevated. Let's say we've got a Fed who talks this Wednesday about stagflationary risks or starts to give us the impression that they're more concerned about inflation than jobs. Then I think we've got a conversation where something like hikes comes back onto the table later this year, which would probably terrify markets.
Would that make you more bullish or less bullish on the long end of the yield curve?
On the long end of the yield curve, less bullish. And I think we've seen the 10-year rise over this period for good reason. I mean, this would end up being an inflationary shock in many ways. And there is some maybe saving grace that we are a net exporter of oil. So as prices rise, there are certain spots in the U.S. economy that could benefit from that. But the consumer drives our economy. And if you've got a consumer that's under pressure already from inflation and has been for a number of years, and now we're taking one of the non-negotiable items of their spending, which is energy and particularly gasoline, to get to work, take your kids to school, and pressuring that, then we've got a consumer that has to pull back and make different decisions in other places.
The round trip on bond yields has been unreal. February up 30, or rather down 30 basis points, and then March up 30 basis points, back to where we were at the start of last month.
Yeah, and a full range of one particular benchmark yield. I mean, it's not exactly moving that much out of that range. I do wonder, though, is this going to be recessionary or disinflationary down the line? I guess that's the real question, because if you start to spend less, does that cause the economy to grow more slowly or even contract and lead to lower yields down the line? This is sort of one of the big debates right now on Wall Street.
Let's mention consumer confidence. Mitch, came out on Friday going into the weekend. Sentiment 3-month low. The survey director said this to us: the sentiment readings that came in after the attacks were considerably lower than what we were collecting beforehand. The survey period, really important here, it was between Feb 17th and March 9th. So ultimately, anything that came afterwards, you saw a very different picture. I wonder, Liz, in your mind, and just to wrap things up, do you think this is going to change how consumers interact with the economy when they get those tax refunds, which were meant to fuel a cyclical bounce in this economy?
Yes, I think in the near term it will. And there are two different consumer confidence readings. There's the University of Michigan and there's the Conference Board. The questions for University of Michigan skew towards inflation more than jobs, Conference Board more toward jobs. So I would expect that we see a bigger hit to the University of Michigan numbers than the Conference Board numbers. But yes, in the near term, consumers do usually pull back. I think we're still in an era, though, where the consumer will just hit pause and not stop and not reverse yet. We haven't gotten to a point in gas prices yet, I think, where people have seen demand destruction or entirely changed their behavior. But there is a pause button that gets hit, and you'll see that sort of bake through into the data. One of the things that's really important to watch in this upcoming earnings season is operating margins, to see if companies have needed to start managing their cost structure differently. I don't expect... Operating margins are very strong right now, in fact, above trend. So there is some buffer to absorb this. But I don't expect that there's companies that are going to manage it yet. But you do want to watch that line, that operating margin line, for a rollover, even just the beginning of a rollover, and then sort of manage your expectations if it starts to come down.
Liz, this was awesome. It's good to see you in person. Thanks for being here. Thank you. Liz Thomas there of SoFi, breaking down this market. You mentioned earnings season and corporate executives who will need to talk about this. That's about a month away. The middle of April, when the bank earnings begin.
Yeah, they're probably glad they've got a little time to see how long this is going to go on. And to the point of that one big, beautiful bill, I still go back to this. Deutsche Bank economists think that a sustained oil price around $100 a barrel would be manageable and actually would be offset entirely and then some by the one big, beautiful bill. But $150, another story, even $130. So there's definitely is a sort of sea change as it goes higher.
But not if some of that money was already spent, because consumers knew it was coming down the pipeline. They maybe spent it during the holiday season or in January when electricity prices were higher. This is going to get incredibly challenging for this administration as gas prices continue to tick higher. In some states, it's already above $5 a gallon. And I think when it gets to $4 and continues tracking to $5, that's when you can see more of these controversial tools coming out of the toolbox.
Average around 370 at the moment and climbing pretty quickly. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Treasury Secretary Scott Bessent saying this morning he sees more and more oil going through the Strait of Hormuz and expects oil prices to fall, quote, much lower than $80 a barrel in the coming months. Bessent went on to say his recent talks with his Chinese counterparts in Paris went well, and it's false to say President Trump's scheduled trip to China may be delayed due to the war. Iranian authorities are not seeking a ceasefire as the war enters its third week. The country's foreign minister saying, quote, this war must end in such a way that our enemies never again think of repeating these attacks. President Trump saying Washington is talking to Tehran, but he's not sure if Iranians were ready. And U.S. allies responding to President Trump's calls to form a coalition to support safe passage through the Strait of Hormuz. UK Prime Minister Keir Starmer saying efforts to reopen the strait won't come as a NATO mission, but the UK will work with partners on a plan. A spokesperson for the German government also saying Germany won't provide military support in Iran, calling the war unrelated to NATO. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Up next on the programme, the Morning Calls Plus. Jay Goldberg of Seaport Global looking ahead to NVIDIA's AI conference live from New York City this morning. Good morning.
Most assets should be able to come back within a month to 2 months if and when the war ends. Another key assumption in our numbers is that Hormuz is going to be reopening, which might also be maybe too far-fetched an assumption. We are always one step away from a major escalation on the energy side, and that's, I think, the fear the oil market has.
I would say that was a balanced interview with Francisco Blanch of Bank of America a little bit earlier, aware of the risk but constructive on the outlook and confident that we can bounce back from this shock if it ends quickly, and that's a big if. Right now, crude looks like this. Brent pulling back by just 0.1%. Brent 103, WTI 96.60 and down 2 percentage points. That move sets the tone for this. Just helps equities on the margin following a 4-day slide. A 4-day losing streak coming into Monday on the S&P. We bounced back by 0.9% on the S&P. On the Nasdaq, up by 1 full percentage point. That's the price action. Let's get you some morning calls. First up, Wells Fargo cutting its price target on United Airlines to 130, citing risks from higher fuel prices. Your second call from Seaport Research downgrading Qualcomm to sell, saying the memory crunch is going to hit its customers the hardest. And finally, from RBC, raising its price target on Micron to 525, expecting data center demand to drive multiple expansion. That stock is up in the pre-market by 4%. Let's stick with tech. NVIDIA's annual AI conference kicking off today. Traders looking for a fresh catalyst, with the stock trading lower despite last month's blowout earnings report. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the show, buddy. What are you looking for later?
Yeah, I mean, a fresh catalyst is exactly what the street is looking for, John, but that catalyst is going to have to be pretty spectacular to move the needle. You know, like the problem with NVIDIA is that it's a stock that's traded in a very narrow range, sideways essentially, for more than 6 months. And all of the growth that came from some 2022 through 2024 that was predicated on real revenues growth, nothing's really changed since. So NVIDIA has this guidance for $500 billion of data center sales through the end of the year. And they'd already kind of indicated at the start of this year that they were tracking beyond that. If you basically, both across the buy side and sell side, were to summarize the sentiment, that $500 billion figure is going to have to change enormously to move the needle here. But it is, how can I say this with respect? It can be a bit of a circus. It's 48 hours of just NVIDIA everything, where you hear from the main man, Jensen Huang himself, half a dozen times, so brace.
Stock has done nothing for more than 4 months. It needs to start doing something, that's for sure. It's negative on the year so far. Ed, before you go, I wanted to squeeze in this from Reuters. Meta. This could be a big story. Planning sweeping layoffs, according to Reuters, that could affect 20% or more of the company. Is this a block-type play? What do you think this is?
Yeah, the interpretation is that it is a block-type play. That there's limited sell-side reaction, but they're all looking at it and saying, actually, following on from block, decreasing headcount such that it is, Meta is a good candidate to follow suit, and it would the reason the stock might be higher in pre-market is that it would be evidence that AI is having a positive, meaningful impact for Meta to make that change. I would also note, right, capital expenditures or R&D, that their spending tracks very high relative to peers, and so maybe that either justifies it or they'll have to pull back on some things. But that certainly is the signal from the market in how this is being read.
Stock is up by 3% in the pre-market. Ed, good to see you. Looking forward to the show later. Bloomberg Technology, a few hours away. Meta employs about 80,000 people. 20% is not nothing, that's for sure.
And we've seen them already engage with rounds of layoffs like this, right? The year of efficiency led to the year of investment. This time, they're still investing a tremendous amount of money, but it is not going to increasing their staff. And that really speaks to the trend right now in tech.
Let's keep it on tech and talk about NVIDIA. Jay Goldberg of Seaport Global has a rare sell rating and 140 price target on shares of NVIDIA, writing this will likely be a tough year, buffeted by shortages and rising costs without the demand to bolster their results. Jay joins us now for more. Jay, welcome to the show. Let's talk about the difference between vision and execution. Today might be about vision. Why is the execution a problem?
I think the execution is a problem in part for a lot of factors beyond NVIDIA's control, right? One of their big limitations right now, why they can't take numbers up higher, is because they're limited at the capacity that got allocated by TSMC. Right? TSMC can only make and can only package so many NVIDIA chips. NVIDIA's getting everything they can out of TSMC this year, and that's a pretty hard constraint. I think you look a little bit further out, there's also, I think, growing friction in trying to finance these data centers. Right? I saw statistics yesterday that you look at the hyperscalers, they have something like $700 billion in operating leases off their books. And these, in order for NVIDIA's numbers to keep moving up in a way that I think will make people happy, you need to have some really big numbers. People have to pay for it. And that's getting harder and harder with the size of some of these data centers that are coming online in the next year or two.
Jay, do you expect to get any guidance as to what the Iran war is potentially going to mean for NVIDIA? And I say this, Anne-Marie made a great point about 33% of the world's helium transports through the strait, and that is crucial for TSMC's production of chips and the world's majority of them. I mean, do you have a sense of how some of the big tech players, NVIDIA primarily among them, are really viewing this?
I think the primary concern around the Iran war for semis this year is more on the demand side. What that's going to do to demand, you just had a guest on talking about oil prices going way up. That's going to crimp consumer demand and just make people a little more risk averse when it comes to investing hundreds of billions of dollars at data centers. In terms of little spot shortages like helium, I think there's a pretty good amount of helium already in reserves out there. I'm not so worried specifically about that one component, but you have to remember in the context of everything in semiconductors is constrained right now. Helium is just one more constraint. There's a lot of bottlenecks in the industry right now.
But Jay, on this point, when it comes to a company like NVIDIA, you had Jensen Huang with the president a year ago on that Middle East trip. I spoke to him in Riyadh. He was so excited about data centers in Saudi Arabia and the UAE. Do they need to rethink that rollout?
I think geopolitics are a giant wild card for the whole industry that nobody can predict right now. I mean, right after that same trip, the president tweeted out that they'd reached an agreement for NVIDIA to sell chips to China. We still don't have that, right? So we're still sort of bottlenecked by that as well. Certainly, data center construction, I'm imagining, is not a high priority in the Gulf right now, and that's going to be a concern for lots of players here. But I think that's sort of for me, like worrying about the Iran war, there are bigger concerns than data centers and AI getting built.
Well, what are the bigger concerns? You mentioned China. We do have the president potentially weighing not going to Beijing on this trip. You mentioned these chips that are not even going to China yet. Does China have the appetite for the level of chips that the United States is willing to send?
I think there is a lot of demand out there for AI chips. And I think what's happening is this big meteor of demand has hit the industry and is rippling across. And NVIDIA got sold out first. Now we see that demand spreading to other companies like Broadcom, who I think is still very well positioned here. AMD starts to get into the mix as well, right? If you look at the numbers, NVIDIA is at sort of 83% share of data center semiconductors right now. And that's sort of plateaued, right? Where do you go from 83% share? It's hard to go up much from that. And I think if NVIDIA is going to it's gotten what share it has, and now we see competitors have seen the door cracked open for them, and they're rushing in there.
Hey, Jay, it's good to see you. Thank you, buddy. Jay Goldberg there of Seaport Global. Ahead of this developers conference a little bit later, Ed Ludlow, Caroline Hyde will guide you through that story later on today. Big tailwind for that company coming into this year was the sovereign story. And a lot of that was coming out of the Middle East. And I wonder to what extent that's been upended by the past few weeks.
Absolutely. A lot of money was being sent by these hyperscalers to the UAE, to Saudi Arabia, to create these data centers. What are they going to do in the future? These data centers now need to go underground because they're concerned of the security risk. This is a huge problem. Also, if you are shipping these chips from Taiwan to the United States, how are you doing that? It's going to be a lot more expensive, and potentially you have to avoid a huge region in the global world.
And these countries are making less money. We've seen the production numbers this morning coming out of UAE and Kuwait. Production cut in half, basically, as some of those key producers across the Middle East. Up next on the programme, David Seif of Nomura counting down to this week's Fed decision. Plus, Danny Berger has your morning movers. Micron rising ahead of results this week. Their stock is up by 4%. Stocks are higher by 0.9% on the S&P 500 following a four-day losing streak through Friday, and coming into Monday, we bounced by 1% on the Nasdaq and by 1% plus on the Russell 2000. In the commodity market, the highs overnight 106.50 on Brent, the high overnight on WTI 102.44. We're off those levels, 103 on Brent. WTI at 96.60, and that's breathing some life into this equity market rally. In the bond market, major moves on the month so far. Yields higher by some 30 basis points across the curve, 2s and 10s. Coming into Monday, we declined by 4 basis points across the curve, 2s out to 10s. The 10-year at 4.24, the 2-year at 3.67. The Fed meets on Wednesday, and some major questions about how they take this move in crude and put it into their outlook.
The way that the market has put it into their outlook is by subtracting one rate cut from their expectations. When you look at Fed funds futures, there now is one full rate cut being priced in, and only at the end of the year. Do you get confirmation of that? Do you start to hear about geopolitics? Do you start to hear about the idea that even transitory shocks could have big ramifications in the short term for inflation expectations? The rhetoric will be key.
It's a four-part act coming up on Wednesday. You've got the statement, the news conference, the outlook, and then the political cloud just hanging over the Federal Reserve at the same time. Some big questions about the future of Chairman Powell. You know, when I was asked this question a few times about whether he'd step down in May and just, enjoy retirement, make some real money again, away from the central bank, which compared to his PE money days is like nothing.
It's not real money.
He needs to make real money. I'm sure there's a lifestyle to upkeep. But for him, I do wonder if he stays around now, because these legal issues are just not going away.
They're not going away, even though the White House, in a sense, was gifted a gift over the weekend. On Friday, you had the U.S. District Court basically saying you cannot subpoena the Federal Reserve. And then you had Attorney Pirro come out and say, what we are going to do is continue the investigation and we will appeal this. Okay, then it went silent until just after midnight tonight, the president unleashed on Jay Powell and the district court for what they're doing. So it doesn't seem like they're trying to wrap this up anytime soon.
The senator from North Carolina is a key player here, Tom Tillis, good friend of this program over the years. He's basically saying, just take the out. Why are you not taking the out? The off-ramp is there. Your guy's lined up. We're going to confirm him in the Senate and we can move on. Here's the off-ramp. Take it, but they're not taking the off-ramp.
I can't answer that question, but it feels a little bit like when you're in third grade and you say, you're a dummy. No, you are. No, you are. And you keep saying it because no one's willing to stop. It feels a little bit like that.
The funniest part of that press conference was every reporter kept asking about Senator Tillis. And clearly, Attorney Pirro was getting very annoyed because she said her lane is not politics. And at one point she goes, I don't even know who he is, talking about Kevin Warsh. I'm not sure the incoming potential Fed chair liked the idea of that.
There you go. We'll get back to that story in just a moment. Equity futures positive here by 0.9%. The opening bound just around the corner, less than 1 hour away. Let's get you some morning movers, some single names. Danny has more. Hey, Danny.
Hey, John, a little bit of deal news this morning. Public Storage will be buying National Storage, creating a $57 billion storage giant. The deal size is about $5.6 billion. They're offering just over $42 a share for National Storage. So you can say we're surging. We're not even at the deal price yet. That moves higher by 27% in the pre-market. Published storage sinks by about 4% in the pre-market trade. Elsewhere, we do have some earnings, some big earnings coming up this week. We're going to hear from Micron on Wednesday. The sell side very bullish, out with a lot of upgrades. And again, bullish language ahead of that. So we are seeing the shares rally 3.9% in the pre-market. TD Cowen says that they expect a big beat in RBC, lifting their guidance ahead of those results. Again, they come on Wednesday. Finally, rounding things out with another set of earnings from Dollar Tree this morning. Shares up 1.9% in the past year. They swung to a profit after a loss in the quarter prior. However, their outlook was somewhat muted. It slightly missed expectations, but just want to point out Dollar General had some pretty poor earnings last week. They also had expectations that didn't meet the bar of Wall Street for these value-seeking stores. So some of that might already be priced in. Shares moving nearly 2%, John.
Danny, appreciate the update. Danny, thank you. Danny Berg and Matt Miller coming up on Bloomberg TV in about 30 minutes' time to guide you into the opening bow. Look out for that a little bit later. Traders awaiting this week's Fed rate decision. It's just around the corner. The central bank widely expected to keep interest rates on hold. Bloomberg's Enda Curran joins us now for more. Enda, we talk about that 3-4-part act. Let's park the politics and focus on the three. A statement, a news conference, the projections. What are you and the team focused on down in Washington?
So the real action is going to be, this will be the first time we get to hear from the Fed, John, in terms of their response to the Iran war and the oil shock. As you mentioned, no change to policy expected, but they're going to put out new forecasts that are expected to show an increase in their outlook for inflation. That will be interesting, and at the same time, they're going to nudge down, or expected to nudge down, their outlook for growth. So then when you consider the fact that we're at that point where hawks are really in control of the FOMC committee at the moment, those ones who are more worried about inflation than anything else, when you consider that weak February employment number and the fact that there are those warning $100 a barrel oil will eventually, once you look through it, become a tax on consumers and business and will impact growth, then I think what we could see on Wednesday is the start or the beginning of the Fed debate around how will they respond to that Iran oil shock, and will it ultimately result in rate cuts, and will they, of course, start to use the word transitory again?
And do we have an appreciation for where inflation is right now? And the reason I raise that question is because many people in the economics industry were looking at the PCE data on Friday into the weekend and were focused on the methodology that was used for certain indicators, certain readings on things like legal fees. What's your takeaway of what's going on at the moment?
I think, look, inflation remains above the Fed's target. It's certainly a core PCE, their own preferred gauge, is still beyond, their comfort zone. But, John, it's broadly, what I'll say, stable, perhaps. By component, there's certainly different signals being given off. For example, the goods sector, we saw in those numbers last week, the inflation story there is still somewhat mixed. But the service side of things, you look at the insurance sector, you look at periodically cost linked to education, tuition, healthcare and the like. There's clearly parts of the economy where inflation is real, sticky and persistent. And that's why the hawks on the FOMC are in control at the moment. And that's why we had several at the last Fed meeting warning that at some point they may need to start talking about hikes. Now, I think this Iran shock might put a different hue on the debate at the Fed. I'm not necessarily sure if the Fed will be talking about hikes near term. It's probably going to be more of a story of looking through that. But there's no doubt about it in terms of the Fed getting back to its inflation target. I mean, that remains a long way off for now.
And good to see you. And Curran down in Washington. Appreciate your time, sir. David Seif there of Nomura weighing in on the Fed's path forward, writing this. We continue to expect 2 cuts in June and September under Chair nominee Walsh. We do not think that the Iran conflict significantly lowers the likelihood of Fed rate cuts. A man who knows who Kevin Walsh is. David joins us now for more. David, good morning.
Good morning.
I'm sure you'll let that joke slide. It's good to see you. Let's talk about what you're expecting from this chairman, Chairman Powell, in his penultimate meeting, I believe, on Wednesday.
Yeah, well, we're certainly not expecting any change from the Fed, and I think that at this meeting, and I think Chair Powell has to continue to reflect the entire committee as he does at every press conference, and so really separate from what's going on in Iran, there has been, I would say, a change in Fed rhetoric. Not from the core of the committee like Powell, but from some members of the committee who have gotten a little bit more hawkish. So we might see Powell reflect that. At the same time, we had an 11-1 decision with only one dovish dissent at the January meeting. We could easily see this as a 9-3, which is our base case, with 3 dovish dissents. So Myron this time joined by Bowman and Waller, all 3 of them dissenting. So the decision itself could actually be seen as dovish, with 3 people voting for a cut instead of just 1, with the press conference a little bit more hawkish. When it comes to Iran, though, we really just don't see this having a big impact on Fed policy at this point. So sure, the statement will, of course, acknowledge geopolitical risk. It might not use the word Iran, but we really just don't think this is actually that major for the Fed, despite changes in market pricing.
At this point, how much is that phrase doing some heavy lifting?
You know, it's not doing as much heavy lifting as you might think. I think that the Fed will have to increasingly acknowledge the two-sided risks from this. But the important thing is that it's two-sided risks. So yes, this has raised oil prices. It will probably raise headline inflation. But the Fed really focuses in on core inflation, and that's really important here. And so we really just don't see a huge amount of pass-through from this sort of headline inflation rise, which is really oil-focused, into core inflation. And so we look to the Fed to probably look through this. I think it would take a lot longer of a conflict, significantly more than the, say, additional month that markets are thinking, before the Fed really has to consider this. And it's not even clear that its response would be to be more hawkish, as is being priced in.
That said, even stripping this conflict out, looking at core inflation, it's actually inflecting upwards so far this year. And you're seeing a lot of services and goods that have actually been getting expensive at a faster pace. How can they really reject that?
Well, there's no question that we've been seeing some elements of supercore inflation start to creep up a little bit. And that has, again, nothing to do with the Iran war. I think that is why you've been seeing, as I was talking about before, some members of the FOMC become a little bit more hawkish, and Powell may have to reflect this. It's not really clear that he himself feels that way. But again, you know, we're at the cusp of a major change in Fed leadership, one that we think is going to bring more dovishness to it. And so even if a Powell-led Fed were Powell to remain as chair for, say, another couple of years, even if that was something that was likely to get more hawkish outside of the effect of the Iran war, it's really not clear that Chair Warsh, once he's confirmed, is going to be on board with that at all.
Can we go down a little rabbit hole with core PCE? There was a huge debate over the weekend about a key aspect of core PCE that was changed without disclosing it, legal services.
Yeah.
If they hadn't changed the methodology, that would have been up more than 11%. Instead, it was up less than 1%, which seriously skewed the entire data, which normally is completely predictable based on the other inputs. Is this a political act by the BEA? Is this how do you take this and understand it in the framework of whether some of these numbers are legitimate?
Yeah, I'll tell you, it does seem like the BEA sort of changed horses in midstream here, and usually we, along with many other forecasters, are extremely accurate. Almost everybody was off by a full 10 basis points, which is a big miss on this. And it was essentially 100% due to this legal services fee change. And it was just a matter of, usually it's taken from the CPI when it goes into PCE, and this time it was taken from the PPI. There was no advance warning given on that, and that made a big difference here. I think some criticism is pretty justified. I can't say whether it was political or not. I will say in the BEA's defense that the BEA does have more discretion than the BLS, which comes up with the CPI and PPI numbers, to do these sort of methodological changes. And had it made this change where it didn't matter so much, I think there would have been a little bit of people shrugging their shoulders. I think what is leading to this debate and criticism, which I think is at least somewhat fair, is that they made this change right when it mattered the most. And you know, it is what it is. I don't think there's any way to sort of sugarcoat that is what happened.
Timing isn't great. Let's finish on the calendar. The chairman of the Federal Reserve, Chair Powell, March 18th, April 29th, then he should be done.
Yes.
What are the prospects of him hanging around?
I think there's really three options here. One is, does he leave immediately? Two, does he wait out the midterms and see whether he can you know, if the Democrats win the Senate, he might be able to resign after a few months and prevent Trump from at least nominating a successor and leave the seat vacant indefinitely, or force a compromise candidate, or stay around forever. I don't think he's going to stay around for the rest of his term, which would be until 2028. But I do think that as Democratic prospects of taking the Senate rise, it does make it increasingly attractive for him to at least take a look at and see how November goes.
That screams politics, doesn't it?
It does scream politics.
Is he a political beast?
I think that Powell avoided politics for quite some time, as much as he possibly could, and it was really a sea change what happened on January 11th with his response to the subpoenas, which do not appear to be going away anytime soon. It does appear that he has based some of his statements.
But let me piece those things together, because those pieces of information, your view is important. You just said you don't think the subpoenas are going away, one. There's a prospect that Powell stays until November, two. Doesn't that raise a question about the future of Warsh's nomination?
Subpoenas did not go away despite the ruling from the district court. I do not think that they will be a constraint to Warsh being, in practice, to Warsh being confirmed. I think they will be withdrawn if necessary in order to make sure that Warsh is confirmed in time for him to be on there for the June meeting.
So basically you think Pirro at some point stops the investigation, because Senator Tillis has been very emphatic that he will not go ahead unless the investigation to the Fed is dropped.
I think Tillis is likely credible. There are ways around that in the Senate. I don't think that Thune would necessarily use them. So yes, I mean, I think that they will keep this investigation going as long as they can, but will ultimately withdraw it or end it in time to make sure that Warsh is confirmed for the June meeting.
Okay, David, good to see you.
Great
Thanks for dropping by. David Seif of Nomura on what could be a messy summer for the Federal Reserve. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Iran launching fresh attacks across the Persian Gulf as the war enters its third week. The UAE and Saudi Arabia reporting drone and missile attacks overnight, with the key Fujairah export terminal suffering another hit. The repeated strikes have led to the UAE cutting its oil production by nearly half since the war began. Elsewhere, Meta is planning layoffs that could affect at least 20% of the company. Reuters reporting that top executives have signaled the plans to other senior leaders at Meta. No dates for the cuts has been set, and the scale of the layoffs has not been finalized. The cuts are aimed at offsetting costly investments in AI infrastructure. And a top Apollo executive is sounding off on, quote, the arrogance in private markets. The Wall Street Journal reporting the firm's co-president of its asset management arm blaming the media for creating a frenzy around private credit. John Zito saying, quote, obviously we are in the middle of a private credit party, apparently. If you do credit well, it's supposed to be pretty boring. That's your Bloomberg Brief, John.
Yahara, appreciate the update. Thanks for this morning. Thank you. Up next on the programme, setting you up for the day ahead. Plus, we'll touch base with Barbara Reinhardt of Voya Investment Management as the conflict in the Middle East whipsaws equities. Equities this morning up by 1% from New York. You're watching Bloomberg TV.
It's crazy to me that you see all these narratives being written that central banks are going to tighten into this. I think central banks have learned along the way you don't tighten into energy shocks. I think if anything, you know, if this gets worse than people anticipate, we should be talking about more cuts, not less cuts down the line.
You hope they've learned along the way. Is I imagine what Chris Verona, strategist, was meant to say a little bit earlier when he spoke to us earlier on this morning. Equities are doing better this morning. On the S&P 500, firmer by 1%. On the Nasdaq, up by 1.1. On the Russell, up by 1.3. Two pillars of support this morning. One is a shaky one. We'll talk about it now. Brent and WTI. Brent crude off the highs from overnight. 102 at the moment and down 1%. WTI breaking 95 now. We're down by about 3.9%. That is a fragile pillar of support because that can change any second, any moment. The tone out of the talks over the weekend with China and the US, constructive, even if, as the press secretary suggested just moments ago, Caroline Leavitt, that meeting between Trump and Xi might be delayed. China and the US agreed to stable trade ties to benefit the world. The readout of that meeting coming from the Chinese side just moments ago.
So basically the Chinese side is saying this détente, we want it to last and we want a working relationship with the United States. What's interesting about this meeting, though, is I actually long thought the second Trump had these strikes in Iran, the meeting would be delayed because the Chinese like everything to be done ahead of time. And this is the first real meeting we've seen before that meeting is set to take place in just 2 weeks' time. So a lot of the deliverables aren't yet on the table, and Trump is now solely focused on trying to reopen the Strait of Hormuz.
And that is a major focus, not just for him, but for everybody else as well. As we count you down to the opening bell, this is the trading diary for the week ahead. At 2 p.m. Eastern Time, the NVIDIA CEO, Jensen Huang, speaking at the company's AI conference. Look out for that. Look out for this too. 3:30 Eastern Time, the President and Vice President J.D. Vance speaking to the press. The Vice President's been fairly quiet recently. His thoughts, hopefully, on the war coming up a little bit later. On Wednesday, PPI data plus a Fed rate decision with Chairman Powell. On Thursday, rate decisions from the BOJ, ECB and BOE, plus another read on the labour market. Jobless claims just around the corner. Barbara Reinhardt of Voya Investment Management writes this about the market. There is a real risk of a whipsaw in equities because of the news-related nature of the war, and this is clearly a highly uncertain time for investors to make any major bets. Barbara joins us now for more. Barbara, good morning. Good to see you.
Good morning.
Our capacity to absorb shocks, with the stock market just 5% away from all-time highs. Is there a cushion there?
The valuation cushion certainly isn't there, but the fundamentals going into this war were actually quite good, right? You had wage inflation was coming down pretty dramatically. You were close to the Fed's target on core personal consumption expenditures or getting there. So the fundamentals were great, and you also had very good earnings support. So going into this, it's very different than it was in 2022 when you had inflation was rampant. PCE at the time was over 5.5%. Wage inflation was spiraling, and you had a Fed that had to be very aggressive. Turning into this one, you had an easing of monetary policy, you had fiscal support, and you had very strong earnings. So it's a very different place we were in 2022.
It seems like no one's really worried about a massive drawdown. They're all worried about missing out on the upswing when you do get some sort of resolution to this. Would you say that's accurate?
Well, there's been a lot of nervousness underneath the market. While maybe the S&P is only about 4.5% off of its all-time high, the internals of the market have been very weak, right? Liquidity has been very low. There's been a lot of reduction in length and positions. And also, if you think about where most of the assets had gone in the first 2 months of this year into the emerging markets and into Europe, those markets are down closer to 10%. So we see that there's been some relative weakness. Some of our short-term sentiment indicators are oversold, but they're not looking at capitulation yet, where you would say, shut your eyes and buy. The thing to do at this point, from our view at Voya, is that when you have an initial surge in oil prices, bond yields generally get dragged up with it. We do not think that any central bank is going to be hiking into this. This is a supply shock, not necessarily a demand shock. So if you want to do something in your portfolios, probably buying some duration at this point would be a very good bet.
That's what we've been hearing from a number of guests so far this morning. Is that because there is an expectation that growth will have to slow? Or is it just simply capitalizing on the wrong way bets that people are making, which seems to make sense in the short run, but never does in the long run?
Well, I think there's two things. Number one, no central bank is going to be hiking into this, right? This is a supply shock that consumers are going to be feeling in their purses, and bond yields get brought down because consumption starts to slow. More of your pocketbook has to get spent on energy and gasoline prices. That, of course, is going to slow inflation pretty dramatically, and that's why bond yields are likely to fall off of this.
What kind of levels in WTI, Brent, or gasoline do you predict potentially mean that this would actually impact growth and impact consumers?
In order for it to really hurt the U.S. in a significant way, you would probably need to see Brent WTI, somewhere around $140 a barrel for a pretty long period of time, like 2 to 3 months, in order for it to really hit the U.S. economy very hard.
If the bond market's a buy, are energy stocks a sell?
Oh, so look, if the bond market's a buy, unfortunately, it's the news-related nature of this. If you're selling equities today, there's a real chance you could get whipsawed on something
in both directions.
Yeah, exactly. That the straits suddenly open up or they suddenly end up shutting down again. So I think if you're going to look at this for a longer-term time period, like we do when we're investing for retirement, you try to invest through these political shocks. And if you can get a capitulation, oversold environment, that's when you would potentially start to add.
Have we seen that capitulation yet, do you think?
I don't think you've seen it necessarily in the U.S. If you were to get another 10% drawdown from here, or even maybe another 5 to 5.5, you might start to see it. We look at things like AAII bull bear. We look at the put call ratio. We also have weekly sentiment indicators and also our own homemade ones. You haven't seen capitulation. You've seen distress. You've seen low liquidity levels. but you haven't seen it where you would say, shut your eyes and buy.
Not seeing it this morning either. Barbara, good to see you.
Nice to
Thanks
meet
for
you.
being here. Thank you. Barbara Reinhardt there, Voya Investment Management. Equities this morning higher by 0.9% on the S&P 500. A lot can change between now and tomorrow morning. In the meantime, crude is lower by 3.5%, 95 on WTI, Brent at 102. Coming up tomorrow, Julian Emmanuel of Evercore, Bob McNally of Rapid Energy, Liz Ann Saunders of Charles Schwab, and Lisa Hornby of Schroders. Monday morning, and some of you wishing for Friday already. From New York City this morning, good morning. This was Bloomberg Surveillance.
Sure. What it do? I'm here, baby. Love is patiently waiting with a plan for you. A plan that pays up to 100,000 Rand for a funeral. Absa Flexi Funeral Plan. Your story matters. Absa Life Limited is an insurer licensed to conduct life insurance business. T's and C's apply.
Orders, and I wouldn't say that there aren't negotiations. I know the Iranians come out and said no talks are happening. Maybe no talks are happening directly, but there has been a lot of reporting, whether it's due Turkey, whether it's due Pakistan, that there are intermediaries that are willing to step in right now and are talking to both sides. And one thing I hear a lot from former officials is that anytime a third party gets involved, they always try to embellish. So maybe there's some embellishing to the Washington side and some embellishing to the Iranian side. Potentially no direct talks, but there could be a diplomatic channel.
Should we take a beat about who knew what and when ahead of that post by the president just yesterday? This is from the team here at Bloomberg. Here are some numbers for you. Futures corresponding to at least 6 million barrels of crude was sold in about 2 minutes, about 15 minutes before we got that post from the president yesterday. The average for the same time period over the previous 5 days, 700,000 barrels. That is a lot more volume, way more volume than we're typically used to going into a massive market-moving post by the president.
I've gotten a lot of outreach about this. Individuals messaging me who knew about what when ahead of the president's posting because of the wild moves, as you say, a range we normally see in 12 months whittled down to just minutes. The FT also spoke to someone who said, this is hard to prove, but you have to wonder who would have been relatively aggressive at selling futures at that point, 15 minutes before Trump's post. This is what everyone in financial markets is wondering, even if they can't prove it.
Brent crude this morning, 101.60. Equity futures just about unchanged on the S&P. We're negative by 0.2%. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth, with stocks coming off their best day in 6 weeks. Dan Stroyven of Goldman Sachs raising his price target on crude, and Kay Herr of JP Morgan Asset Management on why the Fed could still cut rates this year. We begin this hour with our top story. Iran firing fresh attacks across the region after denying talks with the US. The Wall Street Journal reporting Saudi Arabia and the UAE are weighing getting involved in the war. Joining us now is Bloomberg's Jumana Basechi from Dubai. Jumana, welcome to the program. Always leaning on your expertise here to understand some of the reporting we're seeing so far. What's the reaction in the region to that reporting from the Journal?
Yeah, if I could summarize the last 24 hours, I would say that there are two things that have happened. Number one is an attempt to move towards diplomacy. And number two, an attempt to perhaps bring down the temperature, de-escalate, and remove the imminent threat of attacking power plants. And one thing that has really emerged, that is very clear in the last 24 hours, is attacking power plants, going after civilian infrastructure, desalination plants. All of those constitute red lines. And from our own reporting, it is also quite evident that Gulf states have put a lot of pressure on the Trump administration to dial back against some of those threats on Iranian civilian infrastructure out of fear of reprisal, because if Iran did respond, they would once again look to target energy and those desalination plants in the region as well. Now, that being said, What is very clear, too, is that the Gulf states' resolve has most definitely hardened over the course of the last week. And you've heard it from the likes of the Saudi foreign minister. The night of those Ras Laffan attacks, he was giving a speech and he said, look, Saudi patience is not unlimited. In the last couple of days, Saudi Arabia have literally kicked out the Iranian military attachés and deemed them to be persona non grata. Our own reporting also suggests that if Iran had retaliated and gone after a Saudi power plant or desalination plant, then that perhaps would be the red line for Saudi Arabia to get militarily involved. But the bar is still very, very high for these states to get militarily involved, and we're not there yet, according to many senior people that I've spoken to. But at the same time, I think it's also worth reminding people that an outcome in which Iran still maintains effective control over the Strait of Hormuz is something that is unacceptable. You heard from the likes of Sultan Al-Jaber. He's the CEO of ADNOC, which is the state-owned energy company here in the UAE, and he likened the Iranian control or effective control of the Strait of Hormuz now to economic terror. So we don't take those words lightly. And I think while, yes, there's been a push for indirect discussions right now between the US and Iran, questions about whether this is going to lead to some sort of a breakthrough. And number two, especially for energy markets, what's going to be crucial from here onwards is who effectively is going to be controlling the Strait of Hormuz. So it's not just who militarily is going to win the war, but also more long-term, who's going to effectively be controlling the passage of those vessels passing through the strait.
Jumana, always good to catch up. Jumana Basechi there, leading our coverage out of Dubai this morning. There's always a home bias on Wall Street. I understand where it comes from. What led to the president removing short-term escalation risk yesterday morning? In markets, you believe it's about markets, the pressure coming from equities, from bond yields. When you listen to Jumana, what I'm hearing is the pressure coming from Gulf allies, pushing the president away from escalating things too quickly, too soon.
Gulf allies, intermediaries, but also I would say even some corporate America executives from the C-suite. You know, Sarah Week, you have Secretary Wright, Secretary Burgum there, and I'm told they did get a bit of an earful of what the tit-for-tat escalation could mean between Washington and Iran to their facilities in the region.
Here's The View on Wall Street this morning. Cameron Dawson of New Edge Wealth writes in the following: you can't predict the taco, but we see equity market volatility continuing in the coming weeks. Cam joins us now for more. Cam, good morning. Do your best. What was that yesterday?
Yeah, well, it was a form of a taco, and certainly we saw stress in markets. Whether we think the thing that probably was the most pressure from a market's perspective was the 2-year yield being above the Fed funds rate. We used to think the 10-year was the thing that got Trump to act back last year in the face of tariffs, but that surge in the 2-year yield suggesting that the Fed could be pushed to rate hikes certainly seemed to be the thing that possibly caused the most pressure.
There's a difference between pricing out escalation risk and pricing in long-term peace. Where do you think we are at the moment?
Well, when we think about oil prices, it's not where you go, it's ending up where you stay. And the really big question is how much damage has been done to infrastructure that could prevent us from getting back down to that $60, $70 a barrel where we were prior to this conflict. There was a great article in Bloomberg last week from Dylan Griffiths, who went through all the different things of infrastructure that have been destroyed or damaged. And it just suggests that even if you do see a de-escalation, getting us back down to oil prices where they were before looks to be an unlikely scenario, which means that we have to price in more of the energy cost pressure on the broader economy and potentially earnings, which we have seen nothing yet.
You've surely got to reprice growth. I'm just going through the estimates quickly that we're seeing from the likes of UBS, the likes of Goldman Sachs. Goldman's saying we're going to average 85 this year on Brent. UBS putting that number at 86. For the second quarter, they put that number at 100. The number before was in the mid-70s. That's a major change. How are you repricing your outlook for growth with those numbers in mind?
The most interesting thing about the last month is how much analysts have held the line on their growth estimates. And that's a big difference from 2022 with Russia-Ukraine or 2025 with tariffs, where analysts were really quick to cut estimates and then ended up having to chase them higher as the economy and corporate earnings proved to be more resilient. So you've seen GDP estimates stay at about 2.4%, but more interestingly, you've actually seen earnings estimates go up in the last month. You've added $10 a share to 2027 earnings estimates in the last 3 weeks alone, which is now pricing in 16% growth for 2026 and 2027. So it raises the question, is this a sign of resiliency or is this a sign of complacency?
Well, you're right to point out that peace can't fix broken pipes. And it does feel like if this lingers, maybe the street individuals will have to go back and say, actually, this is going to have a bigger hit to corporate profit. When does that time come?
Yeah, maybe as we start getting into the first quarter earnings season. It's interesting, if you start pulling back the layers of where this upside to earnings estimates have come from, we think that there's a portion of it that is complacent. The everything else portion of the market where earnings estimates have stayed flat in response to this energy disruption. But the majority of the upside has come from areas like semiconductors and a little bit from energy prices. But remember, the entirety of the energy sector is less than half the weight in the S&P 500 than NVIDIA is. So NVIDIA and the broader semiconductor complex has been the source of all of this upside to earnings estimates, which we can say is idiosyncratic and resilient. But I think it's also interesting to note, despite the fact that you've increased earnings estimates for semis by 30% over the last 3 months, you've actually seen the stocks be flat. So it hasn't translated into better stock prices.
You can push around paper markets with headlines, and we saw plenty of that in the last 24 hours. Physical markets need to clear demand and supply at spot. What we're seeing right now is real tightness. And in certain places like Asia, real shortages. Natasha Kaneva of JP Morgan said demand isn't being reduced by choice, but by the physical absence of inputs. That's about shortages. That's what you're seeing in physical markets.
And you're seeing that, you're right to point out, across Asia. And they are going after a number of measures they have in their toolbox, even telling individuals you have to work from home, or if you want to go out, you have to carpool. They are on the front lines of this energy shock, and they are doing anything they can to make this easier for the consumer.
So, Cam, what are you advocating for right now? We often talk about dislocations and creating value in certain spots of the market off the back of big moves. You talked about the front end of the yield curve, 3-4% for the first time since last year on twos. Where's the opportunity at the moment for you?
Yeah, we think it's really important to stay disciplined with the technicals, mostly if this volatility continues. We got a slight bit of an oversold indication back on Friday, but if we continue to see this volatility, there likely will be long-term buying opportunities in the market, which means that it's important to take the emotion out of some of that decision-making. We always quote Walter Deemer, when it comes time to buy, you won't want to, but that's a really important reminder in times of very distinct uncertainty. So watching those things like breadth measures, watching oversold conditions will be so very important as we navigate through what we think could be continued volatility in coming weeks.
I think it's fair to say that at the moment there's a lack of trust. Can I just ask you your opinion on that and where we stand at the moment? Do you think that could lead to reduced liquidity? Just certain market participants saying, you know what, I don't want to play. Not in this market. I don't know what to trust. I don't know when I'm going to be whipsawed next and by what.
Well, look, we've been seeing liquidity start to pull away from this market for quite some time. Michael Howell has been writing a lot about this. It's really important that liquidity has been ebbing, and you've been seeing it in portions of the market. I think what will be fascinating is if you continue to see a little bit of an ebbing of inflows into U.S. equities, where we have seen a lot of inflows into international equities starting this year, which is very different than last year. If you recall, the whole narrative was about how people were selling America and going into international, and then you looked at the flows data, and people were still buying in record amounts U.S. stocks. So the question is, at what point do people get tipped over the edge and stop buying?
Cam, it's good to see you. As always, thank you. Cameron Dawson there of New Edge Wealth. If you are just joining us, following the biggest one-day gain in some 6 weeks on the S&P 500. Futures this morning, just about unchanged. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Day 25 of the Iran war, and attacks are continuing on both sides, even after President Donald Trump said he's holding off from striking Iran's energy infrastructure for 5 days. Trump saying U.S. envoys Steve Witkoff and Jared Kushner spoke with the top person in Iran on Sunday, but that it's not the new supreme leader. Iranian officials say they're ruling out discussions with the U.S. Meanwhile, Saudi Arabia and the UAE are considering becoming involved in the conflict. The Wall Street Journal reporting Saudi Arabia has agreed to give the U.S. access to King Fahd Air Base, and the UAE has closed a hospital and a club owned by Iran. The Journal also reporting that thousands of U.S. Marines are set to arrive in the Middle East on Friday. And New York's LaGuardia Airport reopening with reduced capacity following that deadly collision between an Air Canada express plane and a fire truck late Sunday night. Recordings reveal an air traffic controller ordering the truck to stop just before the impact with the plane, which was traveling at more than 130 miles an hour. That's your Bloomberg Brief, John.
Yahara, thank you. Thank you for the update. Up next on the program, Iran's last chance.
Iran is one more opportunity to end its threats to America and her allies, and we hope they take it. Either way, America and the entire world will soon be much safer.
Up next, we'll catch up with Stephen Kirk of the Council on Foreign Relations, live from New York City this morning. Good morning. Compared to the manic price action just on Monday, things are a whole lot calmer. Equity futures unchanged on the S&P 500, on the Nasdaq 100, slightly positive by almost a tenth of 1%. Under surveillance this morning, Iran's final chance.
Iran, we've been negotiating for a long time, and this time they mean business. They want to settle, and we're going to get it done, I hope. Now Iran is one more opportunity to end its threats to America and her allies, and we hope they take it. Either way, America and the entire world will soon be much safer.
So here's the latest this morning. Iran firing fresh strikes across the Gulf as President Trump claims talks are underway to end the conflict. Bloomberg's Mike Shepard joins us now from Washington for more. Shep, welcome to the programme. What is the state of play? Who's talking to who, and how far along are we in those talks?
Well, John, this is maybe what we refer to as the fog of war, or perhaps the fog of diplomacy. We have, on the one hand, President Donald Trump yesterday claiming that talks involving his special envoy, Steve Witkoff, and son-in-law, Jared Kushner, with a top person in Iran, were moving ahead, and that Iran was actually looking to make a deal. Yet we just as quickly heard back from Tehran saying that no such talks were underway and that they wouldn't want to reach a deal with Trump at this point because they do not see any trust between Tehran and Washington at this point. At the same time, Iran's foreign minister has been discussing with some counterparts in the region, in Turkey, Oman, and elsewhere, who have served as intermediaries between the U.S. and Iran. So there may be some level, John, of discussions underway, very preliminary if they are really advancing at all. And we'll have to watch to see what the president says later today. He'll be appearing at 1:30 p.m. for a swearing-in ceremony for the new Homeland Security Secretary, Mark Wayne Mullen. It'll be in the Oval Office, a place where he likes to hold court and really talk about his next steps. So the question will be, will he tilt more toward diplomacy or tilt more in the direction of this ultimatum that he has given to Tehran by Friday to come to heel and accept the U.S. terms for some sort of peace agreement?
So, Shep, let's stay on the calendar. So in 5 days, that's when this period expires, in 5 days. Count yesterday as one, we get to Friday. Shep, also on the calendar, additional assets get to the region around the same time. Is that just a coincidence?
Well, that's a great question. And there are some observers who have wondered whether Trump is simply buying time to take perhaps another step. And that would be putting American boots on the ground. And in particular, one of the areas that he has weighed in the past, and even more recently, is whether American troops should take a presence on the energy hub of Karg Island. It is close to the Strait of Hormuz, or perhaps take some sort of a role in trying to reopen the strait by putting a military presence on the ground there. All of that is speculation. It's unclear whether he would move in that direction. But remember that when this conflict started right beforehand, Jared Kushner and Steve Witkoff had been engaged in talks with senior Iranian officials indirectly via Oman, and they found that the talks hadn't gone anywhere, and not to the satisfaction of the administration. And it was at that point that they walked away. So if there are talks underway, as the president says, there is not much time for Iran to make a move. So it will be interesting to see how those assets line up and what the president's next steps will be.
Hey, Shep, it's good to see you, buddy. As always, down in Washington, D.C., Mike Shepard. You'll hear more from Mike later on this morning. Stephen Kirk of the Council on Foreign Relations writing the following: President Trump must get clear, verifiable constraints on Iran's nuclear program and re-establish freedom of navigation through the Strait of Hormuz, or it is a strategic defeat for the U.S. Stephen joins us now for more. Steve, welcome to the program. If I want to call Iran, who do I call right now? Who do I speak to?
Well, that's a very good question. The reporting is that the United States was able to reach the Speaker of Iran's parliament, who is quite powerful. He, of course, has denied that any negotiations are going on. There's also some indication that the Egyptian foreign minister was able to reach people within the Islamic Revolutionary Guard Corps. They have also denied the fact that there are going to be negotiations. Regardless of whether there are or there aren't, it does seem that the president is in keeping with his timeline of 4 to 6 weeks, looking for a way to wind this conflict down.
Stephen, you know these countries really well, especially when it comes to Egypt, Pakistan. I know Turkey you spent a lot of time in. Who do you think could be a real viable intermediary right now between Tehran and Washington?
Well, it seems that the Pakistanis are taking the lead with a lot of help from the Egyptians. The Egyptians have improved their relations with Pakistan. Pakistan has improved its relations with Iran, and the Egyptians have also improved their relations with Iran in the run-up to this conflict. So those are the countries that seem to be playing the most behind-the-scenes role in trying to establish some type of communication between Washington and Tehran. But the Iranian position is we've been negotiating with Trump, and twice in the middle of negotiations, he has taken military action. So there's going to be a tremendous amount of skepticism within Tehran about getting to the table. And as we've seen, the Iranians still have a lot of fight in them. There doesn't seem to be a lot of incentive on their part, despite what the president is saying, to engage in negotiations to bring this to an end.
To picking up on your point that the U.S. needs to reestablish the freedom of navigation in the Strait of Hormuz, or it is a strategic failure, how do you perceive the Strait of Hormuz will be basically operated in the future? Because the president said yesterday, it was a little bit tongue-in-cheek, but he did say maybe me and the Ayatollah will do it together.
Yeah, this is a huge problem. The United States cannot come out of this war with the Iranian regime intact, Iran's ability to fire on its neighbors, no clear verifiable limits on Iran's nuclear program, and the Iranians in control of the Strait of Hormuz. That would be a worse position than the United States was in before the president started hostilities on February 28th. They're going to have to reestablish freedom of navigation through the Strait. That means that the Iranians will have no control over who goes through that waterway.
Isn't that genie already out of the bottle? The Iranians have control. They're not going to get out.
It is, and it's going to be extremely difficult to put that genie back into the bottle. And it seems to me that the way to do that is going to be through military action. It's hard to imagine a negotiation, given the position that the Iranians are in right now, where they have established essentially a new regime for passage through the Strait of Hormuz, that they're going to go back voluntarily.
Stephen, it's good to see you, sir. Thank you. Stephen Cook there, the Council on Foreign Relations, framing what these talks, if there are any, will be about and what the objectives need to be.
And to Stephen's point, the Iranians will say, we have been through these talks with the United States, and every time we've been through them, whether it was Midnight Hammer, whether it's right now Operation Epic Fury, we have been attacked. So why should they take these talks seriously? And to your point, is Trump just buying time until the tens of thousands, the thousands of Marines get to the Middle East, and potentially we could see even regional partners come in terms of backing up the United States?
It's something everybody's doing right now, trying to figure out the next phase of this war. Does it lead to de-escalation or ultimately escalation? Equity futures this morning a whole lot calmer on the S&P 500. Yesterday, anything but calm, particularly this time yesterday, when we were about 40, 50 minutes away from a market-moving statement from the President of the United States. Futures calmer. In the bond market, wild swings. Two-year yields briefly through 4% before retreating back to levels we haven't seen in about a week or so on a two-year yield. Still a major move this month so far, both in bonds and in crude. We'll talk about all next. Dan Stroiver at Goldman Sachs on why crude could stay higher for longer. Plus, Yahira has your morning movers. Netgear surging on a US ban of foreign-made routers. Their stock is up by 14%. Coming off the back of the biggest one-day gain on the S&P 500 in some 6 weeks. On the S&P this morning, we're just about unchanged to negative by 0.1% on the S&P. On the Russell yesterday at more than 2%. Best day since early Feb. So the best days of the month of March to kick off the trading week so far. On the Russell this morning, we're down by 0.2%. In the commodity market, yesterday, of course, consumer discretionary stocks outperforming as energy retreating briefly. Brent is positive again this morning, up 1%, triple digits on Brent, $90 on WTI, up by 2% on the session. And in the physical market, some very interesting buyers stepping in to purchase Iranian crude.
Yep, the Indians, Reliance Refineries, Reliance Industries purchasing 5 million barrels of Iranian crude. This is according to Reuters. And Jonathan, this line strikes me, especially given the fact that we are under a Trump administration. And for years, the president has spoken about maximum pressure on Iran. The crude was priced at a premium of about $7 a barrel to Brent futures. This is much higher in terms of price per barrel the Iranians are getting than we were just a few weeks ago.
This Treasury Department leveled accusations at the Europeans, which I acknowledge are fair, that the Europeans were financing the war against themselves by buying Russian energy.
Yep.
Feels like a very similar situation given the setup and the sanction relief we've seen over the past 2 weeks.
Yep, there's been a lot of people messaging me saying this is very hypocritical. How can you unsanction Iranian crude when you are literally in the middle of a kinetic fight with the Iranians, and they are attacking energy installation of your partners, and some of those are joint ventures with U.S. companies in the region.
That's the setup for the oil market. Here's the bond market, 2s, 10s, 30s. Let's just pick out 2 points on the curve. We'll go with 2s and we'll go with 10s. New highs for the year, 4.01% on 2s, on 10s, 4.44. And those highs for the year struck yesterday. And then we pulled back dramatically following that social media post from the president. 2s back at 389. 10s this morning at 4.37. As we count you down to the opening bell, let's get you some single names. About 3 hours away from the cash open, Yahira has more. Hey, Yahira.
Hi, John. We start with Jeffrey. Shares are up 9.5% in the pre-market on a report in the FT that Japan's SMFG is exploring a possible takeover. SMFG has been quietly building its stake as Jeffries has traded well off its highs, weighed down by its exposure to First Brands and just more broadly questions around its underwriting standards. And for SMFG, this is all about bulking up its investment bank and getting a foothold on Wall Street. Turning to Netgear, those shares also rising nearly 14% in the pre-market after a major policy shift out of Washington that the FCC is moving to ban routers made outside the U.S. over national security concerns. Now, Netgear does make its products overseas, but investors are betting that it could win exemptions and actually benefits if rivals like TP-Link get pushed out. TP-Link is the world's largest router maker, but it has connections to China, so it has been under scrutiny for that. And we end over in Spain with Puig shares up nearly 15% in the pre-market after Estée Lauder said it is in talks to buy the company in a deal that would create a $20 billion beauty powerhouse. The deal would help Estée compete with L'Oreal, but investors are questioning the timing since Estée Lauder is in the midst of a turnaround. So I will note Estée Lauder shares barely moving this morning, though they were down more than 7% on the news yesterday. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour in about 15 minutes' time. On our radar this morning, Apollo curbing redemptions from one of its biggest private credit funds following a surge in requests. The $25 billion business development company, Apollo Debt Solutions, capping withdrawals of 5% of outstanding shares. Elsewhere, Iran launching missile and drone attacks on Israeli cities and U.S. bases in the Middle East overnight. President Trump saying talks to end the war are underway. Tehran denying that claim. And finally, U.S. allies across the Persian Gulf reportedly moving closer to joining the fight against Iran. The Wall Street Journal writing Saudi Arabia will allow American forces to use one of its air bases as the UAE begins cracking down on Iranian-owned assets.
And the Wall Street Journal went even further than that, saying right now Mohammed bin Salman, the Crown Prince of Saudi Arabia, is actually looking to set deterrence and may join in the attacks, while the Emiratis are really trying to cut off some of the financial benefits there are in the Emirates that are helping the regime. What is interesting, and a viewer actually messaged me about this, and we were discussing it, the Saudi Arabians recently, just months ago, signed a defense pact with Pakistan. How messy could those deliberations get on the diplomatic front if Islamabad is leading those talks, but also if Saudi Arabia were to join in this fight and they were attacked by the Iranians, that basically means Pakistan, which wants to lead the diplomatic deliberations, would have to join the fight and back up the kingdom.
Reading through the details of this reporting and our reporting too, and getting a decent understanding of what's going on here, any involvement of Saudi Arabia and the UAE, highly conditional, and conditional on something very, very specific, which is dramatic escalation from here. And that escalation would include damage being done to power plants and the likes, energy infrastructure that would really harm civilians. That was what was on the table potentially on Monday evening, the initial ultimatum that the president would strike those power plants, those energy assets in Iran. Iran in turn would retaliate. They put massive pressure on the US not to go forward with that. And I think that's a decent way of thinking about where we are and what the UAE and Saudi Arabia does not want to do and doesn't want to see at the moment.
No, but would they be willing to do it, especially now? And I think the comments from Saudi Arabia's foreign minister recently basically saying we do have a limit into what we are willing to tolerate from Tehran. They have said a number of individuals in Riyadh, in terms of officials, are persona non grata. So the relationship is quite tense right now.
Crude this morning, 101, WTI around 90. Crude, of course, coming off the back of one of the biggest one-day swings we've ever seen. The Chevron CEO, Mike Wirth, warning that risks might not be fully priced in.
The markets are trading on scant information, I would say, and kind of perception. There are very real physical manifestations of the closure of the Strait of Hormuz that are working their way around the world and through the system that I don't think are fully priced into the futures curves.
Dan Stroyven of Goldman Sachs hiking his full-year forecast, writing, we now expect 26 averages for Brent of 85, 79 for WTI, reflecting a longer disruption assumption and a recognition of structurally high supply risks. Dan joins us now for more. Dan, good morning.
Morning.
Let's talk about how your assumptions have shifted in the past few weeks. What was the base case and what is it now?
Yeah, so we changed our forecasts on the back of an assumption that it will take longer for flows to the Strait of Hormuz to start to recover. We now look for a start of recovery in mid-April as opposed to late March previously. We're looking for a gradual recovery over 30 months. But it's an assumption, and I do think the risks are skewed towards longer periods for flows to recover. Second, more structurally, I think prices even by year-end in our base case where flows start to recover would be about $20 higher than where they would have been in the absence of this shock. Both because we're seeing significant damage to global commercial oil inventories. This is a very large shock, the largest supply shock ever. And second, a recognition of structurally higher risk to supply, I think will lead to faster strategic stockpiling from governments for years to come and a security premium in long-dated oil prices.
Let's just stick on that last point, the stockpiling point. Can you detail the physical shortages that are building right now in places like Asia in certain products and why that would lead them to basically look at the situation and say, you know what, we need to stockpile from here and for a long time to make sure this never happens again?
Yeah, so oil exports from the Persian Gulf are down 17 million barrels per day, even allowing for some redirection via pipelines. About 90% of the flows typically goes to Asia. And so we're seeing extreme prices, for instance, for jet fuel, fuel oil, pricing above $200 per barrel. This is particularly concerning for countries in Asia that have relatively low inventories, have limited strategic petroleum reserves, and are large net importers, and that have a very large share of their GDP accounted for by oil imports. And so even when we do a word count of articles related to fuel rationing using Bloomberg sources, our Asia economics team has identified, for instance, Thailand and India at the top of the list in terms of the risk of shortages.
Where were inventories and storage going into the conflict?
At the global level, inventories were somewhat above average, very high on water, but we're now seeing incredibly quick drawdowns in oil and water. We've essentially undone in 2.5 weeks the largest builds ever on water that we saw last year, and we're seeing large drawdowns also in Russian oil and water. At the moment, there is still this big divergence between actually slight builds of inventories in the US, massive draws on water, and large draws in Asia as well. That's the key reason why TI is at 90, and Dubai and Oman are well into triple-digit territory.
When you talk about what Asian countries are doing, Sinopec, which is China's biggest oil refiner, is basically saying we're going to have to cut how much we export because we need it for our domestic consumption. Are we going to see a lot more moves like that? And when does it start to really hit Europe?
Yes, so we already have seen at least 3 countries imposing restrictions of refined oil products. And so it's really a triple whammy for refined oil product markets. The Middle East is exporting less, especially the heavier products such as jet. Second, we're missing the heavier crude that the Middle East typically makes. That's the building block for the heavier refined oil products like jet, fuel oil, and diesel. And third, several countries are trying to reduce the risk of shortages by restricting exports. And so we're going to very low inventory levels for the heavy refined oil products if this disruption continues.
Mike Wirth of Chevron saying this, we played the sound moments ago. There are very real physical manifestations of the closure of the Strait of Hormuz that are working their way around the world and through the system that I don't think are fully priced into the futures curves. What's the difference between what's happening in physical markets right now and what you see out in the futures curve? And what do you make of that statement by one of the CEOs of one of the biggest companies in the energy sector in this country?
Yeah, so I would agree with Mike. I think while futures pricing is broadly consistent with our base case, where you start to see recovery of flows somewhere mid-April, the skew of risks is very much towards delays and sharper physical tightness, and therefore higher prices.
What are higher prices? What kind of numbers are you thinking about?
Yeah, so we laid out two risk scenarios beyond our base case. One, in the adverse risk scenario, it takes 10 weeks for flows to recover rather than our base case of 6. You end the year at 100 for Brent, significantly higher in the spring. And in a severely adverse scenario, you also have 10 weeks of very low flows, and you have 2 million barrels per day of persistent oil production losses from the Middle East, as happened in some of the largest prior supply shocks. Then you end the year at around 115 with significantly higher prices in the summer.
We're at $3.97 a gallon of gas in America. How high is it going to get to in this conflict?
Yeah, in our base case, you probably go a bit above 4, especially in the summertime when there's a premium, with risk skewed to the upside. That said, retail diesel prices are already at 5.
Dan, it's good to see you. Thanks for dropping by. Dan Stroyven there of Goldman Sachs with his latest forecast on this oil market. We're basically at 4 for gasoline right now.
When he's talking about these other countries taking measures to ban exports, and I'm looking at what China is doing, at Sinopec is doing in their refinery, you have to think, if we get to a level close to $5 a gallon, will this White House come out and say, I know we said we weren't going to ban exports, but that was then, and this is now, and prices are too high, and it's a midterm election year, and we have to do something for these consumers?
I keep hearing this phrase that gets thrown around, demand destruction. What you're seeing right now, I don't think you can call demand destruction. Demand for energy, if you speak to people like Dan, is structurally inelastic. People will carry on using it so long as they can get it. And right now, they can't get it. It's the shortages right now that is really hitting demand, not the price. That's really, really important. The price reflects the shortages. It's the shortages that are hurting Asia at the moment.
It's a great point. And there's dual shortages. There's short term in terms of Strait of Hormuz, the product can actually not move. And there's long-term concerns of this physical demand destruction, of it's going to take months and years for some of these installations in the region to be back up and running as normal.
Brent crude, 101.30 so far this morning. With an update on stories worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The European Union and Australia agreeing to a free trade deal after almost a decade of negotiations. Both parties are working to shield their economies from U.S. tariffs and China's restrictions on critical minerals. European Commission President Ursula von der Leyen saying the agreement will need to be signed off by EU countries and approved by both parliaments. Mark Wayne Mullen has been confirmed as Department of Homeland Security Secretary. The Senate's voting mostly along party lines to confirm the first-term Republican senator who has been a staunch defender of President Trump's deportation campaign. Mullen replaces former DHS Secretary Christine Noem. And more on DHS, senators on both sides of the aisles expressing optimism about reaching an agreement to end the DHS's ongoing 5-week partial shutdown. Speaking after a meeting with President Donald Trump, Republican Senator Katie Britt saying she thought they had a solution to the impasse and she would be working through the night to, quote, land this plane. So maybe today. That's your Bloomberg Brief. John?
Yahara, we can only hope. Thanks for the update. We appreciate it. Up next on the program, cutting through the noise.
We shouldn't be making policy based on short-term headlines. These oil shocks have been things that this Fed has looked through for a long time. Looking 12 to 18 months out, there's still not enough clarity to think that monetary policy itself should adjust.
Kate Hare of JP Morgan Asset Management joins us next, live from New York City. You're watching Bloomberg TV. So here are your scores this morning. Equity futures slightly negative. We're down by about 0.1% on the S&P 500. Following the wild swings to start the trading week, the Nasdaq just about unchanged. The Russell negative by some 0.1%. That is nothing compared to where we were yesterday morning. Heading into that social media post from the president, just removing that short-term escalation risk. In the bond market, a new high for the year on 2s and on 10s. On 2s north of 4%, on 10s north of 440. We're back below those levels this morning at 388 on a 2-year, on a 10-year at 437, and in crude, staying elevated, remaining elevated on WTI and on Brent. WTI was triple digits to start the week, $90 now, and up 2% on the session. Brent crude at 101, just about holding on to triple digits this morning, but way off the highs of yesterday morning.
It's hard to keep track, but really that President's Truth Social post really depressed some of the risk premium we saw going into the week because we had, remember, a 7:45 p.m. deadline last night for increasing volatility and threats against the regime. The regime came out and said, well, we're going to counter that. Now we have a new deadline. Where are we going to be Friday at the close going into this week?
Absolutely no idea. And if I knew, I would not be here. I'd be putting that trade on, and I'm sure someone else was thinking about doing the same thing if they had the information they had ahead of that tweet, that message, that social media post by the president yesterday.
And that's a lot of controversy right now. I know the Financial Times, the Journal, Bloomberg, all looking into how big these trades were. Just a mere 10 minutes before the president came out with that Truth Social post. Knowing what he was going to say, some people suggest, if you knew what he was going to say, that's the trade you'd put on.
Without a doubt. And people are scrutinizing the amount of volume that was going through certain asset classes at certain times, and we'll keep doing our best to figure out just what was going on. Under surveillance this morning, attempting to cut through the noise.
We shouldn't be making policy based on short-term headlines. These oil shocks have been things that this Fed has looked through for a long time. We have to look 12 to 18 months out, not what happened to the oil price yesterday, right? And so looking 12 to 18 months out, there's still not enough clarity to think that monetary policy itself should adjust.
So here's the latest this morning. Bond yields whipsawed by conflicting claims on Iran. Treasuries seeing their biggest intraday swing since last August as traders reprice Fed rate cut bets. Kay Herr of JP Morgan Asset Management writing the following. Our base case is range-bound rates and a gradual repricing of central bank policy rates back to 3%. Kay joins us now for more. Kay, good morning.
Good morning, John. Glad to be here, but I hate to confess it, but I'm happier to be here today than yesterday at 6:45 a.m.
I wish I'd taken yesterday morning off as well, particularly ahead of those headlines that cross. The swings we have seen, we were pricing in cuts, then we started to price in hikes, then we priced them back out again. Where are we now?
John, this was supposed to be a quiet news week. There's no major economic data. All we have in terms of the Treasury markets is 2, 5, 7-year auctions. This was supposed to be quiet. And you know, I guess it was T.S. Eliot who said April's the cruelest month. It's feeling like March is a pretty cruel month. It's almost over. But I think what's really happened here is the market is vacillating wildly between what the Fed's going to do. It actually reminds us of last April. You remember tariffs? Remember that? That seemed so, the financial markets were so volatile. So go back to last April. And at the same time, people were worried about the inflationary aspects from tariffs. What did the Fed end up doing last year? 75 basis points worth of cuts. And if you look at what the Fed said, gosh, last Wednesday seems like a very long time ago, but what was it, 12 of 19 FOMC governors saying they expect at least one or more cuts. So I'm not exactly sure how much what we're going to get, but if you look at the bond markets, we vacillated from as recently as 3 weeks ago, pricing in 2 cuts, yesterday morning, pricing in a hike. And I think what's really important is to take a step back. To us, it continues to feel like a low hire, low fire market. And what we've had here, like I said, similar to last April, is another supply shock. Last year, it was the tariffs. This year, it's an energy supply shock. So I don't think people are really thinking about, people are focused on what's the reaction function of the Fed, what's the reaction function of the American consumer. You've had a significant tightening in financial conditions, not as high as they got to last April, but you've had a very rapid ratcheting up in financial conditions.
It's not a direct comparison, though, is it, though? Because that was a policy of choice when it comes to Liberation Day. This is actual demand destruction of supply chains. Can the Fed actually look through that?
Well, I think the Fed typically does, and you had Myron on before me. The Fed typically does look through any type of supply shocks, and I think we also need to look at what's the reaction of, what's the American consumer going to do in the face of higher food prices, potentially higher, well, what we've seen already, higher gas prices. So,
what are investors doing? Can I ask you that?
Yeah,
what are your clients doing? When yields started to back up, we got through 4% of the front end, 440 on 10s. Were they stepping in?
People are stepping in. So I think there's a couple of things that are really important to look at. So this is an important week in the bond market in terms of supply. The high yield market's going to bring $12 billion worth of supply. So I think it's really important to see how that's digested. The investment grade market, I guess it was 3 weeks ago, had a record week. Was it $135 billion? So a little quieter this week, but I think yesterday priced $7-8 billion, and broadly over the last couple of weeks, deals are 4 times oversubscribed, and deals are coming with 4 basis points of concessions. So when I look at our ETF book, year to date in fixed income, we brought in almost $8 billion. So clients are seeing the attractive yields. You can get 5, 6, 7%. So, you know, I hate this expression, but value has been created. So value is being created on the front end of the spectrum. So you've seen those moves in twos. Values have been created where supply has come on in some of the hyperscalers. So I think what's really important is to take a step back, not get too worked up about where the headlines are, not focus too much on intraday swings, be wary of catching falling knives.
Yeah.
But, you know, overall, broadly, yields can remain very attractive.
Or falling chainsaws at the moment, which kind of
Falling
describes the
chainsaws,
last
I like that one, John. I had not heard
24
that
hours.
before.
Let's go with that phrase, value creation. I can see the value creation in the Treasury curve. I understand that. I get that. What about the credit market, though? How much are you actually seeing?
So you're right. There has not been a lot of value created. I think from the tights to the wides and high yield, we've backed up about 100 basis points. In terms of IG markets, I think we're up to something like 87 basis points. We were in the low 70s. So the question really is a function of what does the economy do from here? You know, the reason that the high yield spreads have been as tight as they are is that default rates have been so low. So we're not going back to a 2020 type era because there's not nearly as much energy, and energy is actually a much better debt backdrop for, you know, for those companies here. But I think you've had some widening. If we're going to go into a recession, though, 10s aren't going to sit here where they are now. High yield spreads aren't going to sit here where they are now.
Yeah, that's the risk. That's the risk for sure.
That's
Kay,
the risk.
It's good to see you.
Always great to be here.
Thanks for being here. Thank you. Kay Her there of JP Morgan Asset Management. That was far too calm relative to the craziness of the last 3 weeks.
Yesterday was one of those craziness of the last 3 weeks, and I love the way you put it, falling chainsaws. And I think you mean basically Truth Social post.
Hands in blenders, falling chainsaws. Not my lines. I remember them from London from another time of the Eurozone debt crisis.
Yeah, that's kind of what it feels
Similar
like.
feels.
But it almost is that times 10.
Don't do any of those things, okay? Coming up next on the program, Aaron Cannon of Clear Harbor Asset Management, the former Deputy National Security Advisor, Victoria Coates, Vikas Dwivedi of Macquarie, and Greg Peters of PGIM Fixed Income. The second hour of Bloomberg Surveillance is just around the corner.
The long-term implications for the economy hasn't been priced in completely.
This is a supply shock. It's going to mean higher prices, but it's also going to mean damp demand.
Higher inflation would tell you to raise rates. Lower growth would tell you to cut rates. So maybe you just don't do much.
I don't think there's any, certainly, reason for cutting at this juncture.
I think in the back part of the year, it's fairly likely we'll get a cut.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price section looks like this. Equity futures just about unchanged on the S&P 500, following some wild swings in the last 24 hours. The biggest one-day rally on the S&P in some 6 weeks, and a big move in crude, following a statement from the President of the United States about 24 hours ago, just removing near-term escalation risk for this market and putting on the table the prospect of talks completing in the next several days.
So basically what we have right now is the president opening up the window for diplomatic talks. You have a number of these countries coming in saying, I want to be the one to do that. Pakistan, maybe Egypt, Turkey. The problem is, Jonathan, how sustainable and real is this? And you made a really good point earlier, which is that you have an amphibious assault ship headed to the Middle East. They're about to arrive at the time of this new deadline. So there's a lot of speculation that potentially the president is just buying time.
There is a major difference between pricing out near-term escalation risk, just taking that off the table for a moment, and pricing in long-term enduring peace. We clearly did one yesterday and not the other. And I don't think anyone's getting too excited going into the weekend about the prospect of having something that takes all of this off the table. Whipsawed yesterday, yes, but remember where we were this time yesterday, before this post hit, in about 3 minutes' time. Before that post hit, there was a very real risk of real escalation in the Middle East, which would drag in Gulf partners across that region and lead to something even messier than what we're seeing already?
Because the president had a threat on the table for yesterday evening that he immediately took off with that post, and that is why we saw the whipsaw in financial markets. But how do you price in long-term peace when already overnight there was continued attacks when it comes to missiles and drones both ways? A number of countries were hit: Bahrain, Kuwait, Qatar. On top of that, there's reporting that we have, as well as goes a little bit further in the journal, about how Gulf partners Saudi Arabia and UAE may be willing to set some deterrents, and if pushed hard enough, would actually join this conflict.
So stocks are calm compared to the craziness of yesterday. Futures so far this morning negative by about 0.2% on the S&P 500. Here's a view on Wall Street this morning from Aaron Cannon of Clear Harbor Asset Management. He writes the following: volatility reduces risk-taking. We see opportunity to own the companies we believe are trading at depressed prices. Let's talk about some of those opportunities right now. Aaron joins us for more. Aaron, good morning.
Good morning.
That first line, volatility reduces risk-taking. Just how much of a reduction in risk-taking have we seen over the past few weeks, given how volatile these headlines have been?
I think we've seen quite a bit, but we are not at levels where I sort of view volatility as creating significant downside risk to the markets. And that vol number for me on just sort of headline VIX would probably be about a 30. So if you look at VIX over the last 3 weeks, we actually haven't hit 30. We've almost hit 30, but we're not there. So it gives me some pause that if the president is not looking for an off-ramp and he's delaying what may be a boots on the ground sort of scenario, we could have vol spike way above 30, and there could be significantly more downside risk to the equity markets in the near term.
There is a lot of speculation right now, and I want to stress the difference between reality, speculation, and perception. This is about speculation and perception. A lot of speculation at the moment in this market. There's some people have an edge that others don't. They have an inside line on what's going to happen, and other people don't know. That there will be statements coming out that they're not aware of. And when you get to that position, I wonder if we have a reduction right now in trust, and that there is a lot of speculation that we are at least perceiving that some people have an edge that we don't. And I want to understand whether that leads to a reduction in liquidity in this market. Because if I'm a financial market participant at the moment, and I begin to believe that someone might have an edge that I don't, do I really want to take risk in that kind of market? Do I really want to step in and put my money to work?
Right. Well, certainly you're alluding to what transpired yesterday, just prior to the president's announcement, which was, I would argue, very unfortunate and certainly didn't instill trust in myself or the market. And if it were some sort of communication that occurred within the administration prior to the president's announcement that there's going to be a 5-day hiatus, we saw significant selling of crude futures just before that announcement, just before we saw crude prices falter. We saw a significant purchase of S&P futures on the upside with the idea that the market was going to blow off top in a positive way. That was an embarrassing moment, potentially, if in fact, as an American, if in fact that was something that could have been avoided. Perhaps, however, there was a communication had across our allies, and perhaps some of these actions occurred from participants in the Middle East rather than within the administration. So I want to be super cautious about pointing fingers at anyone on that front, but it was highly suspicious.
Highly suspicious, and you're right. Very embarrassing as an American if this is true. But to Jonathan's point, if you see this happening, does it make you just want to say, I'm packing up, I don't want to be involved in this market right now?
Well, we can't do that. I do think that if you take a big step back, what drives markets ultimately are the ability for corporations to generate earnings. If you look at the S&P, earnings estimates have actually trended higher. The S&P, I think, estimates for the next 12 months are something like 16% growth rate. If you look at the equal weight, it's something like 10%. The market's trading at 20 and a half times on the S&P. The equal weighted S&P is trading at, 16 and a half times over the next 12 months. So we sort of think that there's the noise of the politics and the policy of the moment, and it has real implications for things like supply constraints on the energy side. What does it mean for inflation? How are consumers going to be thinking about this? and what does it mean for overall growth? But at the end of the day, as investors, we have to look at the companies, we have to look at the sectors, and we have to ask ourselves the questions whether or not these positive trends can continue after the war.
I'm always looking for pockets of tension, and that's where the pocket of tension is for me right now. We've repriced energy across the curve out to the end of the year, higher than where we were before, by some $20. We've repriced interest rates. We've taken out easing. On the margin, we've been starting to sniff out the prospect of rate hikes. Whether that's too far, that's a separate debate, but we've certainly priced out the rate cuts for now. So you've got higher energy prices, the prospect of tighter financial conditions, and then higher earnings. And that's the point of tension for me. Why has the earnings outlook improved at the same time that energy prices have gone up and financial conditions have arguably got tighter?
Well, I think one reality is that the elephant in the S&P 500 room remains technology. And if you look at the upside sort of trends over the last couple of weeks in terms of full-year earnings, it's come from semiconductors, hyperscaler growth, to some extent energy. So we're not seeing that broadening of the story. With that said, I still think the pro-cyclical equity trade hasn't broken down. Not just energy, which is up, 30-odd% on the year, but if you look at, other key areas within the economy, both home and abroad, Japan's up on the year. Emerging markets are up mid-single digits on the year. Yes, they've corrected more over the last month than, let's say, the Mag 7, but that pro-cyclical trade is not over, and we think that there are tailwinds. If this duration of this Iranian invasion can prove shorter and not longer, if it's another month and not another 6 months, then I think we can move back and focus on growth, we can focus on earnings, and we can probably think that the concept of inflation running away a la June 2022, where it peaked over 9% headline, is not going to transpire.
Drone activity yesterday in Bahrain also, though, showed that tech companies aren't immune to what is going on in the Middle East. AWS out with a statement that they've suffered. At some point, potentially, when it comes to those earnings, Mag 7, these companies that were in the Gulf investing billions of dollars, will that suffer?
It could, Anne-Marie. Unfortunately, war also tends to trigger more spending after the storm has passed, and we've seen that time and time again. The other thing we've seen is that usually during the first sort of initial phases of war, we see the greatest spikes in the fear factor, both on the VIX and on energy prices, and then we see a calming effect occur. Are we entering that phase now, and did it start yesterday? Only time will tell. Is this an off-ramp for the president, or is this a delay to bring in troops from Asia, to put boots on the ground, and for this to accelerate further? That latter thought would certainly be a negative for equity markets and for credit markets.
The two-way risk going into the weekend, that's for sure. Can we finish on gold? Big move in gold so far this month, down about double digits so far for the month of March. This headline crossed moments ago on Turkey. They're mulling tapping $135 billion gold reserves to defend the Turkish lira. There has been some speculation about this also over the last week, that the countries who have limited fiscal space, limited reserves to deal with moments like this, maybe the big oil exporters, maybe countries like Turkey, would have to monetize some of those gold reserves, those gold assets. You expecting to see some of that realized?
It could occur, Jonathan. I think that there's a lot of truth to that. Gold's off about $1,000 an ounce since it peaked earlier, in late January. And, it's at about 5,400, and now it's at about 4,400. And there are three thoughts that I have on this. One is central banks are not buying gold, and they may, to your point, actually be selling gold. But it's the second largest global reserve currency. We have to think about it that way. We have the dollar, and we have gold, and we have everything else. The other is retail speculation. When you have heightened volatility and you need to raise capital, where are you going to do it? You're going to do it in things that have gone up a lot. Gold was up 70% last year. So there's been a lot of rationale for liquidating gold. But I think in the long run, the dollar's stronger, another reason why gold's weaker, but in the long run, my view is, gold remains a form of money. It's well tested for 4,500 years. If the dollar is super strong, gold's probably going to be under some pressure. If the dollar were to weaken, going back to your trust question right at the top, perhaps gold may be poised to gain a little bit of steam.
Given what you just said, though, what's the role in the portfolio right now of gold? Does it provide any risk mitigation? Doesn't sound like it. What is it providing at the moment?
I think from a longer-term ballast perspective, it is a currency diversification tool. In this market environment, what have we seen? The dollar strengthen. Gold's been off. Bonds have been off. equities have been off. There's been very few places to hide other than cash.
Gold, little change so far this morning, down big time over the month so far. Aaron, it's good to see you, sir.
Good to see you.
Thank you. Aaron Cannon there of Clear Harbor Asset Management. If you're just joining us, welcome to the program. Stocks just about unchanged on the S&P. Lots of headlines to catch up on with your Bloomberg brief, with your stories worldwide. Yahara has more. Hey, Yahara.
Hi, John. Day 25 of the Iran war, and attacks are continuing on both sides, even after President Trump said he's holding off on going after Iran's energy infrastructure for 5 days. Trump saying U.S. envoy Steve Witkoff and Jared Kushner spoke with the top person in Iran on Sunday, but that it's not the new supreme leader. Iranian officials say they're ruling out discussions with the U.S. Indian refiner Reliance Industries has reportedly purchased 5 million barrels of Iranian oil. Reuters reporting the move after the U.S. temporarily halted sanctions on the oil. A source familiar with the matter told the news outlet the crude was priced at a premium of about $7 a barrel to ICE Brent futures. And Apollo is curbing redemptions from one of its largest non-traded private credit funds. According to a shareholder letter, the $25 billion business development company Apollo Debt Solutions capped withdrawals at 5% of outstanding shares yesterday after clients sought to redeem more than 11%. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, teeing up a deal with Iran.
I think there's a very good chance we're going to end up in a deal. And so we're giving it 5 days, and then we're going to see where that takes us.
It's going to be quite a 5 days coming up. We'll catch up with the former Deputy National Security Advisor, Victoria Coates, from New York City this morning. Good morning. I imagine there's a collective sigh of relief that this is what we're waking up this morning to. Equity futures just about unchanged on the S&P 500, negative by a tenth. Likewise on the Nasdaq, on the Russell, down by 0.11. In the commodity market at the moment, Brent and WTI fairly well behaved, relatively speaking, of course. Brent crude at 101.66, WTI at $90.50. A very different picture to what we were facing down yesterday morning.
Literally this time yesterday morning, we saw moves of 10, 12% on WTI and Brent. We went into yesterday going in with this ultimatum from the White House. You had 48 hours. That was supposed to be, Jonathan, last night at 7:45 p.m. Well, now the new deadline is Friday. Potentially a window for diplomatic talks, or potentially this is just the president buying time because he has troops that are being sent to the region.
This morning could have been a very different morning. Under surveillance this morning, teeing up a deal with Iran.
I think there's a very good chance we're going to end up in a deal. And so we're giving it 5 days, and then we're going to see where that takes us. And I would say at the end of this period, I think it could very well end up being a very good deal for everybody. As good as if we went all the way and just literally annihilated the place, which if we don't have to do that, that would be a good thing.
So here's the latest this morning. Crude prices hovering near 100 as President Trump pauses strikes on Iranian power. The president hailing very strong talks with Iran, a claim immediately denied by Tehran. Bloomberg's Mike Shepard joins us now for the more. Shep, welcome back to the program. Let's just frame these talks. Who is talking to who is mediating, and where are these talks taking place?
Well, it's unclear exactly what the state of the talks is, John, because the president has said that his special envoy, Steve Witkoff, and his son-in-law, Jared Kushner, have been engaging in talks with someone, a top person, he said, in Iran, but Iran has pushed back against any notion of these conversations taking place. We are aware, though, that the foreign minister of Iran has been engaging in negotiations with regional counterparts, and they have served in the past as intermediaries between Washington and Tehran. So that may be where things are getting started, at least in terms of a conversation. But look, John, 5 days from now, it may sound like a lot of time, but really, when you think about negotiations with Iran historically, that's really not much time at all. The 2015 Iran nuclear deal took nearly 2 years to reach, and of course, that was the agreement that President Donald Trump scrapped soon after taking office the first time around, and in part laid this groundwork for where we are right now. It is important to note that there is incentive on all sides to reach a deal. For one, of course, for Iran, the human toll there is rising. One human rights group has estimated as many as 3,200 casualties in Iran. That number is not confirmed by local sources. Two, the longer this goes on, there is the rising risk that this escalates militarily and the prospect that the U.S. could enter in terms of a ground presence in Iran, either by trying to take Karg Island, a key energy hub controlled by Iran, is one possibility, or another move to perhaps try to wrest control of the critical choke point of the Strait of Hormuz is another question. And then there is the Gulf allies themselves, and whether, as Jumarna Bersetchi said earlier in the program, they may decide ultimately whether they need to enter the conflict militarily on their own terms. They have stayed on the sidelines and let the U.S. and Israel carry out a lot of the strikes for now. The challenge, though, is how the U.S. and Iran and Israel get there, and whether, for one, the U.S. and Israel will be on the same page when it comes to the terms. And those terms, what will Iran accept? And what will the U.S. In particular be asking for? For one, we can be sure that there will be a call for the U.S. to take control of Iran's nuclear stockpile. But then there is the question of the Strait of Hormuz. Will there be some sort of effort to try to include that and a guarantee of freedom of movement there as part of these talks? We'll have to see what the president says later today, this afternoon, during a swearing-in ceremony at the White House, and if he has anything more to add, John, on the status of those discussions.
Watch this space, Shep. Appreciate your time down in Washington, D.C. there. Mike Shepard, the former Deputy National Security Advisor, Victoria Coates, writing the following. The 5-day pushback is a calculated pause from the president. Things are going very poorly for the Iranians, giving them all the incentive in the world to agree to a deal. Victoria joins us now for more. Victoria, welcome back. Always enjoy getting some time with you. Let's talk about the outlines of that deal. What do you envision that deal might look like?
Well, Jonathan, good to be with you. Good morning. The deal is actually fairly simple in its parameters, as I understand it. That nuclear stockpile Shep was just talking about has to get dealt with. It's about 850 pounds of highly enriched uranium. That needs to come out of Iran. That is a material step toward preventing them from getting a nuclear weapon. Those nuclear facilities need to be disabled. We need to get after the dual-use facilities like academic institutions where a lot of that research happens. Then we also need to see the entirety of their missile program, which is so much deadlier than we thought it was just 3 days ago after the attack on Diego Garcia revealed they've got 4,000 kilometers of range, not 2,000 like they claimed. So we need that to all get cleaned up. A lot of that work has already been done. And then have a guarantee that the Iranian regime will not attack the Iranian people if they decide to protest. So those are the basic, I think, points that should be not that difficult for the Iranians to agree to if the regime wishes to survive in any form.
Victoria, as you know, in Washington, the saying is personnel is policy. And we understand that potentially an individual in Iran that they're speaking to is Mohammad Ghalibaf, the Iranian Speaker of Parliament. But who are the Iranians talking to on the American side? Because reports were flying yesterday that even maybe Vice President J.D. Vance might become part of the negotiating team.
Anne-Marie, good to see you too. It's a complicated, obviously, situation, and I think the administration is leaving it deliberately opaque. It's not clear if, as you say, Speaker Ghalibaf, I'm going to get his name wrong, who's not a household name, clearly, but is well known in Iran. He's run for president a couple of times. He has deep ties to the Islamic Revolutionary Guard Corps, and so he could be a figure that has some credibility, but it really seems quite chaotic in Tehran. I mean, nobody knows if the new supreme leader is even alive. He hasn't been seen. There's no proof of life. We're not hearing from the president in any particularly consistent way, the president of Iran, that is. And so this may just be kind of a death spiral for this particular government of Iran. And one other point for your audience rather, is the economic problems in Iran are systemic and they're not fixable. 2 months ago, they announced their largest banknote ever, a 5 million rial note. Well, 2 days ago, they announced a $10 million rial note, which is worth about $7. And that is not a sustainable path for any kind of modern economy. So what happens to Iran economically is, in a way, the second front in this war.
Victoria, when it comes to the president putting now a 5-day deadline on potentially these negotiations, do you think he really wants a diplomatic route, or is he buying time?
I think he always wants a diplomatic route. And bear in mind, in the first term, we worked on the diplomatic channels for a year before we ceased compliance with the Joint Comprehensive Plan of Action, the Obama-era nuclear deal. So he gave diplomacy a year of chance in the second term as well. So I think that always is possible. But at the same time, I think you want to watch what President Trump does, not necessarily every word he says. And in this case, we have, the Tripoli, the Marine Strike Group steaming toward the region. Elements of the 82nd Airborne are turning up, and the Gerald R. Ford, the aircraft carrier group, which had to go to Cyprus for some maintenance, is also coming back. So as you say, 5 days is an awfully convenient amount of time for all those things to get into place. But if nothing else, that's additional leverage for any diplomacy that does take place.
The Iranians seeing the same thing, no doubt. The former Deputy National Security Advisor, Victoria Coates, there with the latest in the region. The calendar's set up, right? Potential for de-escalation and real potential for escalation over the weekend as well.
And we had seen this in the past, actually, when the Gerald Ford was headed to the region, the president said, we're going to have another round of talks, and then the Gerald Ford went to the region, and then the strikes actually happened. So potentially looking at this, the president could be offering the Iranians an off-ramp. Come to the table, agree on these terms that Victoria just outlined, which are the core terms that this administration wants to see. Maybe there could be a deal, but if not, everything will be in place by Friday.
The economy's broken, leadership is fractured. It doesn't surprise me that we see headlines saying that Iran denies the talks. When we say Iran denies the talks, who in Iran is denying the talks? And who in Iran would be having the talks that wants to acknowledge they're having the talks right now? They're all problems that we're all grappling with, wrestling with in financial markets. It's difficult to really know what's going on.
It is, and it's a difficult moment. Obviously, the regime has been absolutely decimated, so trying to understand who's running it internally is very challenging. I know everyone is talking about the Iranian parliament speaker. We also have a new individual that is going to be the head of the National Security Council, replacing Ali Laranjani. All of these names potentially could be counterparts.
Coming up next on the programme, we'll talk about crude. Vikas Dwivedi of Macquarie on what could drive Brent to $150 a barrel. That's next. You're watching Bloomberg TV. Equities this morning down by, let's call it a 1/10% on the S&P 500, just pulling back following yesterday's big gains, the biggest one-day gain on the S&P 500 in some 6 weeks. The Russell with a 2% move in yesterday's session, the best day since early February. Pulling back also on small caps, we're down by about a 1/10%. In the bond market, 2s, 10s, 30s, let's talk about where 2s were yesterday. Wow, north of 4%, then pulling back following the president's statement that he's going to take off that near-term de-escalation, or rather near-term escalation risk for this market and push things back a few days. Now 5 days of talks coming up for the president, the US, and potentially Iran.
Potentially. Also, maybe 5 days of the president buying more time, as we do have more American hardware and thousands of Marines headed to the region. What strikes me is what the president troops and then what you hear from the energy sector. Mike Wirth of Chevron yesterday speaking at CERAWeek, talking about how the futures market and the physical market couldn't be further from the truth of each other in terms of what is happening with actual crude and product on the ground. And that is why you see Oman and Dubai, those grades, priced so much higher, closer to $200 a barrel than $100.
We said this yesterday. We said this earlier this morning. You can push around the paper market with headlines. The physical market needs to clear demand and supply at spot. And what you're seeing right now in certain places like Asia, certain countries and certain industries with crude product, you're seeing genuine shortages. Genuine shortages.
Absolutely genuine shortages. What we see from China's biggest oil company, biggest refiner, Sinopec, saying we are going to have to curb exports of product. What you're seeing in Indian wedding caterers saying we're going to have to cut back on your menus because we don't have enough liquefied petroleum gas. We get 90% that goes to the Strait of Hormuz. You're seeing genuine supply shocks in Asia. They're going to start to ripple through to Europe.
Brent crude just short of 102, positive this morning by 1.8%. WTI in the 90s this morning. As we count you down to the open, about 2 hours away. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. Apollo shares this morning down 2.2%. After seeing about $1.6 billion worth of redemptions come from one of their BDCs. They didn't fully redeem that. That would be about 11% of the funds. These fund structures have a redemption gate of 5%, and that is what they enacted. It's something John Zito has talked about in the past, that funds should honor what they have in the perspective and what they tell investors, that will only be 5%. They did get a downgrade from BMO, citing the redemptions as well as some pressure around asset-backed capital and at the same time volatility, which might contribute to more redemptions. Also looking at Jefferies this morning, an FT story that the Japanese bank SMFG is looking at a potential bid to take over Jefferies. It already owns a small minority stake, but they're looking at any opportunistic moment to buy more into Jefferies. Jefferies down about 40% from its peak last year. Shares are up 7.5% in the pre-market. Finally, wrapping things up with Netgear. Those shares also much higher this morning, up about 12.33% after a new FCC mandate that all routers made abroad should not be used in the U.S., a ban of them. Now, Netgear, Stifel points out, they do make their routers abroad, but not in China, and that is key. The FCC will be giving some qualifications and allowing some through. And the fact that Netgear is an American company with a transparent supply chain, Stifel says they're sitting in a pretty good position. John.
There we go. Thanks for the update. Danny, appreciate it. More from Danny in the next hour. On our radar this morning, warnings from U.S. allies in Gulf countries driving President Trump's decision to hold off on destroying Iranian power infrastructure. Sources telling us here at Bloomberg, some allies told the president the war was becoming a disaster. Elsewhere, the Pentagon weighing the deployment of about 3,000 troops into Iran. According to the New York Times, the soldiers could be used alongside Marines to seize Karg Island, the country's main oil export hub. And finally, Japan's finance ministry considering possible intervention in the crude futures market to ease pressure on the commodity. Tokyo saying it is ready to take, quote, all possible measures at all times and on all fronts to protect the yen from volatile commodity speculation.
It seems to be something that a number of capitals around the world are weighing. How do we get ahead of this in terms of what we are seeing in the energy shock, but what's happening in the paper market and the wild swings? It reminds me, Jonathan, remember when you had the Japanese officials going to market participants in terms of a rate check? Now they're going to market participants in terms of a crude check.
They're getting hits both ways. Currency's getting weaker, potentially more so, and you've got the crude price getting higher, priced in dollars. That's a problem for a lot of these big importers.
It's a massive problem, and that is why Asia, as we've been saying, is on the front lines when it comes to this energy shock. They are a lot of these countries, most of them, by and large, are importers. They have to hoard these products, and their imports come from the Middle East, which is why you see WTI throughout this entire crisis still trading at quite a distinct distance from Brent. It is because we are somewhat immune to what is going on in the Middle East from a product side. Asia is not.
This is what the Department of Energy's got to say about things right now. The U.S. Energy Secretary Chris Wright downplaying the market impact of the war, urging energy companies to ramp up production.
Markets do what markets do. Prices went up to send signals to everyone that can produce more, please produce more. The prices have not risen high enough yet to drive meaningful demand destruction. But Americans and energy entrepreneurs around the world are ingenious. So things are being done, but these are mitigants of a situation that's temporary.
So Brent is holding near $100 a barrel as uncertainty lingers around the conflict's outcome. Vikas Trivedi of Macquarie writing, if the Strait of Hormuz remains effectively shut until the end of April, Brent could still reach $150 a barrel. Vikas joins us now for more. Vikas, welcome to the program. Can I start with this? What is your base case at the moment? And perhaps more importantly, what informs that base case?
Yeah, our base case is for Brent to revisit the 120 range. As you mentioned earlier, there is a big disconnect between the physical and the financial markets. We think that disconnect will close if the Strait remains, largely shut. It's not completely shut. So we think 120, maybe 125 is kind of the most likely area that price will revisit. But to your other point, if the Strait remains largely shut through April, even if you get a single day resolution, right? Like, hey, we're done. You won't get flows back to normal till May. By then, the amount of oil that didn't make it to refiners and petrochemical plants will have been so large that, we think 150 Brent, something that closes in on Oman pricing, Dubai pricing, some of the physical markets that you guys mentioned are considerably above Brent. We think that gap will have to close.
That's the base case if the Strait of Hormuz opens in the short term. What happens if it doesn't open in the short term and countries like Saudi Arabia or the UAE also engage in a more material way in this conflict?
Yeah, in that scenario, there are numerous mitigations that can come to the market to limit oil from going to 200 on the futures market. We've seen refined products go well above that already, but global strategic petroleum reserve releases, we think could reach about 3 million barrels a day. The East-West pipeline that crosses across Saudi Arabia to circumvent Hormuz, that could do another 3.5. You've got refining run cuts, which will then translate into even higher refined product prices, but it will alleviate some of the crude shortages. So there's a bunch of big ones, right? And the OPEC also has about 200 million of storage outside of the Middle East. They can use that. So when we add, if everything can come to the market in a timely way, without all the normal bureaucratic friction, you can actually rebalance the market largely, not fully. You still are, cutting refining runs. So that's a, Peter to pay Paul situation, but you can close that deficit from what we estimated about 13 million a day. You could close it down to about 3 million, much more manageable. But you can't do that forever, right? Like even that has a time limit.
The East-West pipeline, I'm glad you mentioned it. It's looking very prudent of Saudi Arabia to have invested billions of dollars of this to bring their crude to Yanbu, to the Red Sea. But individuals I'm talking about are putting higher probability now that the Houthis would get involved and cut some of that production off. Are you starting to bake some of that concern in?
Absolutely. Yeah, we think that should be a big concern. We think where Yanbu is, the pipeline route, all of it is at risk. And to your point, the Houthis have been strangely quiet. The Red Sea issues have been strangely quiet. We don't know any reason why those cannot flare back up again and cause a real problem. So yeah, that's and if you knock that out in any manner, you suddenly roughly 6 million, 5.5 million a day of the mitigation around Hormuz would be gone, right? And then that's a whole different complexion to this market again.
And Vikas, I think we're all thankful we're not there this morning, and hopefully we don't experience that in the coming days and weeks. Yeah. Because what we hear a lot about on this program is that even after this war is resolved itself, that from here we will have structurally higher demand through stockpiling, that countries will become conditioned to avoid this situation ever happening to them again, that particularly the nations in Asia, the big oil importers, like what we've experienced with China, will see elsewhere. Do you see that increase in structural demand, a regime shift following this experience?
We do. We do. We think this will, if this didn't send the signal, then nothing would have to any country saying, hey, we need 90 days inside our own borders, right? Or whatever day they pick, but that 90 is the typical. And now China looks extremely prudent in doing what they did. I know there were a lot of theories about, are they doing it for an eventual Taiwan? But what they said is, look, we've imported an enormous amount of oil and it's far away. We have a fragile supply chain. We need the extra storage, right? And it looks very prudent today. I think everybody will follow that model.
Vikas, I know this is difficult to put a number on, but what kind of premium does that introduce? What kind of new floor does that introduce for this market for the time being?
Yeah, we think it could add, all else equal, about 500,000 a day of extra demand as countries refill and add new SPR storage. You can translate that to somewhere between $5 and $7 a barrel to what your previous base case might have been. So that would move us, kind of into the mid-60s instead of the high 50s, low 60s.
But does that mean this is for the rest of the world, barring the United States?
Yeah. We think, there might be aggregation as well, right? Where countries decide to have like a joint storage between themselves, right? So they don't necessarily all have to build new tanks in every single country, but there's a cooperation. In the U.S., you know, we're at 400 million, 420 million. We're a net exporter, but of petroleum. So technically, we don't need anything by that normal rule of thumb. But there again, it would be imprudent, right? We probably should be around the 500 million range at all times.
Vikas, appreciate your time. As always, sir, it's good to see you. Vikas Trivedi there of Macquarie. Crude right now, Brent up by 2%, 102. WTI at around 90. Your thoughts on the Red Sea and the Houthis getting involved? I mean, I don't think people even want to envision what that might look like in the next several weeks.
Well, we're going to have an individual up in the next hour from Rapidan Energy who I know thinks that those chances have increased further. If this becomes more of a protracted tit-for-tat escalation between Washington, Tehran, and Israel, you can see the Iranian regime, which is in an existential moment right now, telling the Houthis, who they fund,